Good morning, everyone, and welcome to the first trade for Thursday, August 13th. I'm Alexis Christoforous, joined by my co-host Brian Sazi. An encouraging sign for the labor market this morning. The government says 963,000 Americans filed for first-time unemployment benefits in the latest week. This is the first time that number has come in below a million since pandemic-induced lockdowns began in March. Let's take a look at stock futures on this news. They were lower earlier. They have now turned mostly higher. We've got Dow futures up 12, Nasdaq futures rallying 64, and S&P futures up about 3 points. And we know the S&P closed yesterday a stone's throw away from a new all-time high. We have Emily McCormick standing by for more on this latest report involving the labor market. Emily, what else can you tell us?
Well, good morning, Alexis. And as you mentioned earlier, really the labor market crossing an important milestone this morning. We had the Labor Department's weekly unemployment insurance claims coming in below the 1 million mark for the first time since March. So the first time that we've seen this number improve to below that 1 million mark in this pandemic period. So to reiterate that headline figure, we had initial jobless claims for the week ended August 8th coming in at 963,000. That was below the 1.1 million that had been expected and the 1.2 million from the prior week. Taking a look at those continuing unemployment insurance claims for the week ended August 1st, those were at about 15.5 million, also better than the 15.8 million expected and the 16.1 million from the prior week. So that was also a pandemic era low on the continuing claims side. Now, taking a look here from the week ended March 20th, we now have more than 56 million Americans who have filed for new first-time unemployment insurance claims. So still seeing a staggering and historic number if we think about this tally as a whole, as well as on that continuing claims side, of course, with tens of millions of Americans still out of work. Now, taking a look at those first-time unemployment insurance claims across states, nearly every state across the country did report a decline in new claims last week on an unadjusted basis. We had Florida's new jobless claims improving by 23,000 last week for the largest drop of any state. We did have New York State following closely behind with 22,000 fewer new claims filed last week than the week prior. Now, we didn't have a huge reaction here in the futures market. Taking a look at those equity futures, still hovering around the flat line. The S&P 500 and Dow futures had been slightly below that flat line, now popping slightly above. So a muted market reaction here. But again, an important report that we've seen from the Labor Department this morning. Alexis.
We'll take any bit of encouraging news we can get, Emily. I want to turn now to a couple of big earnings reports that are out this morning. Cisco reporting its first annual sales decline in about 3 years. We've also got the CFO, Kelly Kramer, retiring, and the stock, as I see here, taking a big hit in the pre-market, down about 7%.
That's right, Alexis. And taking a look at Cisco's results, one of the big headlines coming out of it was the company announced plans to cut costs by $1 billion on an annualized basis over the next few quarters, something that analysts hadn't been looking for, really coming as a surprise here during that earnings call yesterday. CEO Chuck Robbins saying that Cisco is really re-examining its business in light of the pandemic, focusing on accelerating its investments in cloud security and collaboration, education, healthcare, and automation. So a couple of new focus areas now for Cisco, potentially cutting back on some of these other areas as well to get to that $1 billion worth of cut cost. Taking a look at those fiscal fourth quarter results, we did have a beat on the top and bottom line. We had revenue of $12.2 billion, slightly better than expected, but still down 9% over last year. Although Cisco did guide towards yet another quarterly revenue decline on a year-over-year basis. The company seeing fiscal first quarter revenue as much as down 11%, much worse than the decline of 7% that had been expected. Alexis?
Now, on the flip side, you've got Tapestry. That's the company behind Coach and Kate Spade, rallying here in the pre-market after losing less money than expected in the latest quarter. What can you tell us there?
That's right, Alexis. So we did see Tapestry with a narrower than expected loss, that adjusted loss per share at 25 cents versus the 58 cents loss per share expected. Also saw net sales of $715 million, down 53% year over year, but still better than expected. And that was led by a decline in Stuart Weitzman. Those sales were down 61% over last year. The company also rolling out a new acceleration program to try and streamline the organization. With that, it's planning to incur total criminal charges of up to $200 million, but it expects it will realize about $300 million in gross run rate expense savings from its initiatives. That's going to include store closures, going to take place over the next several quarters and potentially several years, and will include some brand revitalizations for each of Coach, Kate Spade, and Stuart Weitzman. Now, taking a look at Tapestry, we do have that stock actually up just about 6% in pre-market trading. So taking that better than expected results on the reported quarter and that guidance for the future revitalization plan in stride here. Alexis?
All right, Emily, thanks for that. And this morning, there are growing doubts over a stimulus deal. The latest round of talks yesterday between House Speaker Pelosi and Treasury Secretary Mnuchin broke up almost as soon as they started. And President Trump said last night that a deal is, quote, not going to happen. Our DC correspondent Jessica Smith is here with us now. And Jess, I guess Pelosi said the two sides, and her words are miles apart. This is not good.
Yeah, the two sides are still very far apart here. Treasury Secretary Stephen Mnuchin and House Speaker Pelosi did speak by phone yesterday, and the Democratic leaders say that Mnuchin made it clear the administration was not going to budge. They say that the administration still doesn't grasp the magnitude of the problem, and they won't meet again, or at least they say they are going to wait and restart negotiations until the administration starts taking the process seriously, in their words. Now, Mnuchin says that it was the Democratic lawmakers, the Democratic side, who are not willing to negotiate. He says they have no interest in it. And we did hear from President Trump yesterday at his briefing with reporters, blaming Democrats for this, saying that a bill is not going to happen because they are pushing for so many other things that are unrelated to the coronavirus. We will hear from Speaker Pelosi at 10:45 this morning in our weekly press conference. So we'll see if she gives us any more details about where things stand.
And what about Trump's executive actions that he signed over the weekend? I know some of them are going to be challenged in court. Where do those stand right now?
Well, it's still not clear when people may start seeing any extra money, those enhanced unemployment benefits that the president had promised. And he did promise $400 a week extra in the beginning of this, but now it looks like it will only be a guaranteed $300 a week if the states can get this program up and running, which it's not clear that they're going to be able to do anytime soon. We're also waiting on further guidance on the eviction moratorium. It's not really an eviction moratorium. It's an executive action on evictions, but it doesn't ban evictions at this point. And experts worry that it might give people a false sense of security. And finally, there are worries about the payroll tax move that the president took over the weekend, deferring those payroll taxes. The Chamber of Commerce put out a statement and a letter to the administration saying that they had concerns about this for employees and employers. We also heard from President Trump yesterday saying that he wanted to permanently cut that payroll tax. But that is something that would need Congress to get involved, and Congress is not going to be anywhere near excited about that deal. That's not going to happen. So we'll see what the president does going forward on this.
All right, Jessica Smith, thank you. An Iran-operated Navy helicopter boarded and then briefly seized a Liberian-flagged oil tanker yesterday near the Strait of Hormuz. That's according to the Associated Press. The Iranian Navy held the vessel for about 5 hours before releasing it. Yahoo Finance's Jared Blickery is here for more. So Jared, give us the details. What do we know here? We're also showing some black and white video of special forces roping down from a helicopter. What effect, if any, is this having on the oil markets?
Well, oil has been slightly elevated. I don't think that this is the single biggest driver right now. We have a lot of other factors in play, but we can remember last year when we had tensions rising in the Gulf, particularly around the Straits of Hormuz. That's where 1/5 of the world's traded oil passes through. It's an incredibly important channel that's very narrow. And if tensions do rise in this area, it does have an effect on oil generally. But given the limited scope of this and what we know so far, I don't think it's really affected the price just yet. But we definitely do need to monitor this.
Now, something that can move prices, we know, are these reports we get weekly. IEA out with a report saying that demand for oil this year worse than expected.
Yeah, they're actually reducing their demand expectations throughout 2021. That's the end of next year. The steepest downgrades are coming with the 2 quarters that are finishing this particular year. And they're saying that, yes, 500,000 barrels per day That is the demand cut estimate, but they're also saying that supplies in or outside of OPEC should increase by 500,000 barrels a day. Now that would be bearish on prices, as would that reduced demand forecast. But we can see crude oil here is up, or excuse me, down only about 16 basis points. And just checking out some of the charts here. So this is the overnight price action, kind of zigzaggy sideways action. But if we look over the last 2 months, once oil was able to break above 40, that was right here in June, it's really stayed nicely above this important threshold. So maybe some of the tensions in the Gulf right now are contributing to the oil increase here.
All right, thanks for the wrap up on oil, Jared Blickery.
All right, let's head over to Europe and check in with Yahoo Finance's Tom Belger. Tom, the U.S. won't be lifting tariffs on EU goods. How are markets reacting?
Yeah, there's a lot of disappointment here at these continued tariffs on around $7.5 billion of European products. That's hit European stocks this morning, including Airbus particularly. And they're saying they hope the EU will respond appropriately and defend European interests. What's interesting, though, really, is actually how restrained the EU's response has been, because you could look at this the other way. The US hasn't increased tariffs, which was the real fear here, and the EU has just welcomed that in their own statement. Both the UK and EU authorities, they say they're going to keep pushing back on current tariffs, but the UK government similarly welcomed US restraint and actual easing of tariffs on shortbread, which should bring down prices where you are. Brian.
And Tom, lots of talk and all eyes are still on that GDP report from the UK yesterday. Not good, but consumer spending data out today, perhaps a little more encouraging.
Yeah, good to see some encouraging data, as you say. These are new figures from Barclaycard. They've got about 10 million customers in the UK. They say spending's almost back overall at pre-virus levels. And that tallies with the signs we saw of a rebound in yesterday's data, which was slightly buried in the headlines about the worst recession in Europe. The economy actually expanded more than analysts expected in June. We've had car sales and construction recovering most. The big question, though, of course, how much is this a one-off rebound after lockdown? Brian.
Tom Belger, thanks so much.
All right, stay with us. Still to come on the first trade. What does a weaker dollar mean for the U.S. economy, and which companies might be able to benefit from it? We'll talk about it right after the break. The S&P 500 may be closing in on a record high, but the pandemic and concerns over U.S.-China relations leaves plenty of question marks about the future of our economy. Joining us now is our editor-in-chief, Andy Serwer. Hey, Andy, I know that you recently spoke with Roger Ferguson, the president and CEO of the Teachers Insurance and Annuity Association, TIAA. What insights did he have on where the economy is headed?
Yeah, an interesting guy, of course, Alexis, because he was also a vice chairman of the Federal Reserve. And so someone who really knows the financial markets and in fact was at the Fed during 9/11. So he understands what it takes to sort of manage through one of these crises. And TIAA has $1 trillion in assets as well. So a lot of responsibility there. He talked about questions coming from his customers and how those have changed during COVID. Here's what he had to say.
Our business is telling us that individuals started in the place of being very, very anxious. So we could see a big uptick in the number of phone calls and the nature of the questions. They were mainly looking for reassurance about their own savings and about market and market volatility. You may recall that in early March, the markets were, I would describe them almost in panic mode. And needless to say, that spilled over into how individuals are seeing things. I'd say more recently, the call volumes have started to return to normal. The kinds of questions are the ones you'd expect, but they don't seem to have that same sort of tone about them. And so that's one thing. The other thing that we've seen in our business is a pickup in flows into our core annuity product, the TIA Traditional. Which is historically has been and is shown again to be a safe haven investment. Individuals who are worried about markets, worried about uncertainty, want to take advantage of an insurance company type product. We're moving money into that product at numbers that are much higher than we've had historically. That has slowed somewhat now, but still sort of higher than normal. And so those are some of the things that we've seen. That indicate that the recession and the uncertainty continue to be there, but maybe slowing down just a little bit from panic to the kinds of reasonable questions you'd expect to see on a day-to-day basis.
Of course, the thing about talking to someone like that about subjects like this is that things change so quickly. And, again, we could slide back into a situation where we get more panic calls. I think, all of us agree that the market being at the levels that they are affords a level of comfort to investors right now. If that goes away, you're going to see a lot more uncertainty when it comes to Mr. Ferguson's customers, no doubt.
Andy, you mentioned that Ferguson is a former vice chairman of the Federal Reserve. Did he share any insights on how he thinks the Federal Reserve has handled the crisis?
Yeah, we talked about that a little bit, Brian. And I think that what he indicated is that the Fed actually works through a cumulative knowledge experience. That's sort of how he described it, which is that they learned from previous crises. And they learned from 9/11, and probably most importantly for us, they learned from 2008, 2009, which is, I think it's sort of universally accepted that there was a little bit underdoing on the part of Washington, both in terms of fiscal and monetary policy, and that this time they weren't going to get caught not doing enough. And that's what really informed Jay Powell, to make sure that you come out with guns blazing. And I think you really saw that coming from the Fed. So this is sort of all these sort of top level Fed, current and ex-Fed people having this kind of communication that informs them that way.
All right, Andy, thanks for that. And of course, you can catch the full interview with Roger Ferguson on Influencers with Andy Serwer. That is tonight on yahoofinance.com or on your favorite streaming device.
Thanks.
We have our eye on the dollar this morning. The pandemic and all this fighting over another stimulus package has driven it down to recent lows, and that is impacting a lot of businesses. Here to talk about it is Wolfgang Koester, senior strategist at the financial intelligence company Kyriba. Wolfgang, good to see you. Good morning. You actually say that a stimulus deal is bad for the U.S. dollar. Why is that?
Well, if you have a stimulus package which actually keeps printing money, and in other countries you don't, you're going to have more, quite frankly, dollars, which then means that there's more supply and not as much demand. Therefore, the price would go down. But I think what you're actually seeing is that are we having a stimulus package? Are we not having a stimulus package? What this looks like What's more dangerous for corporations here is the volatility that's been creating ever since, quite frankly, March. So you're trading volatility at a significant high. And the corporations are not in the business to trade one currency versus the other and figure out whether the dollar's going up or down. Corporations really are looking to be currency agnostic. They would love to work without the impact of this volatility. Obviously, that's not doable unless you manage your exposures properly. And so you have companies who really understand the foreign exchange exposures, which then translates into how good, and this is, I think, really important for investors, is how good are corporations is actually managing their entire liquidity. Because liquidity might have been number 4 or 5 on priorities in the past, but currently it's number 1. It's your blood life. People are understanding that in these tough times, you really need to look at the entire liquidity of a company. And a good signal of that is how they're managing the dollar.
When do you think this dollar weakness trade will unwind, and what's the trigger?
Well, I don't know is a short answer of that. What I do know is that the volatility is going to stay here for quite a while, and it's going to be a pain for companies. When the dollar goes down, they're making more money abroad, which actually is good for U.S. companies' revenues. So all of a sudden your dollar goes down, but your jeans that you're selling in Europe, euro is going up, so you're actually making money on that. But on the other hand, if you're producing in a country where your dollar is getting less, then all of a sudden that's not good for you. So you have these things that are going back and forth, and directionally it's very difficult to look at companies and see whether it's going to be good or bad for them when the dollar goes down. What is important here, though, is what companies are not being impacted by it at the bottom line because they're managing it correctly.
Wolfgang, talk to us about some of those companies, if you could get specific. Which companies are managing their currency issues? You say that the goal is to be currency agnostic. That's tough for a multinational. Which companies are doing it right now?
It is tough for multinationals to do, but it is very doable today. The technology is there to do it, and so they can manage it. So if you're looking at companies like Bristol Myers Squibb, basically unimpacted, a massive company, large company, they had less than a $3 million impact due to foreign exchange. You go to Columbia Sportswear, very minimal impacts due to their revenues and to their bottom lines. You have companies like Google, who for years have been doing this really well. They understand their exposures and they can adjust it at any time. And I think that's the important part here. Now you have companies like an Anheuser-Busch in comparison to that. When you really think about this, is a massive difference. You got a company like Bristol Myers Squibb, basically immaterial impact, and they're doing a good job on liquidity. And then you get a company like Anheuser-Busch, who lost last quarter alone $532 million. How many jobs would that be? Lost due to foreign exchange. They obviously don't understand their exposure. And if I'm an investor and I'm looking at what company is going to be good at managing that, that's probably not one I'm going to, or one that I'll be very cautious as to say, look at another company. Now, this is a sweetheart in the IPO business for years, and everybody loves this for the last couple of years, a company called Splunk. Great product, but how well are they managing their currency impacts? We talked about this 2 weeks ago where we said, you got to kind of start warning about this. You got to look at companies like that. You can look at their their quarterly statements as well as their annual statements, and it clearly states in there whether they're making or losing money. And that's a great indicator of how they're actively managing their entire liquidity. Now, they're growing great, so should it be immaterial? Maybe, maybe not. Splunk could be higher priced in their stock market if they got this part under control. And that's what investors need to look at.
All right, Wolfgang Koester of Kariba, thank you so much for being with us this morning. We appreciate your time. Coming up next, a deeper dive into the markets as futures search for direction. We'll be back right after this. We're 4 minutes away from the opening bell, and Jared Blickery, we've been talking about the S&P 500 being on the doorstep of a record high for days now. What might get us over the hump today?
Just a few basis points, and hopefully then we can stop talking about it in anticipation of this great event. Here's what's happening overnight. You can look across the world, a lot of red, but some green mixed in. The Nasdaq notably is up, but the Dow is off about 17 basis points or about 48 points right now. But let's take a look at our Nasdaq 100 heat map. We can see strength broadly in the fangs, Apple up another 1% here. And as we've been tracking some of the different sectors, we do have the semiconductors of interest. AMD just on fire day after day, up 7% yesterday, not on any particular news, but we have Applied Material after the bell today, and they are going to be reporting their third quarter earnings, hopefully better than the second where they took a big dip, but adjusted EPS coming in at about 95 cents for the estimate with sales of 4.18 billion. Going to look for what's happening in the DRAM mix, might have some spillover effects into Micron and Microchip, but we'll see what happens today after the bell.
Yeah, those semiconductor stocks were on fire yesterday. AMD in particular, we'll see if they can keep it going. We'll be back with the opening bell right after this. Some encouraging news on the job front this morning. Weekly jobless claims fell below 1 million for the first time since March. And here's your opening bell. We saw the Dow and S&P futures sort of searching for direction, hanging near the flat line, heading into the open. Nasdaq futures were rallying. Looks like the Dow's going to start the day down 100 points. And here are the headlines making the first trade front page. The number of Americans filing new jobless claims fell to 963,000 in the latest week. This is the first time that number has fallen below 1 million since mid-March. Analysts were expecting 1.1 million claims to have been filed. It's also a significant drop from nearly 1.2 million the prior week. Iranian forces briefly seized an oil tanker marked with a Liberian flag near the strategic Strait of Hormuz. That's according to the Associated Press. The Iranian Navy took control of the tanker yesterday for about 5 hours before releasing it. The news comes amid rising tensions between the U.S. and Iran since President Trump pulled out of the Obama-era Iran nuclear deal back in 2018. And two social media giants are taking some extra steps to fight misinformation heading into the November presidential election. Facebook now has a section that lets users find resources like polls, where candidates stand on topics, and where you can vote. Twitter also has new policies for accurate information on early voting and mail-in ballots. It plans to add more resources over the next month. Let's dig deeper into the markets now with Kevin Krogan. He is Managing Director of Investment Strategy at Buckingham Strategic Wealth. Kevin, good to have you on the show. I just want your reaction to what we saw today in terms of the jobless claims number. Are you encouraged by the fact that that number, while still historically high, did fall below 1 million for the first time in months?
Good morning. Yeah, good to be with you. So I think for sure what we saw in the jobs report today is encouraging. We are seeing a slow but steady improvement in the economy. We saw the number actually beat expectations, which was great to see fewer initial claims. But I think the sobering aspect of the report is both just the extremely high level initial jobless claims continue to be, but also I wouldn't lose sight of where continuing claims are, which was at 15.5 million, which again also beat the median forecast, which was closer to 15.8 million. But still, these numbers are staggeringly high and higher than what we've ever seen in the modern economic data. So, again, on balance, good news, and that is things are going better than expected, but still a lot of work to do in terms of getting folks back to work.
Kevin, the market breathed a sigh of relief yesterday on the Kamala Harris pick. Are you confident, as someone that manages money, that a ticket of Joe Biden and Kamala Harris won't derail the stock market rally?
It's a really good question. I think there's still a lot of uncertainty. I mean, particularly with respect to the selection of a vice president, right? I mean, we've seen in history lots of different examples of very powerful vice presidents. So as an example, Dick Cheney would be one of those, all the way to those who had very little influence or say over the direction of a particular administration. So upon the pick of Kamala Harris, you didn't really see much movement in markets. And I think that in general makes sense because you don't really know how that will influence the direction moving forward. The other broader point I'd make about the upcoming election is that the market is already pricing that in to some degree. So if you look at betting markets right now, as an example, prediction markets have Joe Biden and Kamala Harris as roughly a 55-60% chance of winning in November. And as those odds change over time, as we potentially get closer to the election, or as events evolve, new polls come out, things like that, the market will continue to reevaluate those potential odds and will readjust based on that future forecast. But one thing I would caution investors, and what I've told our clients as they ask about the upcoming election, is that you could be right that let's say a Biden-Harris election would be bad for the market. You could be potentially right about them winning, about them being bad for the market, but the market could still go up for other reasons, right? We know that over time, stocks have positive returns well in excess of cash. So things can happen in the market and in the world that supersede you being right about the election and right about the potential impacts of the election. You could still wind up being wrong if you decide to make changes in your portfolio as a result of an upcoming election.
Well, Kevin, if you say the market is pricing in the election currently and the market's near a record, it sounds as if a potential Biden-Harris pick, given they are leading in the polls, is that good for the stock market then?
Right. So I think the market has priced it in to some degree. So priced in basically a 60% chance that Biden wins in November. And so, of course, the market can move as we approach election day. But again, predicting what will happen as a result of a particular election can be very difficult. So even you think back to 2016, the night before the election, now President Trump then candidate Trump had just a 20% chance in prediction markets of winning the election in 2016. And we, of course, know with hindsight that he won that election. And there were also lots of forecasts at that time that if Trump were to win, it would cause a big pullback in the market. Mark Cuban was one forecaster who made that prediction that said it would be devastating for the stock market if Trump won. And of course, what we saw was a great bull market coming out of that. Now, of course, it eventually pulled back, but due to circumstances that no one was predicting in 2015, 2016, much less in 2019, people were not predicting why the market would have pulled back earlier this year. So it's very difficult to say what will happen as a result of the election. And again, if you think back to 2016, that election was a big surprise, and yet the day after the election, the S&P 500 was up 1.1%. So certainly a move, but not some dramatic move the day after a big surprise outcome in the election. So it's very difficult to say which direction things will move as a result of the election and what magnitude they will move.
Hey, Kevin, want to ask you about the Fed because it's kind of taken a back seat in the news cycle this week. But in a couple of weeks, they're going to be meeting at Jackson Hole and maybe discussing their new communication strategy, which would probably be officially rolled out in the September meeting. And a lot of that has to do with maybe yield curve control, forward guidance. How does this affect your macro outlook right now?
Sure. So I think there's still a lot to be determined there. So I'll start with what we know. I think in terms of Fed policy moving forward, I think the Fed will continue to keep rates extremely low for the foreseeable future. And I think the really good tell on that statement was a statement from Chairman Powell, not this most previous press conference, but the one before that, where he said we're not even thinking about raising rates. So that kind of gives you a sense for where their head is at. Now, with respect to yield curve control, that has been talked about for a while now. Still unsure if the Fed will actually undergo something like that, where they try to control yields further out on the curve. But in terms of how we're talking to clients about the current yield environment, it certainly is challenging. So as you think about your typical retiree who has a 60% stock and 40% bond portfolio, that 40% that's in bonds is now at extremely low yields. So, looking at where the 10-year Treasury is and has been sort of in the 50 to 70 basis points range, which is extremely low relative to history. Historically, the 10-year has yielded usually right around 4 to 5%, somewhere in that ballpark. So as you're thinking about planning for retirement, what that implies to us is that you need to be more muted in terms of how much you can spend in retirement. Is really the only surefire way to account for the lower rates and lower expected returns on your fixed income portfolio. Or you can look at ways of increasing the forward-looking expected return of your portfolio, either by increasing your equity allocation or by thinking about incorporating a modest allocation to alternative investments.
Kevin, value stocks are getting a second look by investors. They're largely outperforming growth stocks lately. Do you see this as a sustainable trend?
So at Buckingham, we've long incorporated a tilt towards value within our portfolios. And the reason we've done that historically is that there's very, very strong academic evidence in support of such a strategy. So what we mean by value are just stocks with low prices. So low price to earnings ratio, low price to book ratio companies have historically outperformed the higher price to earnings ratio and higher price to book ratio companies. So in the US, going back to the 20s, value stocks have outperformed growth by about 4.5% to 5% on average. Again, going back to the 1920s, it's been found not just in the US, but in pretty much every developed market that they've looked at. So within our portfolios, we'll incorporate tilts to value stocks within our equity portfolios. And it certainly has been a very rough 3 years for value, 3.5 years for value investors. But what gives us comfort, and we've looked for lots of reasons why value might not work in the future, and none of them have really seemed all that convincing, mainly because we've seen periods like this before in the historical data. Namely, the late 1990s was another period where we went through a long stretch with value underperforming, and eventually value turned around and did really well over the subsequent 10 years. So we're not really in the business of making short-term forecasts, but over the medium term and long term, we certainly think that incorporating a tilt towards value stocks within your portfolio will increase the expected return of that portfolio.
Kevin Grogan of Buckingham Strategic Wealth. Thanks for being with us today.
My pleasure.
Coming up next, we have got the CEO of the company behind Arby's, Buffalo Wild Wings, and Sonic. We're going to talk about reimagining the restaurant during the pandemic. That's up next. As more of us take our food to go and eat outdoors amid this pandemic, restaurants are rethinking how they do business. Joining us now is Paul Brown, CEO of Inspire Brands. That's the company behind names you know: Arby's, Buffalo Wild Wings, Jimmy John's, Rusty Tacos, and Sonic. Paul, that's a lot of brands. Good to have you here this morning.
It's great to be here.
Specifics, including a redesign for Sonic, which is very exciting. I want to talk about business right now for your restaurant brands. Is there one brand that's sort of shining through or outperforming the rest during this pandemic?
Really, our two QSR brands, Arby's and Sonic, are the ones that are outperforming. Sonic is running over 30% positive year over year for the quarter, and Arby's is running in the mid-teens positive year over year for the quarter. So they're really the ones that are shining the most right now.
Paul, you have two Sonics now in this redesign. Take us through what you were hoping to achieve in that design. And is that a design that you can apply to some other brands in the portfolio, like an Arby's or even a Buffalo Wild Wings?
Yeah, what's happened at Sonic is the result of the same process that we do with all of our brands when we bring them into the portfolio, starting with Arby's and then Buffalo Wild Wings, is first getting clear around what is the positioning and promise of the brand, and then making sure that carries through to all elements of it, whether it be the marketing or the physical plant or even the menu. And so this year earlier, we launched the new marketing campaign for Sonic, which has been phenomenal and actually quite convenient that we launched that campaign before COVID. And then obviously the new building design, which has been incredibly well received. The one in Tahlequah has been open for a couple of months. It was a scrape and rebuild, so just a new building on the same site. And it's running positive 80% year over year, and customers are loving that design.
Paul, your Buffalo Wild Wings locations are sort of known as a gathering spot to watch sports. And we know that fans are not in the stands, but it's hard for people to gather in places now. What have you done? How have you pivoted business within Buffalo Wild Wings?
Well, the first is real movement to digital takeout and delivery. At the very beginning of this in April, we obviously had to shut down all the dining rooms and move entirely to takeout and delivery. And as an example, our digital sales and takeout delivery went from an annualized $800,000 a restaurant to an annualized $2.2 million a restaurant in the period of about 3 weeks as we move to entirely takeout and delivery. That's now settled down at around an annualized 1.4 million. So again, continuing that as we've opened the dining rooms. What we're really doing in opening dining rooms, obviously.
Oh, go ahead, Paul. Go ahead.
As we open the dining rooms, just being very careful about how we do it and making sure that we're bringing guests back safely. But we're seeing them return, looking forward to being able to have draft beer again, which is hard to do in the house, and coming for other reasons than just sports.
You mentioned, Paul, I want to get back to what you just said about Sonic. Sales up 30%. That's on par with what we just heard from Papa John's a week ago. You guys are now, I guess, suddenly two of the hottest brands in the QSR space. How do you explain those type of sales gains amidst a recession?
Well, the two things. First, it's a car-centric model. So only 2% of Sonics have dining rooms. And so the ability to serve the customer through the drive-through and through the drive-in is obviously right in line with what's happening today. And we were able to do it by adding some capacity through speeds of the drive-through. And so that's worked really well for us. But also our digital sales. We've gone from 4% of our sales at Sonic to be order ahead through our digital platform to over 10%. And so that's also helped us as well. It's just a great concept. It's a nice oasis in people's daily routine. And it also just has a great product offering that just people want to have snacking and at lunch.
We've talked a bit in the past about the Inspire Brands model. I've watched you build this portfolio of brands from the ground floor. In this type of environment, are you inclined to keep the acquisition pace going? Look, this morning we saw Fat Brands come out, get a pretty good deal on Johnny Rockets for $25 million. Are you still interested in building out this portfolio, let's say 8 or 10 total brands?
Well, really, the thesis we have around the value of having a broad brand portfolio and achieving scale through acquisition really has played out very much over the past several months. Just the value of the portfolio and the value of our scale. You know, what that turns into as far as additional acquisitions, I really can't speculate this time, but the thesis has certainly been validated over the past several months.
Before we let you go, Paul, I'm pretty excited about this League of Legends Championship esports league. You're partnering with them for what, just Buffalo Wild Wings?
Yes, just for Buffalo Wild Wings. We want to be the official place for esports. It's obviously the fastest growing sports spectatorship, and we feel like we're a great opportunity to be a good partner with them. We're super excited about that partnership.
Get me one of those Arby's fish sandwiches, Paul.
You better come soon. They're running out fast.
Limited time only, as they say. Paul Brown, CEO of Inspire Brands. Thanks for being with us. Good luck to you.
Thank you very much.
All right, coming up next, Lyft out with earnings. We're going to break it down right after this. Lyft posted better than expected earnings after the market closed yesterday. It's the first full quarter since the coronavirus pandemic began. Here to discuss is Wedbush Securities research analyst Yigal Arounian. Yigal, our revenue down a staggering 61%, but now it looks like bookings are slowly picking up, yet I'm seeing the stock and Lyft is off about 4%. So what gives?
Hey, yeah, I think we're just not rebounding as fast as people were hoping. Certainly back in May, Lyft gave a business update. This was before the pandemic kind of started to reaccelerate, and looked like things were headed in the right direction. We took a meaningful step back in July. July's still down about 55%, and the company noted that in August so far, it's still early, but the trends are pretty similar to July. So, the demand for rideshare just isn't coming back fast enough.
Lyft followed Uber's playbook and warned that they might have to pull out of California. Lyft actually provided a date, August 21st, that they might have to pull out or suspend operations in California because of the worker classification ongoing issue. That's 16% of Lyft's total rides. What would be the financial impact of Lyft no longer operating in California?
Yeah, so that's going to be, that's going to move to the forefront now for the next couple of months. Financial impact wise, I think, top line revenue wise, you could think of it similar to that, right? 15 to 20% range. We've heard from Uber and Lyft that California is a little bit more of a competitive market, so the profitability isn't as high there. But I think you could think of it 15 to 20% range. There's a lot of questions around this. How long they exit California for? I think of it more of a pause, waiting for the vote in Proposition 22 in November. I wouldn't expect them to leave California forever. They'd probably come back, readjust how they do business in California, probably raise prices there to offset some of the increase in costs.
Yigal, who's better positioned here, Uber or Lyft, to sort of ride out the pandemic? Of course, you've got Uber more diversified. They do have Uber Eats, which is doing gangbusters right now.
Yeah. Look, I think that question is harder to answer now than ever. Certainly, revenue-wise and bookings-wise, Uber Eats has really offset the challenge in rideshare for Uber. Right? Uber traditionally 70% of its revenue comes from rideshare, 30% from food delivery, and that actually reversed in 2Q, where food delivery accounted for 70% of the top line. That's a huge shift. It definitely offset and helped the impact from people not moving around in rideshare. But food delivery is also super competitive. It's even more competitive than rideshare. Uber's losing a lot of money in that business as well. So certainly helps blunt some of that demand impact, but they're losing a lot of money there, and it's still not really proven whether they'll be that industry can be profitable in the long run. We think it can be, but there's a lot of work to do there.
Yigal, I'd love to get your quick thoughts on Lyft now dabbling in the car rental business. Do you take them seriously in that business? Do you think they'll expand it aggressively?
Sure. It's an interesting time for them to get into the car rental business deeper, right? In the middle of a pandemic when demand's down, and there's a lot of challenges around that. But when you think about what Lyft's doing, building car rentals into its platform really does make a lot of sense, right? They're trying to make mobility easier for everybody. That includes bikes and scooters. Includes getting a ride share, and now they're building rentals into that, where they make the process really seamless. You could rent the car directly from your app. You're not doing the traditional model of renting a car. I think it is very complementary to their offering, and it could make a lot of sense in the long term.
All right, Yigal Arounian over at Wedbush Securities Research for us this morning. Thanks so much.
Thanks for having me.
All right, Jared Blickery, taking a look at the markets. Still a mixed situation, but those tech stocks, once again, the big winners.
Yes, they are. The FANG stocks are up again today as they were yesterday. So value and cyclical is depressed. And you look at Apple, it's up 1%, as is Microsoft, Google almost there, and Facebook up 1.4% right now. Looking at the biggest winners, we see Zoom, that classic COVID security play here. It's up 3%. Autodesk up nearly 3% with Workday. So software names doing fairly well. But now we're seeing travel come back. So let's take a look at that heat map where we're seeing Marriott turn in the green and Royal Caribbean up 3% here. And then looking at some of the semiconductor names, those are green as well. Well, now they've turned, a lot of them has turned red. It looks like Micron is down 3%. We went over Applied Materials preview. They are announcing earnings after the bell, but they are down 1% right now. And then looking at the banks, they are largely underwater here with a couple of standouts. JP Morgan up about 0.2%. And here's our sector look. Communication services, real estate, consumer discretionary, and tech. Those are all outperforming. And 3 out of those 4 are the FANG sectors. To the downside, we have healthcare, energy, utilities, and materials. And just taking a look at our industrials, those had been popping, and we see kind of a mixed board here. Boeing, notably, is up over 1%, as is 3M. And just looking at the energy market, you can see that is mostly underwater here. Royal Dutch Shell down about 1%. Finally, let's take a look at a merger event here. We have Fat Brands acquiring Johnny Rockets for $25 million. Seems kind of cheap to me. Now, the stock is up 129%, had been up 150%, and they bought this from private equity group Sun Capital Partner. Again, the purchase price, $25 million, and they're going to fund that through cash on hand and proceeds generated by the company's securitization facility, Alexis.
I thought the same thing, Jared. 25 million for Johnny Rockets, kind of cheap. They have been struggling though, so this may have been a way for them to continue to survive. Jared Blickery, thanks so much. This just out, AMC, the theaters, plans August 20th to celebrate 100 years in business with 1920 admission prices. Tickets are going to be 15 cents. Oh, wow. Stock up 7%. We'll be back right after this.
All right, welcome back to the first trade. Some mixed market action this Thursday morning as the S&P 500 flirts with a record, but I want to call attention to Cisco's earnings call last night. Demand was down basically everywhere. The tech giant unveiled a new $1 billion cost-cutting effort. To me, that doesn't sound like a global economy warranting of a record high for the S&P 500. But let's get over to Inez for a closer look at those Cisco earnings. Inez, not a good quarter for Cisco.
Not a good quarter, Brian. Cisco right now down more than 10%, with the company posting its first annual revenue decline in 3 years. Revenue for the quarter declined 9% year over year. Its guidance for its first quarter revenue came in below what the street was expecting. Cisco said it saw a slowdown in spending from customers. Now, in the past, Cisco has focused on more expensive hardware, and customers are shifting more towards a multi-cloud architecture. As you spoke about, the company announced a cost-cutting plan of $1 billion to take place over the next few quarters. It's planning to offer early retirement to some employees, and also the company announcing that its CFO, Kelly Kramer, is retiring. This announcement came during the earnings call. Kramer has been CFO since 2015, and she will stay on until a successor is found. But certainly, year to date, if you just take a look at this stock, it's down more than 10% today, 10% down. Looking at Lyft is down more than 4% after reporting its quarterly results with a loss per share of 86 cents. Now that's smaller than what the street had been expecting. Revenue declined 61% year over year, of course, as people stayed at home and took less rides. But ridership in July was up 78% compared to April, which April was really the height of the lockdowns in the US. So taking a look at the stock, year to date, it's down 32%. And then just looking at Tapestry, that stock is down more than 1%. The owner of Coach and Kate Spade posted a narrower than expected loss per share of 25 cents. Its revenue came in above what the street had been expecting. E-commerce sales helped the impact of closed stores, those stores which were temporarily closed during COVID-19. It also talked about a revitalization plan in place to take place over the next few quarters. This will include some store closures and a lot of focus, of course, on digital as well. So Tapestry not only has faced the challenges of COVID-19, but just last month, its chairman and CEO resigned over a probe over his personal conduct. So quite a lot happening with the company there, but today just down more than 1%. And then just taking a look at the overall markets, we've got the Dow that's slightly in the red. We've got the S&P that's flat, struggling to get to that all-time high. And then we've got the Nasdaq that's in the green, Brian.
All right, let's bring in Ari Wald, senior analyst at Oppenheimer. Ari, always good to talk with you. Any other time, any other normal time, when you have a Cisco come out here and report the quarter they did, telling you they're going to cut $1 billion in costs, you would think the market would be down. Why isn't the market down?
Well, I guess for the easy answer would be that there's a lot more companies in the S&P 500 than Cisco alone. Of course, you're going to get these one-offs. But for every Cisco, you have a semiconductor stock that's breaking out to the upside, and it does kind of represent this kind of internals that are a bit still mixed here, that have a little bit more work to do on the upside. But I think with the market, S&P 500 pushing at that February high, our view is that it's only a matter of time till we break out to the upside.
Alexa, I think you're muted. Ari, you mentioned that the market could break out to an all-time high. What would be the trigger point just to have things cool off a bit?
Well, I think as it stands, it's difficult to make the case that conditions are tactical here. So you have the S&P 500 overbought, really hasn't paused in a number of weeks, into resistance at that February peak, and up against seasonal headwinds as well. August, September, typically a poor performing time of the year. So this is the point, I guess, of the calendar year where we think it's reasonable for the market to cool off. But again, it's the take that it's going to be a pause ahead of the breakout. As we talk about this, what has been this concentrated market performance that we've seen, and it's been this lingering concern. We think internals are consistent with where they should be just 5 months after a major market bottom like we had in March 2020. So we think internals are basing, not topping. I think one by one, some of these recovery areas are going to start to break to the upside, and you're going to see the market overall continue to move higher through the balance of the year.
Ari, what's the thing that's going to help us do that? Because right now we have lawmakers, at a stalemate over this stimulus deal. We do have this rotation we're seeing out of growth and into more value at the moment. Is that what's going to take us over the top and get that S&P 500 to a new record high?
We definitely need more cyclical participation in this market. I think a lot of this rotation, it's been our view, it's been more about beta and less about value. I think the overall value index, in our view, still has too much defensive exposure and not enough technology. Historically, technology has been the most early cycle sector, looking at all the major market lows since 1932. So I think technology continues to do well in that environment. It's probably more the defensive high dividend bond proxies that are going to get left behind. So our view is that you're going to continue to see these swings between cyclicals and safety around what is still a long-term underlying bid for high growth companies in this low rate and low commodity world. If you really look at the sector dispersion that we're seeing. So kind of one point that we're making is that market conditions overall far from a bubble, but we are seeing a bubble emerging in sector dispersion. If measured by the spread between the best and worst performing S&P sector, you're seeing that gap widen to the point we haven't seen really since the TMT bubble. Right now, as it stands over a 2-year period, tech's up about 50%, energy's down about 50%. But if you were to kind of dig into those sectors, it's not tech. It's not tech strength. The rate of change of the tech sector really consistent with history. It's far from extreme, nowhere close to where what we've seen in the late 90s. The extreme that we're seeing is happening in the weakness in value. That this bubble and dispersion is being inflated by weakness in value, and that really represents this difficult 2-year period we've been in the equity market, really since 2018, when most global equities peaked, small caps peaked, value peaked. It's been a tough 2-year period. We think the contrarian case is for long-term upside in the market if those beaten up value areas start to participate and act better. We think it's just a matter of time, but indeed more is needed for those groups.
Ari, what are your friends on Wall Street saying about Joe Biden's pick of Kamala Harris?
I'll be honest with you. I'm far from a political analyst, and I'll just go off of what the action of the market has been, and there really hasn't been much of a response. So I think it's too early to really to make that. There's still a lot of time ahead of the election. Typically, markets do act well ahead of an election, especially when an incumbent is up for re-election as a candidate. If the market does tend to drift lower in the 90-day period into the election, typically suggests that Wall Street is expecting the opposing opposition party to win. If it trades higher, typically the incumbent has better odds. And then that type of action carries forward into the post-election year as well. When the incumbent wins again, you'll typically see less disruption in the equity market. But when the opposition wins, then you'll tend to see a little bit more volatility and jerky action.
Hey, Ari, I know that you are big on small caps right now. Make the case for them and any companies in particular that we should be looking at.
Yeah, for small caps, this is one of those recovery areas that we'd like to see start to act better. They've been in decline since 2018. They've been negative since the start of 2018. And again, represents the difficulty for the average stock, especially these smaller cap stocks. So the Russell 2000 has worked its way above its 200-day average. That's an incremental positive. That does suggest that participation is starting to broaden underneath the surface, and why it kind of confirms our positive view on overall market action. Of course, we're momentum investors, which is, we're looking for relative strength and leadership. And the leadership in the Russell 2000 right now is in technology and healthcare, more or less the same sectors that it's where it is in large caps as well. So we like small cap healthcare. We like small cap tech. I think the broad-based strength of those sectors is underappreciated, where you're seeing it really across capitalizations, across industries. And I think those two sectors within healthcare continue to outperform.
All right, no pressure here. In 15 seconds, give us a good trade that might work well into the end of the month.
I think you want to bridge the gap between beta and growth. I think if we get that swing towards cyclicals, You want to own some of that, some beta names, and semiconductors really fits that bill. Semiconductor stocks breaking out across the board, whether it's NVIDIA, Monolithic Power, Marvell Technology. Two more recent breakouts, Qorvo and Semtech Corp, both rated outperform at Oppenheimer by our fundamental research, breaking out technically, good industry. Those are names you want to own, Brian.
See, I knew you can handle that pressure. That's why I always ask you these questions. Ari Wald, senior analyst at Oppenheimer. Good to see you.
Take care. Thank you.
All right, do stick around. Much more ahead on the first trade. All right, welcome back to the first trade. Let's get back to Inez Ferre for a look at one of the top trending tickers on Yahoo Finance. That is online used vehicle platform Vroom. The company posted its second quarter earnings last night and they missed Wall Street estimates. Inez, what happened? I thought people were buying used cars.
Well, they are buying used cars. They did have an issue with their inventory for the last quarter, but let's go over some of the numbers. Vroom's adjusted loss per share came in at 34 cents. Its e-commerce revenue increased 45.2%. Its total revenue came in at 253 million. And e-commerce unit sales increased 74% year over year. Also, the company touted its average monthly unique users, which increased. But its revenue guidance for the third quarter, the current quarter, is expected to come in anywhere between $268 and $290 million. That's below what the street had been expected. Let's get to the issue of inventory. This is what CEO Paul Hennessy said. He said, early in the pandemic, we chose to de-risk the business by significantly reducing our inventory during the first half of the quarter. As demand increased and price became more stable through the second half of the quarter, we pivoted to start rebuilding inventory. These lower inventory levels prevented us from fulfilling all of the demand that materialized in the second half of the quarter. And I went through the earnings call as well, and basically he went on to explain there that from a sales perspective, the company saw a V-shaped recovery. It had a record month for unit sales in April. Then inventories were low in May, and unit sales that month were roughly half. And then they rebounded off of those lows, those May lows. And they've seen a strong sequential increase in unit sales in June and July. Also, the company noted a shift with consumers, saying that they've seen a downward shift in the price points that customers are looking for. And this, Brian, really kind of jives also with what the CEO of Shift.com had said, who was on your program not that long ago, who was also saying that what they've been seeing is basically consumers looking for a little bit of a lower price point.
All right, thanks so much, Inez.
Thank you.
The national debate continues over whether or not schools should open in the fall, but New Jersey is already making a pretty bold move. In a major reversal, New Jersey Governor Phil Murphy says the state's public schools can go all remote, but only if they can prove they can't open with in-person safely. And that could cause all sorts of challenges for parents. Let's talk about this now with Yahoo Finance's Reggie Wade. Reggie, so good to see you. It's been a while since we've had you on the show, my friend.
It's great to see you, Alexis.
Let's break down, and there are many of them, but let's break down some of the challenges parents face if kids have to go all remote this fall.
Yes, and there are many. Bankrate yesterday came out with a new survey that showed that more than 3 in 5 parents, or 61%, say that remote learning would negatively impact their finances. And 42% believe that COVID-related remote learning would be detrimental to their children's education. One of the extra spending that parents think that they will face would be for meals, technology, and also tutoring to supplement the children not being in the classroom.
Reggie, did they break this up by country?
No, this was only in the US. They actually broke it down by region, and that's where I think you find some of the more fascinating elements of this. Northeastern parents are the most likely to say they'll be negatively impacted by online learning at 61% versus 61% in the West and 59% in the Midwest and the South.
What about childcare? Just because you're home working from home and your kids are doing schoolwork from home, you still might actually need help because you can't be with the kids all the time, especially if you have really little ones. You have to deal with your job.
Exactly. And we all know that the child care costs are rising. And I spoke to the lead analyst on this, and he compared it to having a second mortgage for some people, especially people that live in expensive cities like New York, Philadelphia, Boston. So parents are really struggling right now. And if social distance learning continues into the fall and into the rest of the school year, they really don't know what they're going to do financially.
Reggie, you have extensive experience in the education space. Can learning from home be pulled off successfully, or you have to be back in the class?
You know what? It depends. I think distance learning works well for older kids that are in high school and college, because at that point, it's the content that matters. But for the little ones, especially in elementary school, school is as much social as it is educational. You're learning to be with your peers, and you're learning how to conduct yourselves in public. So when the kids go off into the workforce, they know how to handle themselves in a situation where mommy and daddy's not around. So that's really at the core of it. And if these kids are missing that, it can really impact their social lives and their social upbringing.
All right, we'll leave it there. Reggie Wade, always good to talk to you.
Thank you, Brian. Thank you, Alexis.
All right, a quick programming note. Former Treasury Secretary Lawrence Summers will be on Yahoo Finance today. You can check him out at 11:30 a.m. Eastern Standard Time, where he'll join the cast of On the Move. Do stick around. Much more ahead on the markets on The First Trade. All right, welcome back to the first trade. Bitcoin's recent surge has brought on a lot of new predictions about the future of cryptocurrencies. Here to break it down is the CEO of Pantera Capital, Dan Moorhead, and Yahoo Finance editor-at-large, Dan Roberts. Dan Moorhead, I will start with you. Really enjoy looking at your background. That's pretty cool. That's a Bitcoin white paper you told us off camera. Where do you think the next move is, or what do you think the next move in Bitcoin is?
Yeah, we believe that all of the fundamentals are lining up right now. So the price is still 40% below its peak. There's trillions of dollars of paper money being printed, which is pushing up the price of all assets that aren't quantitatively easable. And then actually, the blockchain applications are really starting to take off and work, like decentralized finance. So historically, Bitcoin has tripled every year since 9 years ago on average. We think this year could be much stronger than that.
Is that because people are running to Bitcoin as a hedge in much the same way they would be running to gold, Dan?
It is. Gold's at a record high. So as you print more and more pieces of paper money, it incentivizes people to buy things you can't quantitatively ease. So gold's going to go up, Bitcoin's going to go up. It is a hedge to paper currency being debased.
Dan Roberts here. I know you guys say that you've seen a lot of new institutional interest in investing in Bitcoin. We've heard the same from Grayscale and other firms. But what about from retail investors, just so-called regular people, especially because when we've talked about the market in the last few months, the sort of Robinhood effect has been so big for a lot of key stocks. That is kind of stock market newbies getting in. What about attracting those people to investing in crypto?
It's true. Crypto has these wild price swings. And as the price starts surging, we see interest go way up. And so the prices are up, as you said, about 60% for Bitcoin. Some altcoins or other types of blockchains are up 100 or 200% this year. And that brings massive new interest in.
And I know that you guys had or have still an ICO fund. And what's been interesting, we covered closely the kind of ICO boom and bust. And as I understood it, the SEC and other agencies made pretty clear that they think most of these token offerings are securities offerings. And yet now it seems like we're starting to see a new wave of tokens being created and offered, maybe using different terms. But where is that all headed? And are ICOs really okay and smart investments still?
Yeah, there's kind of a perception that ICOs were invented in 2017. They kind of did their thing and went away. In fact, ICOs were invented in 2013. They just used to be rare. And that's basically where we're back to. ICOs still happen, but they're rare. We have a fund that invests in pre-auction ICOs. And, instead of seeing 50 white papers a week like we were doing at the peak in 2017, we invest in, one every quarter or two. So it's the market's still there. It's just much more, selective.
Dan, you put out a tweet that caught my attention. You noted stay long Bitcoin until schools reopen. Does that suggest the move higher in Bitcoin only has about 2 to 3 weeks left in it?
Oh, as Reggie said, the school opening thing is a really tricky thing for our economy. The Bureau of Labor Statistics says 40% of American families have kids under 18 at home. It's very difficult for those people to go back to work fully if they're in the largest homeschooling army the world's ever seen. So we think that fiscal stimulus will keep coming at least until most kids are back into in-person schools or daycare, and that seems to be a long way away. And the stat that really blows my mind is in June, the United States printed more debt than we did in the first 2 centuries of our existence.
And that's all bullish for Bitcoin.
It is, there's so many uncertainties in this pandemic but one thing that seems almost assured is when you print trillions of dollars more pieces of paper money, it's going to drive up Bitcoin and other cryptocurrencies.
Are you seeing any kind of a demographic shift yet in who's interested in buying Bitcoin? Because I think, it continues to be millennials a hedge with Bitcoin. Older generations like to hedge with gold. Do you see that changing anytime soon?
It is changing. And yes, the original wave was all younger people being excited about it. But you see, like Paul Jones put 2% of Tudor management into Bitcoin. And he's, obviously a famous investor that's been in the business for a long time. And he said it reminded him of gold in the 70s. And I think that's a great way to say it. In the 70s, we had a ton of inflation. They were printing tons of paper money. And gold went up a ton. It's going to be similar here with Bitcoin.
Dan, what do you make of the prospects lately for Ethereum, which there was so much hype around how the Ethereum blockchain was going to be better for applications and a bigger deal than Bitcoin? maybe that hasn't panned out so much. It seems like fair to call you a Bitcoin maximalist.
No, I'm not a maximalist. There's a lot of people in this business that are almost religious about it. There's one true and only one heaven that for some people. We're investors. We're trying to make money. So there was a point where long 100% Bitcoin. There's been points we've had much more Ethereum than Bitcoin. So there are different use cases. And we do believe that over the next year, the non-Bitcoin cryptocurrencies will outperform Bitcoin. And it's happening so far this year. Bitcoin's up about 60% and our digital asset fund's up 130%. So there are different things to invest in. Bitcoin's the biggest. It's about 60% of the market. But the other 40% have a lot of interesting things. And, it's like in the early 90s on the internet being a maximalist about one company. There were 30 really interesting projects. So you should have the same mentality with crypto.
All right, we'll leave it there. Let's thank the double Dans, Dan Moorhead, CEO of Pantera Capital, and our very own editor-at-large, Dan Roberts. Thanks so much.
Thank you.
Taking a look at Smile Direct Club stock this morning, Brian, and it's coming under some pressure. I know they had a mixed quarter there. Stock had been doing really quite nicely since April, but this is that clear aligner company, right? The orthodontia company. It racked up a $95 million net loss in the second quarter. Sales plunged 49%. And Brian, I know that you spoke with the CFO recently. What did he have to say about business conditions?
Yeah, Alexis, I want to get to why the stock is under pressure here. Their profit margins, the gross profit margins down 1,500 basis points quarter over quarter. That's not going to cut it on Wall Street for a stock that has been under pressure, severe pressure coming into this report. Also, on the conference call, they guided to lower average selling prices for the balance of the year for their clear aligners. Wall Street did not like to hear that too. And lastly, there's concern about momentum coming out of July. They have started to see a little bit of a recovery in the aligner business in July. It's unclear if that momentum continued into August. But to your point, I did catch up with Smile Direct Club CFO Kyle Wales. Did tell me the company is still on target to reach adjusted operating profits by the fourth quarter of this year. This is the target they put out earlier in the year. They say they will still be able to hit that in large part because they cut a lot of costs.
Any word on, I know they had to put a bunch of money aside for legal issues. They were being sued, a few class action lawsuits. I know that they had been the subject of a big CBS 60 Minutes expose on their products. Any movement there on those lawsuits?
Nothing doing. No update on there in my interview or on the conference call last night. I think these lawsuits and these issues will just be something that continues to hang over the company. But on the positive side, they did say they're now going to expand into dentist's office. So I think you're looking at the day where you may go to the dentist and be surrounded by a lot of Smile Direct marketing and products. So definitely a slight shift in business model for them.
Yeah, I think that could actually really help legitimize them, right? Interesting move there. And as you say, it's still on track for that profitable fourth quarter. All right, Brian, thanks for that. Coming up next, we're going to take a look at Facebook and Twitter and how they say they're getting a handle on possible misinformation as we move closer to the November presidential election. That's up next.
All right, welcome back to the first trade. Let's get back to Inez Ferre for another look at the markets. Inez, I'm in search of some positive news, and I think I may have found it in this 3M sales update. Good to see sales starting to come back for a company like 3M.
That's right, Brian, with 3M saying that its sales were up 6% year over year in the month of July. You'll recall that GM started giving out these sales updates, these monthly sales updates during COVID-19. Let's break it down by segment. Total sales increased 29% in its healthcare segment, 9% in its consumer segment, 6% in safety and industrial, and transportation and electronics, that declined 7%. And then by region, sales increased the most in the Americas, followed by Europe and the Middle East. And then Asia sales were flat. Right now, we're looking at 3M that's up more than 1%. Year to date, the stock is down about 6%. Then taking a look at another Dow component, Disney. Disney down about 0.2%. Some news regarding Disney and Florida, a dispute between the union representing actors and Disney over COVID-19 testing. That has been resolved with actors in Florida who wanted regular testing for those that did performances that couldn't be wearing masks. So Disney said it will provide space outside of Disney for a testing site for cast members, as they're called, and also for the public. And then just taking a look at Micron. Micron was downgraded by Deutsche Bank to hold from buy because of supply-demand mismatch. The price target was maintained at $48 a share. Micron has been, of course, benefiting from strong memory chip demand from data centers because of all this remote learning and remote working. But the analyst is saying that inventory buildup at cloud data centers looks worse than anticipated, and demand from other end markets is weakening. And that's why Deutsche Bank downgraded the stock to a hold from buy. Year to date, you're looking at Micron that's down about 14%. Today, down 4%, Brian.
All right, Facebook is taking new steps to stop the spread of misinformation online. Starting today, posts about the election may come with new labels. The labels will tell users to visit Facebook's Voting Information Center for official updates on the election. Our senior columnist, Rick Newman, joins us now. Rick, will this really make a difference?
I guess it'll probably absolve Facebook a little bit of any responsibility for outright meddling, such as they had to deal with back in 2016. I mean, we know now that there were all kinds of Russian propaganda efforts on Facebook that Facebook did not detect, and they even denied that was happening months after the election. So we now know what the game is. I think what Facebook is trying to do is, number one, actually help voters a little bit, but more than that, just show that they're on the problem. And even so, they're not saying they're going to be 100% effective at ferreting out bogus information about the election. They're just saying they're going to make a better effort to direct their users to legitimate information. I went looking this morning for this voter information center. It doesn't seem to be up yet, so I can't tell you what it's actually going to look like. But it's better than what they did in 2016, at least, which is nothing.
I want to ask you something off the beaten track there for a minute, Rick. In an interview this morning, President Trump essentially said he is holding up the stimulus deal over money for the post office and mail-in voting. Hard to believe he actually said that out loud, but what do you make of that?
Whoops. He showed his hand. So what this is all about is the Democratic bill. This is a small amount of money relative to the overall bill. So the Democratic bill includes $3.5 billion to help secure universal mail-in voting, and then an extra $25 billion just to help the Postal Service with general operations. And Trump said he opposes both of those funding streams because it would basically allow the post office to function. He said, he basically said we don't want the Postal Service to be able to handle universal mail-in voting for everybody who wants to vote that way this fall. So, we're talking about a stimulus bill here that's going to end up between $1 trillion and $3 trillion. And Trump is talking about these relatively small figures for the Postal Service. So honestly, what I think Trump is doing is he's kind of making a martyr out of the Postal Service. I mean, now he has shown his hand. Now I think there's no way the Democrats will give in now. They're just going to say, oh, now we know what Trump's really up to. Nancy Pelosi is going to say, we are standing up for the Postal Service. It's kind of like standing up for apple pie because you're standing up for the right to people to get their prescriptions and to get, letters from their relatives and things like that. So I think Trump kind of stepped in it this morning.
Rick, both parties are ruining the economy in real time. You have millions of people unemployed, and these two parties can't come together and get this deal done. What ultimately causes a deal to get done?
Brian, I mean, now that Trump has given us a little bit more of a glimpse into the inner workings of the negotiations, the Democrats are holding firm, and I think they're just going to be emboldened by Trump basically saying this is all political about the Postal Service. And Trump, meanwhile, seems to be taking the line that, well, Congress can't get it done, so he's doing a few executive orders, even though the executive orders probably won't be very effective. So, about 3 weeks ago, I thought we'd have a deal by now. And now the counting from inside Washington is do not expect a deal any earlier than about mid-September. And I think the odds have just gone up that we get no deal.
No deal.
I think so, because now that you know where each party stands on this vital issue of funding for the Postal Service, it puts both parties even more in the position of somebody has to cave. Usually one side or the other caves, or they both cave a little bit, but there's some face saving that allows everybody to declare victory. I think given that Trump has now basically outed himself and shown his hand on funding for the Postal Service, he can't cave, and now the Democrats can't cave. If they give an inch on postal funding, it's going to look like they're caving to Trump. So I think this now makes it harder to get a deal done.
These folks are out to lunch. We'll leave it there. Rick Newman, always good to speak with you.
Bye, guys.
All right, do stick around. On the other side of the break, Apple might be making some important changes. Stay tuned. Welcome back to the First Trade. Apple is looking to pull you even deeper into its ecosystem while taking a play out of Amazon's playbook. The company is preparing a bundle service called Apple One, according to Bloomberg. It would allow people to subscribe to a number of its digital services at a lower price for the month. Inez, tell us about this one.
So the goal is really for customers to subscribe to these services and for this to be reoccurring revenue. There are different types of tiers, so to speak, of what this service would be like reportedly. basic package. This would include Apple Music and Apple TV Plus as well. And then a more expensive package that would include Apple Music, Apple TV Plus, and also Apple Arcade Gaming. Then you'd have another tier on top of that that would also include Apple News Plus, and then another tier that would include extra cloud space. The goal is really to offer these group services together that if you were to purchase them individually, they would altogether cost more. So the bundle, of course, would be more cost effective for customers. But it's really trying to play on the Amazon type of bundle as well with Amazon Prime. This bundle kind of model has been very successful for Amazon, and other companies have tried to replicate this. Now, of course, Apple doesn't have this e-commerce delivery network and such, but it does have millions of customers that really are very faithful to their hardware, and that have also had some of these digital subscriptions as well. It also is focusing on a family package as well, so you can have up to 6 people that would have access to these services. And Brian, finally, I also want to mention something that they're reportedly working on as well, and that is a new subscription for virtual fitness classes through some of Apple's devices. This is huge because reportedly they are working with Peloton, they are working with Nike for some of these virtual classes. I've always said I'm not sure why Apple just doesn't buy Peloton, because it would be a great fit, a great match. In this case, the company is reportedly working on developing a program where you can take the virtual classes and access them through your devices, through your Apple devices.
All right, I want to break this down more with tech analyst Renee Ritchie. Renee, good to see you. You should certainly win my Epic Backdrop Background of the Day award. That is pretty impressive there, sir.
Thank you so much.
What are your thoughts on this Apple One news? Is it a financial needle mover for Apple?
Yeah, I think, they've gotten to the point with iPhone penetration in the market. It's a very mature market now that you want to extract greater value from every customer by providing greater value to every customer. And services are the best way to do that. But Apple has different services value. Apple Music is easy to understand. TV Plus, especially with what's going on with production stoppages now, is more difficult, and News Plus is far more regional. So sort of arraying those things together and making people buy a little bit more than they might have otherwise, even if it's for a little bit less, could move the needle for them on services.
Renee, what do you think about what Inez just said? She thought, it makes sense for Apple to go out and buy a Peloton. Do you see that as a match that would actually make sense? I mean, they certainly have the money to go ahead and do it.
I think, quite possibly. I'm not sure they'd want to actually get into the fitness equipment hardware market. They're very cautious about how far they extend themselves in terms of what physical products they make. But I think in terms of the software, the experience, they have people like Jay Blahnik on staff. They have a huge health system. The COO, the Chief Operating Officer, Jeff Williams, is in charge of all health for Apple. And this is something that they can provide easily with all the resources they have on top of what they're doing with Apple Watch and with tvOS and all of those things.
Renee, do you think the next 2 years can be pretty fascinating for Apple? You have the potential 5G super cycle on the iPhones. You have these potential bundle plans. As crazy as it may sound, do you think Apple's stock is undervalued at these levels?
I think traditionally Apple stock has pretty much always been undervalued. It's almost like the gambler's paradox, where the more products they ship and win with, the more the market suspects the next one will finally be the flop. And then if they win again, it's just, oh, well, it definitely has to be the flop next time. But we saw them reach their goal of doubling services revenue early. And it seems like that still has running room for them. And as we approach things like AR glasses, all of these services, if you don't have to have a physical computer with you, don't even have to reach for your phone, that's just an even greater market for all of those services. And I think there's a lot of value they can tap into.
Renee Ness here. Getting back to the cash that Apple has on hand, what could they buy? What do you see them buying in the future? Would it be perhaps a studio?
I think, Apple psychologically still remembers when they almost went bankrupt and when they were incredibly dependent on big houses like Adobe and Microsoft and had to go begging Bill Gates, for their basic survival. So I think it's almost like they've lived through a depression and they're going to sort of stockpile as much resources as they can and then do strategic buys like a Beats, or maybe like a company that lets them enter into or expand the services market. Studio is super interesting, especially because their biggest problem now is they have no catalog content. After you finish watching the Tom Hanks movie, what do you watch next? Netflix, Disney Plus all have that answer, and Apple doesn't.
Yeah, I mean, if you were to pick, it's hard to believe that this is a company that's almost a $2 trillion company. We're talking about the stock maybe being undervalued. But if there's a weak link that you could point to within Apple, would it be Apple TV? And is the subscription bundle a clever way to get revenue from that, get eyeballs on Apple TV, because you're bundling it with these other things that people really want?
Yeah, I think big picture, Siri is still something they have to invest a ton of money on because Amazon is doing that and Google's doing that. And this ambient computer model is what you're going to use in the future to tap in to all of these services and all of these devices. And that should be as important to them now as silicon was to them for the last 10 years. But then you're going to need exactly those services to fill. When people say, hey, show me a movie, you've got to have that movie to show them.
Renee, Apple stock splits 4-for-1 on August 31st. How do you think the stock will react?
I think initially it'll probably be just a little bit of a reflex hold on it, and people are going to wait to see what happens. But it's got such upside just in terms of what they're producing compared to a lot of other technology companies that I think it'll end up playing out similar to the last stock split, where over time it sort of goes back up to the point where people start talking about it again.
All right, I'll leave it there for right now. Tech analyst Renee Ritchie, good to speak with you. And certainly all eyes remain on that Apple stock split day on August 31st, right along with Tesla. We'll talk to you soon.
You too.
All right, do stick around. On the other side of this break, we will speak to Ron Coughlin. That is the CEO of Petco. I'm sure you've been there more than a few times over the past few months. All right, as many of us continue to stay at home during this pandemic, it's making room for new companions in our life. This year, the U.S. is seeing a surge in pet ownership, up 4% so far. Here to discuss that more is Petco CEO Ron Coughlin. Ron, good to see you this morning. So walk us through your business. We've seen a lot of the online players in the pet supply space doing pretty well. How has Petco done?
Yeah, we're doing fantastic, and it starts with safety. The number one priority for us is to make sure that our partners are staying safe. We've shipped thousands of gallons of sanitizers, football fields of masks, and we have 1/3 the COVID penetration in our team than national average. After that, it's about taking care of pets, and our business is up double digits right now. And it's a mix of what's happening in the stores, which are growing, and what's happening with our online assets.
I want to talk about what's happening online because, first of all, how many of your stores have been able to reopen? I'd imagine curbside pickup is a big deal, but how much has e-commerce, grown during this time, and what sort of resources are you putting at play there?
Yeah. So first, we've been open through the pandemic, and our folks were heroic. We were deemed essential. We are the pharmacy. We are the drugstore. We are the supermarket for pets. So we were open throughout. We had different formats. For example, in New York, we had what we call the deli counter format, where you basically came to the front and we shopped for you. And then in other areas, we flexed to different formats. At the same time, our e-commerce business is up over 100%. And you're right, Alexis, a lot of curbside pickup is happening. We launched curbside pickup in 2 weeks, and it's been a fantastic offer for us. But one of the things we saw is a lot of people talk about retail as a problem category. Our stores were an asset because we had inventory next to customers. So we have ship from store next to customers. We had product where they could do curbside pickup, where some of our online competitors really struggled through COVID to supply.
And I went on your site, Ron, and you're selling masks for pets for obvious reasons. But are you seeing pet parents concerned about their pets contracting COVID-19? Are you seeing a pickup in certain, I guess, medications?
Very little. I mean, yes, we are we're selling more grooming. Right now, you can't even get a grooming appointment. It's very difficult. It's out 4 or 6 weeks in many of our salons. But there's some anecdotes about pets getting COVID, a couple cases that seem to have been confirmed, but there are millions and millions, unfortunately, with humans and very little with pets. So we really don't see that as a major concern. And we have a board of veterinarians who guide us on these types of views, and they see a little issue there.
Ron, you're still Petco is still a private company as part of that February 2016 deal with CVC. But you have to have watched the market reception to Chewy's IPO. I mean, the stock has gone up in a straight line. Is an IPO in the works for you?
Yeah, I'm very happy working with CVC and CPP, the Canadian Pension Fund. At the same time, we're growing double digits. And when you're growing double digits, you get choices, but we don't comment beyond that.
Are there going to be any more raises? Do you need to, what's the cash situation like at your company right now?
We have zero cash. We pulled on a revolver early and we've paid that back. So we have zero cash issues. As I said, we're growing double digits. But one thing we are doing is, as the company has done better, we've invested back with our employees. So we're on I think our 4th round of COVID appreciation bonuses. We're around $20 million that we're giving back to our employees on top of their normal wages, because it is a tough environment to be working in. And as I tell them all the time, as the company does better, you're going to do better. So I'm very proud that we have made those type of investments. And we also put $2 million into an employee assistance fund. So you might be fine with Petco, but your spouse might have gotten laid off. And so we put $2 million in an assistance fund. Our board members contributed, our executives team contributed, and we've given out over 1,000 awards for Petco employees that are in need.
Hard not to ask this one. Ron, how many pets do you have?
I have one. His name's Yummy, a yellow lab, and he's the love of our family.
Well, that is definitely good to hear. You know, Ron, real quickly before we let you go, how many stores do you have open right now in terms of percentage? How many have you been able to reopen?
We've been reopened since minute one. So we are open in over 1,400 locations. And as I said, we were deemed essential. So our team has soldiered through a tough environment. But I'm really proud because less than a third of the COVID penetration amongst our population. And we deal with customers all day long. So we've done a nice job on safety.
All right, let's leave it there. Petco CEO Ron Coughlin, good to see you. Have a good rest of the week.
Thank you for having me.
All right, let's get back to Inez Ferre for another look at the markets. Inez, I can't stop watching shares of fat brands. The stock has gone up through the roof today.
Through the roof, 131% right now. That brand is buying Johnny Rockets restaurant chain for approximately $25 million. This purchase is expected to be completed by September of 2020. And with this acquisition, Johnny Rockets, Fat Brands will have more than 700 franchised company-owned restaurants in the world, franchised and company-owned. So you can take a look at, oh my goodness, year-to-date, the stock is up 78%. This action really happening today, up 130%. Then just taking a look at Netflix, that stock is up more than 1%. Netflix will stream the musical Diana based on the life of Princess Diana. It will be streaming prior to the Broadway reopening of this show. Now, Diana was supposed to open on Broadway in late March. It started getting early reviews in early March, but Broadway, of course, closed in March, so Diana wasn't really able to debut on Broadway. It will debut on May 25th of 2021. However, this musical will be filmed without an audience for its Netflix debut, which will happen before the Broadway debut. Very interesting because we're seeing the shift of Broadway shows going into streaming. And then finally, just want to add JCPenney's landlords. They may be close to a deal to buy the retailer. Simon Property Group, the mall owner, and Brookfield Property, the shopping center owner, are reportedly in advanced talks to buy JCPenney, which went into Chapter 11 during COVID-19, Brian.
All right, do stick around. On the Move is next. They will have on Larry Summers, who will explain why the economy will not recover without another round of stimulus. And of course, they will have all the market analysis you need to survive the trading day. Do stick around. Much more ahead on the Move.
Welcome to Yahoo Finance on the Move. It's 11 a.m. here in New York City. I'm Adam Shapiro along with Julie Hyman. We're 90 minutes into the trading session, and stocks right now a bit of a mixed picture. The Dow is off about 40 points. The Nasdaq is positive, almost 100 points. The S&P 500 is also positive, not by much, positive almost 3 points. U.S. unemployment claims, or initial claims for unemployment, fell below 1 million for the first time since March. What that means for the economy and the economic recovery straight ahead. Bad for business. Companies including Apple and Disney warned the White House that a ban on WeChat will hurt their bottom line. Stimulus stalemate. Larry Summers will explain why the economy will not recover if Congress does not act on stimulus. Again, I'm Adam Shapiro with Julie Hyman. We've got joining us this hour on the panel, Brian Chung and Julia LaRoche. Also, I want to let you know we're going to be speaking with the Chief Scientific Officer from Johnson & Johnson in the next 15 minutes about their vaccine trials. But we want to talk about this issue of companies pushing back against the White House's threats with WeChat and TikTok. And Akiko Fujita joins us with the latest on that.
Yeah, Adam, anybody who has visited China, done business out of China will tell you that you cannot communicate or operate as a business there without using the WeChat app. This is an app with 1.2 billion users and not only allow users to message, but pay their bills, do banking, get your groceries, even buy a car. And so it's the thread that is essential for any business that wants to tap into that lucrative consumer market. Now, US businesses are saying that any ban on its usage would have serious implications on their ability to be competitive in the market. And the Wall Street Journal reports that more than a dozen companies, including Apple, Ford, and Walmart, expressed those concerns about the ban on a call with the White House officials on Tuesday. Now, the official ban won't take effect until September 15th, but you're seeing intense lobbying behind the scenes, largely because that executive order the president signed banning WeChat doesn't really specify the scope of the ban. It does say that that will be determined by Commerce Secretary Wilbur Ross once that ban takes effect. And the expectation right now is that this will largely be limited to US jurisdiction. But if the ban extends to markets like China, Apple, for example, could be asked to remove the WeChat app from their app store. And that could have real implications for their bottom line. We had an analyst for Apple saying that if the app is banned, that could mean a 30% decline in iPhone shipments if the ban goes into effect. Essentially saying that in China, WeChat is more important than the iPhone. And so if you can't put WeChat on the iPhone, then it's essentially a useless device. Now, we should point out this weekend, Chinese Vice Premier Liu He is meeting with trade advisor Robert Lighthizer. This is a meeting that's set up to discuss the phase one part of the trade deal to see how much progress has been made, but you can bet that will be raised. The issue of the ban, not just on TikTok, but on WeChat, will certainly be raised there.
We're watching that, but we're also watching what's happening with this economy. We want to invite into the stream Emily Rowland, John Hancock Investment Management Co-Chief Investment Strategist, especially when we look at these initial claims for unemployment benefits down below 1 million. Is that a milestone, and should we be cheering, Emily?
Thanks, Adam, for having me today. And certainly, I think it's evidence that we are sort of reigniting this recovery in the jobs market. We had 20 straight weeks of initial unemployment claims over 1 million, but we're still digging out of an incredibly deep hole here. We still have about 15.5 million Americans who are receiving unemployment benefits right now. The unemployment rate, of course, at 10%. So we still have a really long ways to go in terms of healing the jobs market. Today, certainly some momentum, but just to put things in context, the worst week that we ever saw in terms of initial jobless claims before this in the global financial crisis was about 665 million Americans. So even a reading like we got today, just under 1 million, yes, good progress, but still, again, very devastating numbers.
So Emily, it's Julie here. It's great to see you. So if you look at the sort of collection of data out there, whether you're talking about economic data that is improving, but still not great, when you look at the situation between the US and China and tension there, when you look at the lack of stimulus agreement that we are seeing, and on the other hand, you see markets that are trading near record highs. How are you thinking about that? And are you thinking that the markets are being overly optimistic here about the outcomes of all of these items?
Yeah, Julie, I think it's such a great question, and it's pretty remarkable that we're talking about, reaching these new all-time highs, and the market's ignoring a lot of big risks right now. The tensions in terms of the fiscal stimulus getting done in Washington, which continues to get pushed out. Obviously, this sort of renewed breakdown in U.S.-China relations, and let's not forget, in 82 days, we have a presidential election here in the US. So if we weren't already exhausted enough from 2020, we're heading into a very heated political environment as well. So, stocks are priced for perfection right now. We've got a forward PE on the S&P 500 of 22 times forward earnings, and really investors are ignoring some of these big risks. We want to stay invested in equities. We want to be able to participate in upside potential if this momentum and the sentiment driven market continues. But we want to be really thoughtful about how we do that across asset classes. We want to own a mix of high quality stocks and defensive parts of the market. And we also want to be exposed to quality within fixed income with a mild credit bias in order to navigate this environment.
Emily, it's Brian Chunk here. So obviously the political event in November being a headwind in the future, but it seems like we've also seen a shift in the types of economic data that the markets care about. So originally it seemed like these jobless reports every Thursday were driving a lot of the movement in equities, at least. It seems like people don't care as much anymore. There's been a shifted focus, it seems like, to inflationary numbers. You could argue, I guess, to what degree that signals maybe optimism over where we are in this cycle. But what do you think is going to be the major headlines that the markets will be watching, let's say, in the next month or two? Is it not just inflationary numbers, but other types of metrics that you particularly are watching?
I think without a doubt, the biggest driver of the markets over the next few months is going to be developments around the vaccine. So I think really right now, because we've just talked about the fact that markets are ignoring a lot of these issues, what they're focused on, in our view, is really the developments around finding a cure or finding a treatment for COVID-19 itself. Because as we know, the economy can't fully reopen until we have that vaccine. I know as a mother of a 2nd and 5th grader, I'm not going to be able to go back and start traveling again this fall because my kids are going to be full-time remote in school. So we think about that element as being very critical in terms of getting the economy back on its own 2 feet. And investors are largely ignoring some of the more traditional inputs that all of us think about when we analyze the macro environment. That's a really challenging environment for investors. Very easy to get whipsawed here. So staying balanced is really important.
Hey, Emily, it's Julia LaRoche, and I totally hear you on that. There's been a lot of talk lately about the weakening U.S. dollar. I would love to hear your insights there and how you sort of navigate that from an investor's perspective.
Yeah, so the weaker dollar has been a really key sort of trend that's been developing. And when we think about what that means, typically in a weaker US dollar environment, that bodes well for foreign stocks. You've got sort of this slightly better economic growth playing out overseas. If you look at PMI data, it was better for the Eurozone than it was for the US for the first time since February this past month. And that's translated into a bid for foreign currencies and a weaker dollar in return. The one thing, though, that we're waiting for and to fully rotate into international equities to benefit from that weaker dollar is for earnings estimates to start to improve. So in the US, if you look at next 12-month forward earnings estimates, they're really starting to turn higher. Overseas, when you look at that same data, it still remains very depressed. So in playing the recovery in overseas equities, we would look to a more quality growth approach instead of rotating all the way into sort of value or deep cyclicals overseas. So we want some exposure there to play the weaker dollar, but we're not ready to sort of go all the way yet.
All right, Emily Rowland is John Hancock Investment Management Co-Chief Investment Strategist. It's always good to have you here on The Move. All the best to you and your team. Of course, the future and any economic recovery are dependent upon a successful vaccine in inoculating all of us against future exposure to COVID-19. Joining us in the stream right now is Dr. Paul Stoffels, Johnson & Johnson's Chief Scientific Officer. He is joining us once again from Belgium. And we want to point out to everybody that there was news made by Johnson & Johnson at the end of July in which you told all of us about the successful tests so far of the vaccine demonstrating, quote, neutralizing antibodies successfully preventing subsequent infection and providing complete or near complete protection in the lungs from the virus in non-human primates. Dr. Stoffels, I think all of us are encouraged, but what happens next with all of this?
Well, thank you very much for having me on the program. What happens next is that second half of July, a few weeks ago, we started the phase 1 clinical trials. And as you have seen in the publication, we achieved that with one single dose injection. So we had complete protection from disease and near complete protection for transmission of disease. And that encouraged us to study the single dose injection, which is now in 350 volunteers, the first cohort of volunteers. We're going to do 1,000 people study with healthy people study, just to study the behavior and getting the neutralizing antibody data. Hopefully, beginning of September, we'll have the first data from that, evaluating that, and we plan a phase 3 placebo-controlled study starting the second half of September. All of that is in full preparation in several hundred of sites in the world, especially in the US, but also in broader in the world. And hopefully in the next, by the end of the year or early next year, we'll have the data showing the efficacy. So the study is powered for giving a very quick answer to, does this work, yes or no?
And we should point out, too, that the government has contracted with the Johnson & Johnson to deliver 100 million doses of the vaccine candidate. We know from previous discussions with you that J&J is producing this vaccine at risk right now, but they're not going to charge U.S. taxpayers for the vaccine, just perhaps the doctor's service to inoculate. But when you say single dose, we hear other vaccine potential manufacturers talking about multiple doses. How important is it that your vaccine might protect us with just one inoculation?
Well, the one inoculation is important in the pandemic for immediate protection. Of course, you need a longer-term protection, and for all vaccines, we will evaluate the booster as part of the study regimen. But we evaluate first whether a single dose protects you for disease transmission and disease and lung disease. We will do booster dose studies as we go forward as part of a study program. But the first intent is to get a single dose vaccine, whether yes or no, it can protect you for the disease. Mm-hmm.
Dr. Stoffels, it's Julie here. So as Adam mentioned, you all and other companies also are making the vaccines already, even though we don't know yet if it's successful. I wonder if it's even possible to put a probability of success, any kind of percentage on your efforts. And I'm also curious, I don't know if this is a silly question, what happens to those 100 million doses if in fact you find the vaccine isn't effective? Can you repurpose it, tweak it in some way, or do you end up destroying all of that medicine?
Well, first to answer on your last question is, if the vaccine doesn't work in clinical trials, the 100 million vaccines and more, because we are producing up to 1 billion for next year, will be lost. So we produce at risk because for the pandemic, it's very urgent. The selected vaccine we put in clinical trials is now in manufacturing. And that will be, before we have any data, any clinical data, we have started all the upscaling. We have several bioreactors in the world active. We have hundreds of millions of vials in the making. We have everything in place to already prepare that at the moment the results are there, we will be able to deliver the first vaccines.
Dr. Stoffels, I also want to ask you about the recent reports and news that Russia said it has developed an effective vaccine. As you know, there was some skepticism around those reports. And there's also some skepticism amongst various populations about taking a vaccine, particularly a new vaccine. Now, I know you're on the science side of it, but what at Johnson & Johnson do you all have planned in terms of trying to make the population feel more comfortable with taking a new vaccine?
Well, we have been working on this vaccine platform because it's not the only vaccine where we use this technology. For about 10 years, we have made an Ebola vaccine, which recently got approved. And at the moment, a large vaccination campaign is ongoing in Rwanda and Congo. Now, more than 70,000 people have got a vaccine. We have an RSV vaccine, which we tested in elderly, which is ongoing, also a very large study. We did a Zika vaccine, and we have an HIV vaccine. And so the total exposure of people to the technology, what gives us confidence that we have a safe platform which will be tolerated and can be administered. In all of these, we were able, in the 4 vaccines we tested, we were able to translate what we learned in animal models into humans. And that also gives us confidence that we have a good chance to make it. We also produce the vaccine, so we are sure we can produce it. We know that it's reasonably safe, The one question we now need to answer is, does it protect for disease or does it protect also for transmission? And that's the one, so we are reasonably comfortable that we get to a vaccine, and hopefully we don't have to throw away the billion vaccines we make.
Dr. Stoffels, two questions for you. The first, these much larger scale human trials that will start in the second half of September. Have you already started to line up the potential volunteers for this? And is it just in the United States? What will this look like?
Well, we are working with the U.S. government, with the NIH, the network, the COVID network for clinical trials. Tens of close to more than 100 study sites are being lined up to do this. Now, it's difficult to line up people at this moment for the study already, because you have to go where the disease is transmitting. We can only learn whether you prevent infection with the disease with the vaccine is where there is high transmission. And so we'll decide in the next few weeks on which centers in the world will be activated. It will also include centers in South America, as well as in Africa, and maybe in the next studies also in Europe. We are working further on expanding around the world.
And our last question to you, Dr. Stoffels. We hear from Dr. Anthony Fauci all the time that he is, quote, cautiously optimistic about a vaccine. What about you personally? What's your opinion of the vaccine Johnson & Johnson is working on? What can you share with us to give us some hope?
Well, I'm reasonably optimistic, but also cautious, because the benefit risk always has to be good. But I wouldn't work that hard with a few thousand people in J&J on this, already at risk producing 1 billion vaccines, if we wouldn't believe it was going to work. So we are very committed, but of course the studies will have to show whether it finally works. So let's wait for that before we victory.
We are counting on it. Dr. Paul Stoffels is the Chief Scientific Officer at Johnson & Johnson, and we always appreciate your updates here on the move. All the best to you and the team at J&J.
Thank you very much.
Let's check some stocks on the move as we head into commercial break. First is American Airlines. Now, shares were up almost 2% at the opening bell. There's the news that's been breaking, CNBC reporting that American Airlines will cut service to middle and smaller size cities after September 30th, when the deals with the United States government in order to get some of the taxpayer-funded grants and loans expires. So there will be service cuts to smaller cities. American Airlines already looking at that. The other thing that's going on with American is that, and this is all the airlines, TSA reported, remember earlier this week, that last week had been the busiest level for air travel since the mid-March lockdowns began. Also, take a look at Cisco. Shares are down more than 10% at the opening bell. It was a disappointing earnings report that caused people to decide they had to sell off. We're going to take a look at those numbers when we come back and break it down for you right here on The Move. Welcome back to Yahoo Finance on the Move. We're watching markets right now. The Dow is off about 40 points, but we're also watching Lyft, which reported earnings, and we see that the shares are off almost 5%. Part of this has to do with a drop in revenue, no surprise there in Q2, but they also had a decrease not only in revenue, but obviously of the number of riders. Let's talk more about these numbers and break them down. Brian, what do you make of this? Are they positioned for recovery going forward?
Well, as you mentioned, not necessarily a surprise that Lyft, in addition to the other gig economy companies, not necessarily pulling out a very impressive performance in the second quarter with the travel restrictions and the inability of people to operate as normally. It's no surprise that those rides were going down. But the story for Lyft is really the lack of diversification in their business model relative to the other competitor in what is really a duopoly, which is Uber. When you consider that Uber, for example, at least had the silver lining of delivery gross revenues off of their Uber Eats platform growing by 103% during the last quarter, Lyft doesn't have anything comparable. Now, they do have a number of other business services. When you think about rentals, for example, with bikes, they also have scooter sharing. Unfortunately, those are all also probably just as equally impacted as their rides business. So I think that's the reason why when you look at the top line number, which is not surprising, you're wondering how can Uber, or rather, how can Lyft get out of this if the coronavirus were to be extended? Because at least with Uber, they do have that Uber Eats business. So I think this is going to be a lingering question as we continue to analyze and work through these two companies battling against each other in the future.
And we also were talking about, as we went to commercial break, the fact that Cisco is trading down about 10% today. Revenue came in year over year. It was down 9%, 12.15 billion. Julie, what do you make of this?
Well, Cisco seems to be facing sort of secular headwinds, right? This is a company whose business is stuff, in other words, hardware, in a world that's moving away from hardware. So many of its one-time clients perhaps migrating more of their services to the cloud. They have less need for things like routers and switches. If you look at their infrastructure platforms business, which includes switchers and routers, that was down 16% if you look at the revenue. Applications, which includes WebEx, which you would think there would be some need for. That business saw revenue fall by 9%. And the company overall is saying that its revenue is going to decline consecutively for the fourth quarter in a row. So all of this raising some concerns about this one-time giant and the sort of place that it's going to have in the new cloud-based world.
Well, as Julie was mentioning, it is a surprise that their WebEx technology actually saw a decline during the last quarter when you consider that it got a lot of public play. I mean, that's the technology that we've been using in the Federal Reserve press conferences. That was the technology that, interestingly, was used in the big tech hearing in Capitol Hill. But I think also what's more interesting from a financial standpoint is that Cisco, despite all of this, is still offering guidance for the next fiscal quarter. That's something that we've seen a lot of other companies pull back from. When we even look at that Lyft report, which we just talked about, they did provide some guidance, but it was very, very loosely based off of when they expect profitability, which they still forecast at the end of next year. But here we have a Cisco actually forecasting specifically guidance of 69 to 71 cents. I mean, that type of granularity, specificity is something we haven't really seen since this crisis began, going back about 2 fiscal quarters. So it's interesting that Cisco is going to do this. It'll be interesting to see if other tangential companies in this space continue to do the same through this season.
Okay, when we come back from commercial break, we're going to turn our attention back to stimulus. And Larry Summers is going to join us. He's going to talk about the issue that everyone seems to focus on the size of a stimulus package, but that could be a mistake because they fail to look at the duration of the package. Larry Summers is next. News on the move right now. The sheriff in Marion County, Florida, has ordered his deputies to stop wearing masks while on duty. Sheriff Billy Woods does allow a few exceptions for deputies working at the county courthouse, jail, hospitals, and public schools. Sheriff Woods says his order is about making it easier for deputies to communicate with the public. His order also forbids any visitor to the sheriff's department from covering their face.
Actors will be returning to Walt Disney World after a 2-month standoff between the company and the union representing the workers. Disney is funding a testing site for those employees who cannot wear protective masks while performing. The Actors Equity Association represents about 750 performers at the park.
Tribune Publishing is closing newsrooms at some of the oldest and respected newspapers in the country. Among the shuttered newsrooms are the 101-year-old New York Daily News and the Capital Gazette in Annapolis, Maryland. Those papers will still publish print and digital online editions, but employees will continue to work from home. Tribune sent a letter to the New York Daily News employees saying they have until the end of October to retrieve their personal possessions. Tribune has not paid rent at several of its leased properties for the past 3 months. When we come back in roughly 1 minute, we've got Larry Summers here to talk about stimulus and this economy. And welcome back to Yahoo Finance on the Move. We're watching the Dow. Not much change, still down about 40 points. We talk a lot about retail and the impact of the pandemic on brick and mortar retail and e-commerce. We want to invite back into the stream Sebastian Siemiatkowski. He is the CEO of Klarna. Now, this is a payment system for e-commerce merchants. And the last time you were with us, we were talking about the buy now, pay later program. But also want to point out that Klarna has reported that the average order value for a retailer using your platform has increased as high as 310% versus people who transact in other ways. Sounds like things are going very well for you. Is this a sign that the economy is rebounding or just that Klarna is rebounding?
Well, I hope it's both. But it's interesting to see, obviously, that, there's been a massive shift of consumption, obviously also going from physical retail to online. So that's obviously benefiting us as well. But there's a big demand among the younger generation who don't have credit cards. 70% of Americans don't have credit cards for these type of solution that gives them an easier way to shop online.
Sebastian, it's Julie here. We last talked to you in May, and you talked about that Klarna tries to offer your services to people that you are confident can repay. How much have you had to tighten your credit standards because of what's been going on in the broader economy, say over the last 3 or 6 months?
So we have obviously taken a conservative approach and been slightly careful. What's a little bit odd about the economical situation we're in right now is that you have, for the people who have not lost their jobs, they actually have more money than ever. So most of the big banks in the US are seeing a contraction of balance sheets because people are using that money to pay down their debt. And while they're spending more consumption online, it's not close to what they have stopped doing offline, right? So in general, the people who have not lost their jobs have more money than ever before, and savings are up. If you look at the people that have been unfortunately impacted in their job situation, these also, due to the stimulus that Trump has done, are also many in a better financial situation, are using that to pay down debt and to spend more online, but they're spending less. So the odd situation is, even though we're approaching something that obviously is going to be an economical downturn, the actual current status of most consumers is that they're financially better off. And so we're trying to balance that and look at that. How do we then, react to that as when we underwrite consumers in the US?
Hi, Sebastian. It's Julia LaRoche. Well, I have to confess that I've never used Klarna, though I feel like I've maybe seen it while doing some online shopping. Maybe I've come across it. Talk to us a bit more about what you're seeing from the consumer, someone who might be buying. Are they more interested in using Klarna now? Is that kind of seen as a better way for them to think about how they want to spend their money rather than spending it all at once, kind of break it up a bit? And then you mentioned earlier at the top the interest you're hearing from merchants. Talk to us a bit more about that.
Yep. So I think first and foremost, again, I think most of maybe us here will have a credit card, but you got to remember that millennials and Gen Z in the US, 70% do not hold a credit card. They only have a debit card. And shopping online with a debit card is a subpar experience because you don't have the money. For example, you're waiting for your salary comes next week, or what if I make a return and the merchant holds on to my money for 3 weeks? It's my salary money. That's not a problem on a credit card. That's a problem on a debit card. So when we can offer people a interest-free installment where they can take $100, split it every second week, $25, it makes it's more affordable, and the benefit compared to a credit card, it doesn't cost them. There's no interest, so it's free because the merchant is funding it. So obviously that's a much more advantageous way for people, and they're only using it for a specific purchase as opposed to kind of lending against groceries and stuff, which you do when you do it on your credit card. So that's where we're seeing a big demand among that generation to use a solution like Klarna as a buy now, pay later. And we're seeing a big interest growth from merchants. I think what's happened also is that what we experienced during COVID was that a lot of the large retailers who would obviously prioritize online because it's an important channel, but also had a big offline, suddenly when COVID came along, the whole company's focus came about online and what can we do to grow our online channel faster? How can we get better conversion rate, more customers through the online channels? So you had these massive organizations, large retailers in the US, who suddenly the whole management, everything they were talking about was suddenly only online. So that's been a massive shift. And we've seen that in interesting inbound interest for merchants and relationships that, all these retailers are now solely focusing. And some of them are obviously very nervous about, will people even come back? We're seeing people are learning to shop online to a large degree. They're getting even more accustomed to it, feeling that it's an even better experience. And we think this is a long-term, strong shift towards online or over offline.
All right, Sebastian, thank you so much for joining us. Sebastian Siemiatowski is the CEO of Klarna. We wish you the best when we come back. We will be talking with Larry Summers, despite the power outages in the Northeast. He's going to join us on the phone to talk about stimulus and the economy. Welcome back to Yahoo Finance on the Move. We want to jump right into the discussion about stimulus, and to do that, we invite into the stream Larry Summers, former Secretary of the Treasury, as well as a director of the National Economic Council under President Barack Obama. Mr. Summers, we got to talk to you about something you said earlier when you said everybody makes a mistake focusing on the size of a stimulus package as opposed to the duration of the package. But within the last hour, we've had President Trump boasting about the fact that he will hold up the stimulus negotiations with Congress because Democrats want $25 billion to help fund mail-in voting. What do you think of the president boasting about holding this up?
I think the president is acting with epic irresponsibility. I think the consequence of not continuing the stimulus that has mitigated our economic problems to whatever degree they have been mitigated are likely to be catastrophic. This is the kind of political posturing and government abdication that under Herbert Hoover made the Depression great. It is unfathomable to me that at a time of such evident distress, that the president would stop money from going to hungry households, families with breadwinners who are out of work through no fault of their own would be denied support. And at a time when the post office is being run by a crony of the President of the United States with serious ethical issues, the idea that buttressing the post office so that it can meet its basic democratic obligations seems utterly natural and appropriate. I wish I could say I was hugely surprised that the president would act like this. I'm not, given the track record. But that it is not unexpected does not make it any less unwelcome or unconsequential for our nation's economy and for the American people.
Larry, it's Julie Hyman here. So the president, of course, has signed an executive order to try to get money into people's pockets, although it's unclear exactly how that's going to play out. When you look at these stimulus discussions, what do you think that the two sides should be prioritizing here? Is it the actual stimulus checks? Is it the duration? Is it the size? Are there other things they need to be thinking about? What's most important?
Number one, making sure there's adequate resources, which we currently lack, for prompt results, testing, and contact tracing, and when the time comes for vaccine testing and vaccine distribution. 5% of any stimulus should be devoted to directly fighting COVID, which is the primary source of our woes. Number two, support for state and local governments on the front line, doing whatever we're going to be able to do for kids being educated, making sure we're able to keep the streets safe, making sure that we're going to meet the increased healthcare needs outside of COVID that come at a time like this. For example, in the mental health space, after people have been driven out of their routines, is going to be expensive, and state and local governments' revenue capacity with reduced sales tax collections, fewer people working and earning, has collapsed. The second priority, large-scale support for state and local governments. Third priority, we are going to be with this and with these problems and with shortfalls of demand for a long time to come, and so we need to begin on a massive public investment program directed at renewing America's infrastructure broadly defined. Everything from adequately clean water to 5G technology. And that should be the third priority in the stimulus bill. Fourth, we need to maintain the level of unemployment insurance benefits. I think there are arguments for modifying the $600, but the problem is with the design of the benefit, a flat benefit, rather than with the level of support that's being provided to people who are desperate in terms of their ability to provide for their families. So support for those most affected, support for overall public investment, support for state and local governments, and support for the fight against COVID. Those should be the right priorities, and they should define a period of substantial government spending for quite some time to come. We have much more to fear from spending too little than from spending too much.
Hey, it's Brian Chung here. So the third point that you made about demand, it seems like that folds into your thesis about secular stagnation, the increasing in savings, which could keep us kind of in a slow growth environment for a while. I'm wondering, has the COVID-19 crisis accelerated the long-term damage that we might expect to see to the U.S. economy, whether or not that's the labor market? I guess another way of phrasing this is there a way we can ever get back to 3.5% unemployment in this country?
Never say never, but events like this cast a shadow forward. The lost opportunities to be in school last spring and to be in school this fall are likely to have a continuing consequence on the skill levels and ability to get good jobs of our young people. 30 years later, people who came out and looked for their first job during the 1982 recession are doing less well than those who came out in 1979 or 1985. So these kinds of periods of deprivation definitely do cast a substantial shadow forward, and that's why we need to do as much as we possibly can to mitigate them. We may not succeed in mitigating every aspect, but our errors should be trying to do too much rather than engaging in stupid holdup battles over irrelevant issues like trying to screw up the post office.
Professor Summers, it's Julia LaRoche, and it's great to be with you again. I would like to get your thoughts on the upcoming election, and if you had any view as to how you think that might play out, and then moving forward, depending on which administration, let's say it's the Biden administration, how they might handle the series of crises that we are going through and how that might play into your own thesis as to what a recovery might look like.
No secret, I think Donald Trump has been the worst of America's 45 presidents. I think he's doing grave damage every day, both in terms of the incompetence with which we're dealing with problems like COVID, and in terms of the erosion of American institutions and the rule of law, traditions for respect of all Americans. So I'm very much hoping that President Biden and the vice presidential candidate Kamala Harris will be elected. My best guess, and nobody knows these things, is that they will in fact be elected. And I think they will bring three things. I think they will bring a return to traditional norms of American civility and seriousness of purpose, whether the issue is listening to public health professionals on a disease, whether the issue is consulting in civil ways with our allies on matters of international concern, whether the issue is engagement with all Americans being treated equally rather than appealing to racism, they will return to great American traditions. Second, I think they've put forward powerful ideas for addressing some of the most pressing problems that we face, whether it is rebuilding the economy and sustaining the globe through aggressive programs of green investment, whether it is having a health system that can provide security for all Americans, whether it is having a set of tax rules and a set of rules on how corporations function and how labor market institutions work that can redress the grievous trends towards inequality we've seen in the last 20 years. I think they've laid out an impressive and ambitious program. And I think if they receive the mandate that I hope they will, I think there's a very good chance that a substantial part of that program can be enacted and enacted quite quickly. And I might just say to some of your listeners that I know that there's a concern that Democrats, that progressives are somehow anti-business. And I'm certainly one who at times has felt he had to warn against those excesses. But I can tell you that the data are remarkably clear that on average, the stock market, on average, corporate profits do better during Democratic administrations than they do during Republican administrations. And so it's not just the little guy that does better. It's actually capital and corporate America that does better. And that's because the foundation of our economy is the middle class. And when you have policies that are based around supporting the middle class, it ends up being better for everyone. And when you have policies that rely on a trickle-down theory, it's not even best for those who have bought the implementation of those policies.
Larry Summers is a former Secretary of the U.S. Treasury, as well as the Director of the Economic Council under President Barack Obama. We appreciate your being here, Mr. Summers. All the best to you. We're going to turn our attention now to something that we like to talk about with a big smile, and we welcome back to our stream not only Reggie Wade, but also Kimi Palouche. She is the Beta Boom founder, and it's good to have both of you here. Want to start first with Reggie. And I'm going to turn this over to you to begin this discussion with Kimi, because she's the founder and managing partner of Beta Boom. And it's about impacting and how it invests women, but specifically women of color. So Reggie, I defer to you.
Yes. Kimi, great to have you on. And we spoke a little bit earlier in the week, and Morgan Stanley actually came out with analysis that said that overlooked founders of startups could represent $4.4 trillion of opportunity. And we see now that Black women starting businesses at the fastest clip that we've ever seen. How is Beta Boom helping not only women, but people who feel they are marginalized start their new company?
Thank you, Reggie, for having me. I'm so excited to be here. That's right. The $4.4 trillion opportunity is real. And we're often talking about we don't have enough data, but the data is there. And the fact is we haven't seen the needle move in terms of the amount of capital that's going to these groups. So yes, Black women are starting at the fastest pace possible, and they're still only receiving less than 0.5% of venture capital dollars. So our firm is looking at basically leveling that playing field. So we invest, primarily in women and founders of color and other overlooked groups. And what makes us different is we invest a lot more human capital into these companies, because writing the check is just not enough. There's a lot of work that needs to be done to tear down access gaps that these founders face. So we invest, and we then also provide them with a team of product, marketing, sales, and coaches that work alongside them to help them to be more successful and to really influence those outcomes.
Kimi, we've seen as of late the calls for social justice reform, not only when it comes to things like policing, but in business. Do you feel that the powers that be have more of an appetite to help people of color when it comes to getting capital to their startups?
I think yes and no. I think we're seeing, luckily, a big movement and outcry that we need to start being more equitable in how we make our investments. Unfortunately, I think we're seeing a lot of lip service in this area. So many that have come out and said that they're going to start doing things, and even kind of the Rooney kind of rules of saying we're going to at least interview and look to these groups. But the fact is we need systemic reform. This is institutionalized racism and other biases that we're seeing. And so in order for us to really see change in this space, I think we need to be looking at how we make these investments. Where are we getting our deal flow? A lot of times we talk about getting the warm introduction, but if we look at the groups that have been marginalized, they're cut out of those networks. So what real action and change are these groups doing? I think SoftBank's $100 million opportunity fund is a great start, and we're seeing that go. But then we've also seen things like Andreessen Horowitz with a $2 million up to $15 million fund, and that's a fraction of the investments that they make. So I think we're beginning to see glimmers of hope, and with everything, with a crisis, we have opportunities that drive conversation. And now I'm looking for real action because there are many of us making changes. And I think we'd love to see much more capital and real action move toward actually moving the needle.
Kimmy, I'm curious because you've been in the room with some of the biggest names in Silicon Valley as well as Wall Street, Bank of America, Google. What's that like for an entrepreneur who's also a person of color?
It's super intimidating. I talk about our startup coaching, and some of that is just instilling belief. We talk about imposter syndrome, and that's basically increased for women and founders of color that are typically not given the social capital that they need, and the belief and the representation. We need a lot more stories featured in the media so that people can believe that they deserve to be in those rooms. So I think I had in my youth kind of naivete, and I didn't know that I should be intimidated in those circumstances. But for a lot of other people, that's not the case. And so I believe that if we can actually prove and show that this is happening, that we are seeing people like Morgan Devon and other companies being formed by founders of color, by women, and that the data is showing that, with diverse teams and female founders, the returns are better, that belief will be instilled, and that we will demand that we be in those rooms and demand that we are given those opportunities and to level that playing field.
Kimmy Palouche is the founder of Beta Boom. We wish you all the best, and we're going to be right back.
Thank you.
We're approaching 12 noon here in New York City, and Jared Blickery is watching the action during the trading session for us. Jared, what have you got?
We got Apple at a record high, and the other FANG stocks doing well too. Not surprisingly, we got communication services, tech, and discretionary, the top three sectors. They're the most heavily influenced by FANGs. Look at the Nasdaq 100 heat map. Here's Apple at that record high, 461. going to be divided by 4 in a couple of weeks here, but Amazon's up over 1%, so is Alphabet. Microsoft and Facebook a little bit under 1%. Tesla's up nearly 6%. Here's a look at the 5-day price action in the S&P 500, and just tantalizingly close to record highs, but just can't seem to squeeze it out. So in the meantime, let's get to Yahoo Finance Premium's investment idea of the day. That's Charter Communication. And Argus Research is raising their price target to 700. So that would be way up here somewhere. And they're saying that COVID-19 slowed Charter's revenue growth a bit in Q2, but also slowed expense growth as the company reported strong earnings. And their estimates imply average growth of 54% over the next 2 years, well above their long-term growth rate forecast of 5%. Adam?
Jared, thank you. We have more on the move for you. We're going to be talking about the stimulus negotiations on Capitol Hill when we come back.
It is noon here in New York. We are about 2.5 hours into the trading day. We're seeing a mixed picture for stocks today. The Dow is off by about 0.1%. The S&P, very little change. It's up about that amount. And the Nasdaq is up 0.8%. 1 trillion at least. That's the gulf between the Democratic and Republican plans for the second round of stimulus as the stalemate in negotiations stretches on. 1 million U.S. unemployment claims fall below that threshold for the first time since March. What that means for the economic recovery straight ahead. And 1 billion. That was the operating loss that MGM Resorts posted in the second quarter. How the Casino King is hoping to lure professionals to change work from home to work from Vegas. Welcome to On the Move. I'm Julie Hyman along with Adam Shapiro. Joining this hour on the panel will be Melody Hum and Jared Blickery, our colleagues. Let's get to that gap in stimulus talks and a threat that President Trump is now making regarding the post office. Our Jessica Smith is in Washington with the details on the latest for us, although there still doesn't seem to be any movement here, Jess, does there?
Yeah, Julie, it does not seem like a deal is anywhere in sight at this point. We just heard from House Speaker Nancy Pelosi in the last hour, and she said that she spoke to Treasury Secretary Steven Mnuchin yesterday. She says that she turned down meeting with him because he would not budge from his position. The Democrats want the administration to meet them at around $2 trillion for this next relief package, but she says the administration would not consider that. There are lots of differences between the two sides at this point. President Trump said in an interview today that one of the sticking points is funding for the U.S. Postal Service. He says he opposes funding for USPS because it would be used to facilitate mail-in voting in November. That is something that he has consistently railed against with unproven claims of voter fraud. He said in this interview, if they don't get the funding, that means you can't have universal mail-in voting. Speaker Pelosi responded to the president's comments this morning. Let's watch.
They've not really ever liked the Postal Service because they always want to find a way to make money off of something and they want to privatize. But now, at a time of a pandemic, you would think they'd have a little sensitivity. But so obsessed are they to undermine absentee voting that this is their connection there. So the president says he's not putting up any money for absentee voting, and he's not putting up any money for the Postal Service, undermining the health of our democracy.
Say that the president is afraid of the American people. She says that he is putting up obstacles to keep people from participating in the election. So clearly nowhere close to a deal at this point. That is just one of many differences. Republicans are saying that Democrats are refusing to negotiate, that they haven't put anything forward. But Speaker Pelosi was quick to point out that 3 months ago, the House passed a relief bill. Julie.
Still waiting, we are. Thank you, Jess. Appreciate it. Let's talk about the effect or lack thereof on the markets of all of this. Samantha Azzarello is joining us now. She is JP Morgan Asset Management Global Market Strategist. She is joining us from New York. Samantha, as I alluded to, the markets do not seem terribly concerned, even though the two sides look further apart than ever. Going into this, it seemed to be pretty vitally important that stimulus checks and a full stimulus package continue. Why aren't investors more concerned?
I mean, it's an interesting question. I would say the market right now has a little bit of ADD, right, in terms of what it's focusing on, what it's weighting in terms of importance and priority. I mean, we know first and foremost, it's a COVID vaccine, right? That is obviously what the market's looking for. We were stuck in a trading range until it looked like there was some progress on the vaccine front. But Julie, to bring it back to your point, we're going to have to deal with this sooner rather than later. And by this, I mean the stimulus. And whether we're talking about $1 trillion or $3 trillion, these are big amounts of money. And frankly, this is a fiscal deficit that's not sustainable. And then more to the point right now, we know many consumers are falling off an income cliff with the removal of the extra unemployment benefit. So that's going to impact the consumer right now and moving into the fall if we don't get more of a package.
So for an investor, you've pointed out that trying to track and understand consumer behavior and doing that in a real-time scenario is very difficult. What mistakes are investors perhaps making, or what successes are they having in trying to understand consumer behavior in selecting their choices for investing?
So Adam, it's a good point because we use data that comes from the government that's arguably slow and sticky, but reliable, right? So I'm thinking of quarterly GDP data and whatnot, even, the weekly unemployment claims. We're using a lot of high frequency data. And I can say that there's a lot happening on the high frequency data front, whether we're looking at Open Table and what's happening there with reservations, or we're looking at TSA flight data. We're trying to get a better, more real-time pulse on the consumer. It's difficult, right? It's ebbing and flowing, and I don't think consumer sentiment that we get monthly is enough. So I would say to be a good investor right now, you really have to be looking forward, right? Looking forward to the future and think what trends are going to stay in place, what trends are going to be amplified, and that's the type of thing that we want to invest in right here, right now, to pay dividends likely in the future. I think investing for this summer and this fall, it's very difficult because things are shifting so much.
Jared Blickery here. You mentioned one cliff, that would be the pandemic unemployment assistance cliff, but there's also an eviction cliff. I'm wondering if you have any real-time high frequency data with respect to real estate or the rental market, anything that could give you the pulse of how close people are on the edge of potential default and eviction.
So fantastic question. The last I had checked, rental payments were basically in line with where they were this time last year. So that sense, it's normally around 80%. We track that data, and normally around 80% of people pay their rent on time. That's started to dip, but to your point, we haven't seen that cliff yet, and it's a huge issue. And when we're talking about the unemployment, right, we're really talking about those who were already at the lower end of the socioeconomic spectrum. They were already having a hard time. And the job data, while we had a decent report last month, we know it's slowed down. I mean, jobs and rehiring, it's slowed down. And that means for a lot of lower income workers, they're in a very precarious position, and we will likely see a cliff. It's going to impact landlords. It's going to impact basically all of the basic spending. And that's why we do need a plan, right, coming from Congress to fix the unemployment claims, at least for another period of time.
Samantha, we know that government plans with regard to coronavirus and also the development of vaccines is vitally important to investors right now. Since you're a global strategist, you're looking at plans around the globe, and you're saying, well, if other countries have better plans than the US, maybe they're better places to invest as well. So where are you looking to put money right now?
I want to bring up Europe, right? Europe's, this thing that investors have not favored over the last 5, even 10 years. But we look at their schema, and basically because they were able to put in place such that workers, I should say, are tied to their employers, right, which is a very different system than what happened here. Companies did not shed their workers. The unemployment rate has stayed relatively lower than it has in terms of how much it's jumped in the US. So we're looking to Europe in terms of its healthcare system and the way its unemployment benefits have been set up to say, we want to take a second look at Europe, because we also think they're going to be the first out of this. Simple data, but just looking at their caseload, right? And they have it under control, right? Europe has crushed its COVID curve. So we're looking at international right now. We have a slight overweight, I would say Europe, and then emerging market Asia over the US, given the COVID outlook.
Okay, so Europe and emerging market Asia, but does that to the exclusion of China? We had the earnings from Marriott, for instance, which said that hotel occupancy is roughly 60% in China, and it would have been 70% year over year. So they're almost back to where they used to be in China. What do you think?
I mean, that's right. So China hit their bottom in January. Europe and the US, we've hit our bottom in April. So China's arguably, farther along in the process. They were able to get COVID completely, well, maybe not completely, but very well under control. And we look at industrial production and manufacturing, that's come back even quicker in China than, per se, the consumer. So if we're looking to Asia, we want to be tilted to anything more digital with respect to the consumer, and then manufacturing and production. But there's signs of life at the end of the tunnel. And I would look to China as an example of what we could look like in terms of getting COVID cases under control, and then how the economy really can bounce back. The reason the US is having trouble, right, our recovery is happening in fits and starts because we have not handled COVID.
Samantha Azzarello, thank you so much. JP Morgan Asset Management Global Market Strategist. Appreciate it. Well, we spoke to former Treasury Secretary Larry Summers last hour, and he said President Trump is the worst of America's 45 presidents. We might be getting another one next time around. Joe Biden hopes it's him. In the wake of him picking Kamala Harris as his running mate, he raised $26 million in the 24 hours following the announcement. The two spoke together, and Kamala Harris talked about a different path from President Trump.
We're reeling from the worst public health crisis in a century. The president's mismanagement of the pandemic has plunged us into the worst economic crisis since the Great Depression.
Our Rick Newman is joining us now. So, there's a lot of talk always that the vice presidential pick doesn't matter that much, but the campaign now has $26 million more to play with, as seemingly directly as a result of that pick.
Yes, and Kamala Harris could help bring in some additional funding. She's actually a pretty good fundraiser from a few campaigns she ran in the state of California, and then her senatorial campaign. She's plugged into a lot of donors in California, and Biden has been only a so-so fundraiser, so she might help in that regard. She also appealed when she did have her own presidential campaign she did appeal to some Wall Street types because while she is a little bit to the left of center, let's say, she is not Bernie Sanders. She's not Elizabeth Warren. She actually has been pretty cozy with tech firms in Silicon Valley, for example, which is where she comes from. So I think the business community feels like they can live with her. She is part of the establishment. I think that's how they see her, and that could help with her fundraising. So I think the Biden-Harris launch, it's only about 2 days old at this point, but it's gone smoothly so far for them.
Rick, what's going to happen to their fundraising efforts if the opposition gets traction by continually pointing out that she attacked Joe Biden on his stances in the past regarding, for instance, school busing? They haven't addressed that yet, and that was a pretty tough attack she had during the debates.
Well, the attacks on Kamala Harris and that exact issue, they began about the very second Joe Biden tweeted that she was his pick 2 days ago. So the Trump campaign has been going after all of this. Remember, Trump said she was nasty. He used that word nasty to describe the way she treated Joe Biden in that one debate. So, I mean, that's just something the campaign has to deal with. This is actually not unusual for presidential campaigns. I mean, a lot of times the eventual nominee does pick somebody he or she competed against during the primaries, and you always have to deal with this criticism from the past. So it's going to be a small issue. I think we're going to hear the sound bites from that debate popping up in Trump ads. In terms of fundraising, I don't think it's going to hurt. And I just checked the numbers before the show. And Biden's actually a little bit ahead of Trump when you include everything that's going to his campaign committee, but also the outside spending, the super PACs. And there's going to be a ton of money spent on this race. And I think the Democrats are probably going to have no trouble generating as much fundraising as they need, simply because opposition to Trump is very strong.
Rick, just quickly, what do we know so far about Joe Biden's economic policy and plans?
It's changed a little bit since he ran in the primaries. He positioned himself, of course, as a moderate. He said he does not want to eliminate private insurance and go for Medicare for all. He does want to raise taxes, but not as much as Bernie Sanders and Elizabeth Warren would have. So he does have some tax hikes. I mean, we've been talking about this a lot, but just to remind people, he does want to raise, to put the top income tax rate back to where it was before President Trump lowered it in 2017. So it used to be at 39.6%. Trump lowered it to 37. Biden would push it back to 39.6. He would also tax capital gains at that higher 39.6 rate for high income people. And he'd raise the corporate tax rate from 21% to 28%. Now, Trump cut it. It was all the way up at 35%. Trump cut it down to 21. Biden says he'd put it back up to 28. And then he'd use that money to fund more generous college grants for people and some other things. That would all have to get through Congress. So this is why a big question is not just will Biden win, but will Democrats take control of the Congress? So there are two things investors really have to pay attention to the next few months.
Yes, there are, amongst many others. Rick Newman, thank you very much. Appreciate it. Well, we have been keeping check on what's happening in education, and the latest on that front, a union representing New York City principals, administrators, teachers, they have written a letter to New York Mayor Bill de Blasio, as well as the school chancellor, saying the start of school should be delayed, that New York City schools are not ready, that they do not have the resources they need. We are joined now by someone who is helping take learning online. That is Victoria Ransom. She is the founder and CEO of Prisma. She's joining us from California. And Victoria, thank you for joining us. There's been a lot of talk about so-called pods, right, where families team up and they maybe hire a teacher to teach their kids. Your company sort of does the same thing, but online, grouping kids together and teaching them. I imagine you've seen an uptick in interest as of late.
We have seen a lot of interest. And so we call ourselves a co-learning network, which has got some similarities with pods. We actually were not started because of COVID. Our vision for education has been around. We've been working on this for several years. But certainly we have seen a lot of interest. I will say that this is our pilot year, so we're being very selective about the families that we bring on board who believe in our education as a long-term solution, not just a COVID solution. Happy to describe more about how our model works. That would be helpful.
Victoria, if you could expand on that a little bit. As I understand, you're gearing up for launch in September, and right now you're focused on 2 different pilot groups with, I think, 20 students across each group. Can you tell us about the sorts of families that they're coming from. I understand it goes for about $8,000 annually. So what is the selection process, and tell us more about that.
Yeah, so let me unpack that. There's a few different questions. Let me quickly describe how it works. So in effect, we provide a much easier, much more social, what we think will be much more fun and effective way to educate kids from home. We're focused on middle school right now. What we do is we group kids into cohorts of 15 to 20 other kids. They do part of their time synchronously via video, but that's really focused on, it's not lectures, it's not boring updates, it's really meaningful discussions, small group exercises, sharing each other's work, celebrating each other's wins, that really focusing on where do you get a lot of meaning from bringing kids online together. And then part of the time is asynchronous, where the kids are working through their core curriculum, but there they are still connected to their coach, to their peers. They're literally one click away for support. And we really focus on providing a lot of flexibility, a lot of choice around what kids focus on, a lot of project-based learning. Our standard pricing is $7,900, but we've actually built into our model a lot of opportunity for families who cannot afford that. We have families in the mix who are paying effectively nothing, families that are paying half of that, and some families that can easily afford that. We are selecting families. We have a whole range of families. We are selecting them, though, based on their real belief in our approach to education. It's a very progressive approach to education. And we are selecting them on their willingness to help us build the model. It is a new approach to education. We think it will be really amazing for kids, but we want a lot of feedback. Part of our belief here is we should listen to what the kids want and really react and adapt our model quickly. And we're seeing families across the spectrum, from families that really believe in progressive education to families who have kids that they have found that when their kids, you hear a lot of negative stories about distance learning, but within that, you hear a lot of stories about kids that are breathing a big sigh of relief. And they're
Victoria,
happier.
on that note, that big sigh of relief, I'm curious, because up until the pandemic, the choices in the United States were public education or a charter school or private or homeschooling. But after the pandemic, might we see a burst of people to continue perhaps the more affordable, not necessarily private, but in-home via these kinds of video pods for education for the kids?
That's certainly what we believe and what we're banking on. And I think there's some growing evidence for that. There's the anecdotal evidence, and the New York Times just had an article a couple of days ago, anecdotally, but talking to a lot of families who say, my kid is much happier, my kid is able to move faster, my kid is not suffering from the social pressures of school. And then you start to see some surveys coming out around families that say, this is really working for us. I spoke to a principal of a charter school in New York recently, and they surveyed their families and said, who would like to continue with distance learning? It was around 30% of their families. Among that, the question was asked, is it because of COVID, or is it because you just think distance learning is better for your child? And half of those families said, so half of 30% said, it's because we think distance learning works better. So yeah, we think there could be a real shift in education coming.
Well, Victoria, can you tell us more about the certification process? So you talk about how it is very progressive, a very progressive approach to education. For a lot of parents out there, is this sort of a credible alternative? Or, because I understand this is for people who are in 4th to 8th grade. So it is kind of a very crucial time in their education process.
Yeah, so it's absolutely credible. We are really focused on what we think are the most critical skills and competencies that you need going into high school, because we're not focused on high school right now. And for us, we believe that's mathematics. So really being at least at grade level, we believe we can get kids much further than grade level in mathematics. Being very competent writers. We build a lot of opportunity for a lot of practicing of writing across various different mediums for our kids. Loving reading and being competent readers and being able to read across a wide variety of medium. And then sort of your core skills, like being able to research, being able to find information, being able to think critically, being able to set deadlines, being able to meet those deadlines. This is what we think is really critical to be successful in high school. Beyond that, we want to expose kids to a lot of different subject areas and hopefully really spark interest in that. So expose them to science in a way that's so fun that when kids get to high school, they'll really want to dig deep into science. Expose them to history in a way that fascinates them so much, they'll really want to dig deep. So that's how we're thinking about how we will prepare kids for high school. Our belief is that they will be extremely well prepared and more independent and self-motivated than most kids. But, you know, the proof will be in the pudding.
Victoria, thank you very much. Victoria Ransom is Prisma founder and CEO. Appreciate it. Just want to bring you a bit of breaking news now. The Supreme Court has rejected an attempt by the Republican National Committee to block Rhode Island's mail-in voting accommodations. This is the first in perhaps many of these types of lawsuits and rulings as we head into election season and as the President Trump and the Republicans have taken a line against mail-in voting. Many states have expanded mail-in voting capability because of coronavirus. So we will see how this continues to unfold. Just want to bring you some stocks on the move as we head to break here. One of those companies is Revolve, the online retailer. That company said revenue fell, but profit rose. It cut executive pay, furloughed some workers, reduced inventory buys in an attempt to get that profit number up. The inventory turned 30% faster than a year earlier, and net sales in June rose for the first time since the pandemic began. Those shares are higher by almost 18%. And then we're looking at a recent IPO. By the way, Revolve IPO'd last June. Vroom IPO'd this June. It's the online used car marketplace. It went public in June. The shares are down, though, 13% today. It had an unexpected profit. Revenue fell by 3%, but the company says this quarter it plans to accelerate its shift to the sale of lower-priced cars, and therefore its sales forecast is below what analysts had been anticipating. Coming up next, work from Las Vegas. Our next guest is trying to convince you to do so. We'll be right back. Well, the hotel and casino industry has been suffering like many industries that rely on travel. So they're getting creative to try and figure out how to get people back traveling. Atif Rafiq is joining us now. He is MGM Resorts International President of Commercial and Growth. Atif, thank you for joining us. So we know that people have not been traveling as much, although some traffic has returned to places like Las Vegas. Conventions are not happening, which had been a big source of traffic to Vegas in particular. So you guys are saying, well, if you're sick of working at home, come and work at an MGM resort in a place like Las Vegas. Are you finding any takers right now? Is that a hard sell, or are people interested in this?
Well, it's early days, but the buzz is tremendous, and we're looking forward to welcoming our first guest this week, actually. Our core kind of idea behind this is that it's clear America is not going back to the office in 2020. And in some cases, companies have said well into 2021. So we asked ourselves, how can we provide a change of scenery that would make it easy, convenient, and also very possible to stay productive while taking advantage of resort experiences like restaurants, pools, and even a massage. So that's what this program, Viva Las Office, is all about.
You know, I'm one of those rare breed who has been to Vegas, enjoyed the resort experience, wasn't a big gamer. I won't say gambler, I'll say gamer. But I wanted to ask you, if there is a push to finally legalize online gaming, would that help, or is the resort portion of the business that much larger than the gaming side of it?
Well, the online part will be very complementary to the resort experience. This is what we call omni-channel, where basically there's some things the brick and mortar does in a very unique way, and that is, you know, a place for leisure or for doing business, a place with all the amenities from fine dining to entertainment to pools, et cetera, et cetera. And so if people want to choose to do something on their phones in terms of online gaming or betting, you know, which is a growing behavior and increasingly legalized in different states, and then get as a reward or a perk for that behavior and that loyalty, the benefits of a resort experience, we think those two things can come together in a very nice way.
Hi, Jared Blickry here. I wanted to ask you about Barry Diller and IAC's $1 billion investment in MGM. He's highlighting online gaming, I'll use Adam's term here, as the potential catalyst. And he says maybe he will work with the people at MGM, with the executives there on their long-term strategy. Is he in the fold right now at all?
Well, it's very early days. I mean, we're happy to welcome a new shareholder, obviously, with that pedigree and experience, and tap into it. It is very early days, so you know we're in dialogue on comparing notes and what we can learn and exchange with each other. I mean, our core strategy, of course, will remain the same. We've been very bullish on the potential for sports betting. That's why we have a very significant investment in a joint venture. It's called Roar Digital. They operate a product called BetMGM. It's increasingly getting traction, and we're very hopeful about the prospects of that line of business and how MGM Resorts, other assets, some of the things I talked about in terms of resorts you can visit for food, hospitality, entertainment, can actually go together very well with that digital experience.
Vegas has done a very good job at pivoting to the day clubs, right? And making sure there are other offerings for people who are not gamers or gamblers. How are you seeing that sort of interest during this time? Do you feel like there is still a lot of caution, or are people sort of acting with reckless abandon and saying, hey, we're back to partying by the pool?
Well, I mean, safety is our very top priority. You know, for a little bit of context, we were closed for about 2.5 months. And during this period of time, we brought intense focus to modifying the resort experience around safety. And that means everything from PPE to screening of employees to distancing spaces like tables and restaurants, and then contactless experience powered by technology. So safety is the basis of consumer trust. And since we feel like we did a pretty good job of that, you know, we've seen consumers return for the options that are available, which are generally in this summer period, pools, cabanas, fine dining, and of course, gaming if that's what you're into. But we're a very diversified company. We have just as many guests here who do little to no gaming as those who are really into all the gaming options.
See, Adam, you are not alone. All right, Atif Rafiq, MGM Resorts International President of Commercial and Growth. Thank you so much for joining us. We appreciate it.
You're welcome. Great to join you.
We'll be right back here on Yahoo Finance talking about coronavirus and the meat industry and a new lawsuit. We'll be right back. Do you need to worry about the meat that you're buying, whether it's contaminated with coronavirus? Well, a nonprofit physicians group says yes, and they're asking a federal court to order meat and poultry processing plants to test their products. Our Alexis Keenan is here. She has been covering this story. Alexis, do we need to worry about this? I mean, what exactly is this physicians group saying is going on at these plants?
Yeah, well, I'm certainly starting to think about it. Now, this nonprofit group of physicians, it is made up of a group whose mission is to reduce animal testing in scientific research, also has a preventative medicine through food bent. But look, they regularly monitor food safety policy, and they filed a petition with the USDA saying that they wanted meat and poultry testing to ensure that at plants where it's processed, that it's not contaminated with COVID-19. They also want those results published so that the public can see what they're eating. Now, that petition was turned down, and that was the impetus for this lawsuit. In response, the group said that specifically they want the meat that's processed for human consumption to be tested. I talked with the attorney for the group, and he described the processing plants for meat and poultry as really a perfect storm, is the way he said it, for spreading the virus. For one, there's the volume of processing at these plants. You have about 300 cows, 1,000 pigs per hour being processed. You have on a daily basis about 20 million birds being processed in U.S. plants. Now you combine that with the low temperatures that this meat is kept at, not only at the plants, but also in transit, also at stores, also in consumers' homes. And that allows, this lawsuit says, for the virus, if it is there on the meat, to really sustain longer, and if frozen, maybe even indefinitely. You also have workers who are working in really close proximity along with inspectors and doing their jobs at that really rapid clip. Now, so far, Yahoo Finance has heard nothing from the USDA. We did reach out. And also, arguably, you have to call into question, given the CDC's data that they've been publishing at these meat plants, whether or not this does need to happen. Through May, the CDC said that of the 23 states that were reporting from processing plants, that infections were at 16,233 cases at that time across 239 facilities, 86 deaths there, and 87% of those cases, a huge number of those infections among racial or ethnic minorities. But in the lawsuit, the numbers are reported to be much higher. The physicians say that there are 40,517 cases so far, 187 deaths. Also on the CDC's website, where I took a look, this is what they have to say about the risks that these workers face. They say that the workers have distinctive challenging and controlling disease. They say meat and poultry processing workers may be exposed to the infectious virus through respiratory droplets in the air. It is also possible, they say, that exposure could occur from contact with contaminated surfaces or objects such as tools, workstations, or break room tables. Now you have to look at that and say there's no mention there of the meat itself. As of July 7th of this year, the CDC reported that 9% of all meatpacking plant workers had tested positive for COVID-19.
Right, although unclear if any of that meat that ended up with consumers ended up infecting anyone. So we'll count on you to keep following this for us. Thank you, Alexis. Appreciate it.
Really, no testing, no numbers.
Right, exactly. Thank you. Well, Yahoo Finance's editor-in-chief, Andy Storwer, sat down with former Fed Vice Chair Roger Ferguson and asked him about his insight on the decision the Federal Reserve has taken during the pandemic.
From your experience as a former Fed official, can you shed any light on the inner workings of the Fed during a crisis like this? For instance, when you were the only Fed official in Washington during 9/11, what is that like, Roger?
These crises are both moments of real-time decision-making in periods of uncertainty and leveraging deep expertise at the Fed. Certainly 9/11 had both of those, right? A great deal of uncertainty exactly what was happening, in markets, what was happening, to the US, were we under attack, et cetera. But the Fed has a reservoir of expertise that allows it to come through these crises quite well and guide the economy through the crises relatively well. So that expertise includes the way markets work, the ability to understand where pockets of illiquidity are popping up, where maybe the Fed Fed can help. The ability to leverage now new communication techniques. And so the Fed is well equipped to handle crises.
That was former Fed Vice Chair and current TIAA CEO Roger Ferguson with our Andy Serwer. You can see that entire interview on influencers with Andy Serwer at yahoofinance.com. We'll be right back. Amongst the many industries that have been hit by coronavirus, live music is certainly on the list. We've seen a suspension of concerts, some attempts at drive-in concerts. For example, we talked with Tommy Mottola earlier in the week, who said that the industry really has to get creative. But there's also an increasing number of people in the music industry who say they need help from the federal government. Frank Riley is one of them. He is the founder of High Road Touring, which does booking for acts like the Alabama Shakes, Nathaniel Rateliff, Joan Baez, Phoebe Bridgers, and then many, many more. Frank, thank you for joining us. And you are also working with a new group called the National Independent Talent Organization to try to get some help from Congress. Talk to me, first of all, about what kind of support you are asking for, what kind of legislation, and what it will be aimed at doing.
What we're asking for, or what we actually need, is basic income or subsidies to survive through this period. Most of our members, 90, 95, 99% of our members have zero income since mid-March. We were all benefited by the rapid implementation of the PPP program earlier this year, April, May, June, but that ran out fairly quickly, and for High Road, it ran out by mid-June. We're now looking at a long-term loss of income through at least the end of the year, and the numbers and the increasing viral activity seem to indicate that this may last through mid of next year. Under those circumstances, many of the independent music companies will not survive. We won't make it through to the next level. That includes agencies, promoters, independent venues, and of course the artists themselves. So what we're looking for right now is money to carry us through the end of the year. And that's, in some part, that seems to be well focused on the Restart program and the Restart bill.
Frank, I'm curious, would the natural way to do this be through the NEA, or even, I mean, back in the Depression, there was a program, it was the Federal Art Program, it was for visual arts, but we already have the mechanism in place to help. Is it really just a matter of funding, say, the NEA?
The NEA is a separate and on some level politicized organization that wouldn't reflect or wouldn't include the independent commercial businesses, the independent agencies and the independent venues per se. We're viable and profitable and successful businesses by and large. And the NEA is a funded government program, as far as I know, that runs on a separate and not necessarily parallel course to what we do also. I don't believe that that's the way to go forward. I don't believe that money would be directed into places of need within our organization. We certainly have common ground, that's for sure. And what would benefit the NEA would benefit us too.
Jared Blickery here. I wanted to ask you, with your insider look in the industry, if there's some kind of paradigm shift going on, brought on by all the changes that are going on, necessarily by the COVID response. For instance, maybe cutting out some of the middlemen, if you will. I've seen certain smaller bands that dropped a kind of direct-to-consumer approach where they're just putting on shows live. They're managing their own merch through some kind of e-commerce platform. And are the changes that we're seeing now going to be more structural, more permanent? And what are they?
There will be structural changes. Some of the repercussions of this catastrophe will affect the larger corporations even more than the smaller ones because they're laden with debt. What happens in the process of development of artists from which the independent community generally, new artists and new ideas and new music generally comes through the independent community. In order to have a further reach than local draw or local access that young bands might have and might be able to do on their own, they need the help and assistance of professionals. They need to be guided into the proper venues, the right avenues, the right support systems, management, promoters. There's a whole interdependent pathway that needs to be navigated more successfully than generally capable of that generally young bands are capable of. There's a well-established system of growth and development of new artists, and it's primarily supported during the early phases by the independent music community. From there, to reach the highest levels of success, you generally have to be aligned with a major label or have other assets behind you. But a lot of people can develop viable and very successful touring careers simply through the independent music community.
Frank, lastly, I just quickly wanted to ask you about what's happening at High Road. Have you had to lay people off? How are you guys weathering this time when there presumably is not a lot, if any, revenue coming in?
Our revenue stopped. 99% of our revenue stopped on March 15th. I struggled through the end of June and kept my entire company intact through some combination of the PPP funds and then cash reserves in the High Road accounts. At the end of June, I had to lay off 10 full-time employees, and I had to push away 3 or 4 contractual workers as well. We have a skeleton crew now of about 11 or 12 people across our 3 offices, and we're relying on our cash reserves. But no company that I know of can rely solely on cash reserves for 12 or 18 months or whatever this period may be. So we're in dire straits. We're going to struggle through this in some form or fashion, but obviously High Road and other independent agencies, along with the independent venues, will not fully survive through this period. We're a cautious and careful company, but other younger, less experienced or less supported companies will not survive through this. It will have a direct effect on the artist community going forward.
I, for one, cannot wait until live music comes back, and we wish you all the best and all the luck. Frank Riley of High Road Touring, thank you so much for joining us. Appreciate it.
Thanks, Julie. Thanks, everybody there. Thanks for the opportunity. Best to all of us.
You too. Thank you. We want to turn to another company that has been having some tricky times, and that is Tapestry, the retailer. Our Brian Sozzi had a chance to talk to the interim CEO. He is joining us now. That is Brian. Brian, what did you hear after? I'm looking at the shares, which are down about 2.5% right now. So what did you hear from Tapestry?
Yeah, it was good to catch up with interim CEO Joanne Crevisarant. I originally came in contact with her when she was COO of Abercrombie & Fitch, but she's been at Tapestry, and now she's the interim CEO, taking over for past couple weeks from ousted CEO Jide Zeitlin. Talk a lot about inventory planning for the holiday season. I think they're obviously planning appropriately conservative for the holiday shopping season. It's unclear how the holidays will shape up in any way, shape, or form, but store closures. You go through this earnings release from Tapestry, and it's clear that she is likely to close a good number of stores. Tapestry around the world operates about 1,500 stores. That's Stuart Weitzman, that's Kate Spade, that's Coach. In reality, that's just too many stores to have open during a pandemic and even post-pandemic. Now, on the positive side, they have seen strong gains digitally, but look for those store closures. She knows how to close stores. She did this extensively at Abercrombie & Fitch. She had pulled it off successfully. I would expect the same deal at Tapestry if she is confirmed as the full-time CEO.
All right, Brian Sozzi, ameliorating the overstoring problem that we have seen with many retailers. Appreciate it, Brian. We will be right back. It's time for a word on the street where we check in with our panelists, find out what stories they are watching. There's a new announcement from Amazon that it cut more than 1,200 delivery contract jobs. Actually, it's a report from CNBC. Melody, seems a little counterintuitive that Amazon would be cutting delivery people.
Yeah, I think we need to back up a little bit because this is part of the delivery service partner program that launched exactly 2 years ago. And it was just a couple days ago, as you rightly point out, that Amazon touted employing and really galvanizing a lot of small business owners and entrepreneurs who basically created startups by driving trucks to be the last mile deliverers. And some numbers here, that program overall has created 85,000 jobs. 1,300 small businesses over the last 2 years, and each of those entrepreneurs drive a Prime branded van. So there are about 40,000 of those across the United States right now. So according to Amazon, this is really just regular order of business. Periodically, they review contracts. They say, okay, maybe in Connecticut, we don't need so many anymore. Maybe in Virginia, we need a few more. So not to necessarily downplay this story, I do feel like, even a couple months ago, a similar sort of round of layoffs of 2,000 drivers took place. So I think in the grand scheme of things, yes, it's created a lot of jobs. They actually have a veteran incentive program where, upstart costs can be less than $10,000 for you to really get a business up and running. But there are echoes of even the antitrust hearing with Bezos, right? When a lot of those lawmakers use powerful testimonies from business owners themselves using the platform, saying that, Amazon is like heroin, where it feels as though you can't really exist outside of that ecosystem. And DSP is one of those prime examples, pun intended, for that sort of foray, right? A lot of these jobs were only created because Amazon exists. It's not as though many of those drivers were in the industry beforehand.
Gotcha. Well, we'll continue to watch that to see if we periodically get more of these announcements. Jared, of course, is watching the charts. Stocks are at or near records, but there is high complacency as well, Jared. What does that mean?
Yeah, we talk about this a lot, especially the concentration of the FANGs driving the market. But I just wanted to go over a few tweets that kind of illustrate where we are on the Wi-Fi Interactive. And the first is from Larry Tarantelli saying that semis, rails, trucking, and housing all in the upper right-hand corner. That means very bullish. And he's saying it's a very bullish technical trend for markets and economic expectations. So if you think about what's powering the move in markets right now, it's not just the FANGs. We actually have pretty broad breadth, and that's why we see chip stocks at record highs. We see housing stocks at record highs, and trucking and rails. The transports have just been on a tear. I think they're down a little bit today, but it's up something like 10 or 11 days in a row. So then let's take a look at what's happening in the Nasdaq. This is yesterday. The Nasdaq was up more than 2%, and the volume in down stocks making up more than 50% of the total. This has never happened before. So within the NASDAQ, because of the way it's skewed, not necessarily seeing that breadth play out, but we do have some signs in the general market that it's okay. And then here is sentiment trader again. Here's an extremely important chart. Dumb money confidence is at the highest level since late 2020 or January 2020, 1 month before stocks peaked and crashed. And so that's the complacency. There is a lot of that in the market, but doesn't necessarily mean we're going to have another crash. We might have a little bit of a rollover and correction to let some of these gains digest the way we saw FANGs, for instance, sell off a few percentage points earlier in the week.
Yeah, definitely something to watch, though. Thank you, Jared. Thank you, Melody. Thanks to Adam, as always. We are seeing a mixed picture for stocks, continuing with the Dow lower, the S&P and the NASDAQ higher. Keep it right here on Yahoo Finance.
Welcome in to live market coverage here on the ticker. A bit of a mixed day today on Wall Street as the Dow is the lone index in the red. The Nasdaq up by about 1% right now. The Dow slightly in the red, as I said. The S&P off by about 0.25% right now. But the overall theme, again, we've seen this shake back and forth between cyclicals and tech stocks today. Tech stocks, the big gainer to report when you look at the sector by sector breakdown right now. The S&P 500, energy, the big loser there. Tech up close to about 1%, gains being led by Apple as Bloomberg reports that the tech giant is considering rolling out a services bundle to go along with the launch of its next iPhone lineup. A basic package there will include Apple Music and Apple Plus, and a more expensive version is also reportedly planned to include its arcade service as well. Apple shares there hit a new all-time high and a new intraday session high just a bit ago. Shares up more than 2% there. But of course, the overall market has been trading off of the unemployment update that we got this morning. The Labor Department releasing its report on weekly unemployment claims there. And the metric came in much better than expected, 963,000 versus the 1.1 million unemployment claims expected there. Of course, it's the first time in a few months that we've seen weekly unemployment claims come in below 1 million, which is insane to think about when we think back to the highs that we saw in the Great Recession, not topping 700,000 on a weekly basis. And it took us this long to get back below 1 million claims. But here to break down that report in full is Yahoo Finance's Emily McCormick. And Emily, I mean, it's taken us a while, but this is better than expected here this week. And again, back below that 1 million mark. So don't want to say we're out of the woods yet, but things much better this week.
That's right, Zach. Definitely getting a much better than expected print on the labor market this morning. A major milestone crossed here for the U.S. labor market. Taking a look again at the specific numbers from the Department of Labor's report on weekly unemployment insurance claims, that showed that new jobless claims fell below the 1 million mark for the first time since March. So the first time we're seeing this number below 1 million in this pandemic period here in the U.S. So specifically, we had initial jobless claims for the week ended August 8th, totaling 963,000, below the 1.1 million that had been expected and the 1.2 million from the previous week. Now, with this print, this ended what had been a previous 20-week streak of new claims totaling more than 1 million. So since the week ended March 20th, we've now had more than 56 million Americans filing new unemployment insurance claims. Those jobless claims did peak with a 1-week increase of about 6.9 million in late March. They've come down relatively steadily since then, although at the same time, prior to the pandemic, we did see weekly jobless claims coming in consistently below 250,000 if we think back to the beginning of this year. So we're still several times above that level. Now, taking a look across the country, we had nearly every state reporting a decline in new claims last week on an unadjusted basis. Florida's new unadjusted jobless claims improved by 23,000 last week for the largest numerical drop across states. We also had New York State following closely behind with 22,000 fewer new claims filed last week than the week prior. Then want to pivot here and talk a little bit about continuing claims, those also falling to the lowest level during the pandemic period at 15.5 million. That was below estimates for 15.8 million and the 16.1 million that we saw during the prior week. Now, while continuing jobless claims remain elevated, we have now seen improvements in 7 of the last 8 weeks worth of reports. So seeing a little bit of improvement there as well. And a couple other metrics I want to look at. We have those new federal pandemic unemployment assistance claims totaling 488,000 for the week ending August 8th. That was down by about 167,000 from the previous week. Those claims are for the self-employed and gig workers who don't qualify for the state program. So all in all, pretty broad-based improvements that we've seen here. Of course, on a historical basis, these numbers are still very elevated, still seeing a lot of weakness in the labor market as a whole, but at least coming off of those lows that we saw for April. Zach?
Yeah, I mean, it's important to step back and put that into context too. When we think about how many weeks we've been tracking this, as you said, since this all kind of hit back in March. If you add all that up, even though we might be starting to see a trend and reversal of shrinking unemployment claims on a weekly basis, you add up all those weeks and you get pretty high insured unemployment rates, that of course being the ratio of people on unemployment benefits divided by the labor force in a few different regions. And when you break that down, these are the states we're seeing the worst kind of impact here over the last few months: Nevada, Hawaii, Puerto Rico, Louisiana, New York. Puerto Rico, not a state, but we're going to include it, at least in the discussion, at 19.1%, the third highest by region we're seeing in the US, but Nevada, close to about 24%. When you think about the national average coming in around 10%, shows you just how impacted some of these states have been in their regional labor markets as well. But clearly, obviously, this is a local story that we've been following here, as some states getting hit harder than others, and those are just a few to note. But Emily McCormick, appreciate you breaking all of that down as we continue to track the impact to America's labor market here as the pandemic continues to worsen. Of course, everything that we've been covering on this show has boiled down to how we will prop the economy up as we weather the storm here. And the latest updates we've gotten out of Washington, D.C. between Republican and Democratic negotiations have not yielded a lot here, to be frank. And the latest update we got today from President Trump, raising new issues with what Democrats are pushing for, mainly more funding for the United States Postal Service. And he took issue with that for a few different reasons. Here's what he had to say on Fox Business Network a little bit earlier. Take a listen.
They want $3.5 billion for something that'll turn out to be fraudulent. That's election money, basically. They want $3.5 billion for the mail-in votes. Okay, universal mail-in ballots. $3.5 trillion. They want $25 billion for the post office. Now, they need that money in order to have the post office work so it can take all of these millions and millions of ballots. Now, in the meantime, they aren't getting there. By the way, those are just two items. But if they don't get those two items, that means you can't have universal mail-in voting because they're not equipped to have it.
Worth noting as well that not a lot of data there to support the idea that more mail-in voting would lead to fraud, which is something that the president has raised as an issue there. We haven't necessarily seen that historically when you look into that issue. But of course, it is holding up a lot of the aid that we're expected to see come through here, the stuff that even Republicans and Democrats already agree upon, including another round of those $1,200 stimulus checks for qualifying Americans. So how much longer is this stalemate expected to last? Here to break that down for us is National Taxpayers Union Senior Fellow Maddie Duppler. And Maddie, I wouldn't expect you to necessarily have the crystal ball answer to say, here's when a deal's going to get done. So let's dig into why it's problematic here, because as we've discussed, the extra unemployment benefits rolling off for Americans here. And we know that there are millions of Americans now unemployed who need some sort of life raft here. So what's your take on how this could get way worse the longer it drags on?
Way worse rather than getting better. That is probably the protocol for Washington, D.C., as most voters watch what's happening here in the nation's capital. But two things I would say on that, Zach. One, of course, this negotiation over the extended unemployment benefits has been the sticking point for the last several weeks. Now, it's interesting over those last couple of weeks as that cliff has neared when that federal expansion expired, we've actually seen an improvement not just on initial claims, but also on those continuing claims. You saw that earlier this morning, as you previously covered. So it actually bolsters the argument, I think, for both sides. For those who are arguing that, you know, the unemployment benefits were a disincentive to go back to work, they could point to this and say, well, listen, when the unemployment benefit expired, the unemployment situation got better. The people who are saying we need to continue those unemployment benefits can also look at this and say, we've still got almost 1 million people who are trying to get unemployment benefits, even with that expiration of the federal expansion. So I think both sides might feel like their side in negotiating has been bolstered by what's happening on the ground. But another point I want to make here is the way Washington normally works versus the way it's working right now. Typically, if you've got divided government like we have right now, Democrats controlling the House, Republicans controlling the Senate. The House passes a bill that kind of stakes their claim on the demands they're making in these negotiations. The Senate then would pass a bill, and those would get conference, maybe not officially, but certainly in negotiations between the leaders of the two parties. And then that bill will get passed through Congress and sent up to the White House to sign. With the
the enigma of President Trump, that process is completely broken down. We saw the House pass their bill last spring. Several months have gone by without a Senate response. The Senate Republicans finally put forth their bill, a couple weeks ago, and they're worlds and worlds apart, which really leaves the negotiating pathway for the president and the administration to walk in and try to negotiate with Democrats. And that's what has been happening. You heard the president talk on Mornings with Maria this morning about mail-in ballots and the other things that Democrats have demanded that are extraneous to the coronavirus crisis. In normal times, those kinds of demands would fall off by the wayside because they simply would have been a flag planted in the ground. Today, because we've got the administration negotiating with Democrats and Senate Republicans watching and taking their cues from the administration, we still got a long way to go because the president has taken the bait from Democrats and talking about things that are completely unrelated to the only thing that's on voters' minds right now, which is the coronavirus pandemic.
Yes, I think that's a good summary there as to why we are in this nightmare scenario. And really, when you think about it, I guess there was optimism that since they had already done this and a lot of these sticking points have been negotiated previously, of course, there's a lot more question marks about how long should this last now that we're here in August. But they do agree on stimulus checks. And that's one of the things I know a lot of our viewers are always interested in because, free money to them. But when we think about that, it's also, I guess, hopeful to think that it would come out quicker if these talks still drag on. But if they agree, it would come quicker because we already have that in place. But that's not necessarily the case, just considering how we've seen things break down before. What's your take on how it might be easier if we do get an agreement to get cash out at the door now that these systems are a go?
Yeah, Zach, a National Taxpayers Union, my organization, has been arguing from the get-go that what Congress should do, it should build on the success of the CARES Act because of course, that was a bipartisan bill that had buy-in from both sides and the president signed into law. So things like those PPP loans and extra support for businesses in the form of tax credits and those stimulus checks all could have been consensus items that we could have had done months and months ago. But of course, politics have gotten in the way. Now, the reason stimulus checks are so popular is because they are effective. President Bush elected to do this in 2008. The administration elected to do this in the spring because you can get them out the door pretty quickly. And Americans realize when they get a check that it feels like free money. Let's contrast that to what the president has decided to do with the payroll tax cut. Americans don't necessarily realize that they get a payroll tax cut because Americans, data shows, do not pay that close attention to their paycheck. Secondly, as we've talked about before, with over 50 million people filing for some form of unemployment over the course of this crisis, if you don't have a paycheck, you don't have a payroll tax to cut. So that's not going to affect the people who need it most. And thirdly, it's just a morass of administrative rules to get that kind of thing out the door. It's not quick, easy, and painless like cutting a check, particularly since Treasury has already gone through this exercise in the spring. So I agree with you. Stimulus checks would be, I think, kind of the lowest common denominator here. We could see the two sides agree on that. But certainly because the stakes are so high now and we've waited so long to get an agreement, I don't see either side coming to the table with small ball items. They want a big deal, and those negotiations are still going to take some time to finish out.
Yeah, not overlooking the fact that there are still a lot of questions about President Trump's plan on the payroll taxes and whether or not they'd be challenged in court. The U.S. Chamber of Commerce also sending a letter to Secretary Mnuchin yesterday about concerns that businesses have over who might be liable should that get reversed. Could turn into a whole big tax mess, and not to get into a discussion on what that tax mess might look like, but shifting.
Come on, Zach, that's my bread and butter.
I know it is. But we've only got so much time here. When shifting into kind of the other issues at hand, it would kind of be a little bit of an oversimplification. I guess this isn't exactly a can of worms that's any more fun to dig into, but Republicans themselves aren't necessarily aligned on a lot of these issues. We've heard some budget hawks come out and talk about the deficit there. In July, it came down because we saw tax receipts get delayed from April to July. But what do you make of that deficit when we think about year to date expected to swell? It's already swollen to $2.81 trillion compared to $867 billion in 2019 last year. And it's going to top what we saw in the Great Recession. So what's your take on that and whether or not it might be a reasonable time to start thinking about reeling in spending?
Well, Zach, I have always warned that a fixation on the deficit is a little bit misplaced because the deficit is a pretty meaningless number between two very meaningful numbers. That is taxes and spending. If you're spending too much and not taking in enough on taxes, that's a problem. If you're taking in a ton on taxes and spending too little, that's also an imbalance that has a major effect. So when it comes to focusing on the deficit, I don't find it to be extremely meaningful when we're talking about what public policy is the right response to the current circumstances. And that relates specifically to today. Given the fact that you now have, everyone's been saying it for the last 4 years, right? We've got the most populist president we've ever had in the White House, and he's presiding over this acute shutdown in businesses, acute shutdown in the private economy, one of the biggest drop-offs in unemployment we have ever seen. And so to argue that the government doesn't have a role and a responsibility to the employers and the workers who've been affected by that, I think is not just anathema to maybe the public understanding of populism, but anathema to really what I think voters across the political spectrum would say is the proper role of government. So as long as we're in the throes of what is an extraordinarily unique circumstance, I think questions about the deficit certainly are well-founded, and that's why NTU has been arguing that any kind of support that goes out the door needs to have safeguards so that those taxpayer dollars are being spent wisely. But I certainly think that the argument about the deficit shouldn't forestall the conversation about how important it is to have some kind of support, confidence, and certainty for business owners and workers as we try to get back to some semblance of normal, which we know could still be a far way off.
Yeah, no, absolutely. Well said. We'll leave that one there. Maddie Depler, National Taxpayers Union Senior Fellow. I appreciate you taking the time.
Thanks, Zach.
All right, we're going to take one quick break here on the ticker. On the other side, digging into the data on the pandemic front as deaths here hit a new high as we continue to watch cases come down, at least optimistic reasons to think that we could move ahead with school reopenings. That's especially the stance of the Trump administration. We'll dig into what they're doing to help schools reopen right after the break. Welcome back to live market coverage here on the ticker. I'm Zach Guzman. We are still seeing the Dow, the lone index, in the red right now as the Nasdaq continues to lead, up by about 0.75% in the afternoon trade. And we've also been watching the coronavirus case count here in the U.S. come down over the last few weeks. When you look at a moving 7-day average, that has a lot of people optimistic that we are moving in the right direction. Of course, there is a lag time between cases and deaths, and we are reporting the highest level of COVID-19 deaths here in the U.S. that we've seen on a daily basis since back in mid-May. So that's not good, but still, of course, people still want to see students back in schools, at least when you ask the Trump administration, and they announced plans yesterday to help on that front, including sending more than 1 million masks to schools to help support teachers in addressing some of the safety concerns we've heard raised. But is that enough? Here to discuss that is Dr. Tyler Black, Medical Director in Emergency Psychiatry, I should say, at BC Children's Hospital. And Dr. Tyler Black, appreciate you taking the time to chat. Obviously, we saw yesterday the Trump administration coming out and saying that would be enough in sending masks out and helping deploy CDC teams to support schools in reopening. I'm not sure what your take would be on that front when you think about how many schools are here in the US and how limited we've seen the CDC in their capacity to handle the outbreak up until this point. So what's your take on whether or not we're setting ourselves up for failure in getting students back to in-classroom teaching?
Thanks so much for having me. It's a little bit confusing because in many jurisdictions we're seeing spikes of cases. Pandemics, will dictate what we do a lot more so than what a politician says we can do. So there's many jurisdictions that are having their test positivity climb, even number of cases climb, and certainly deaths are starting to peak again. So it feels very strange to be talking about reopening schools in a time where many jurisdictions simply don't support that.
And I mean, it's also kind of tied back to the positivity rates that we've seen. At least that was the plan released here in New York. We hadn't necessarily seen a lot of schools come out and introduce their own plans, though we did hear the guidelines of you'd need to fall below a 5% positivity rate. Here in New York, we had been closer to 1%, so it would fall in there. But even showing the difficulties of even in a region that does have positive data to support reopening, a lot of school officials not necessarily being able to agree on what a well-established and safe measures might look like. How difficult is it to get teachers, parents, kids, everybody on board to follow rules in place as well?
Well, there's just so many nuances. I mean, we know for sure that a child going to school is at some point going to get the sniffles or a headache or a fever, and that's necessarily going to start creating, let's quarantine this class, or let's send this class home, let's get everybody tested. The test turnaround time is unfortunately in the United States a little bit too long right now. And that's in areas where the numbers do support it. In New York, it's 1% test positivity. In Texas yesterday, it was 24% positivity. And overall in the United States right now, it's 11.7% positivity. I mean, these are just not numbers that support this notion that kids will return to school and there won't be routine quarantines, suspicions, needs to open and shut down and open and shut down. So the complexities of this is just incredible. And I always just want to throw out there as a suicidologist, this knowledge we have that before the pandemic, school days and school months were most associated with psychiatric distress and suicides in kids. So, we're adding the stress of a pandemic on top of what is already school, which is a child's major job and major stress. So parents are understandably a little bit reluctant. Schools and teachers are a little bit nervous. They were arguing for smaller class sizes before COVID. And now you have a pandemic that is definitely dependent on how large a group is. So all of these things are somewhat forgotten in this discussion about open or not open, even though they've been national dialogues for decades.
Yeah, and open or not open, I guess, we don't want this to be a political discussion. It would be a medical one, we would hope, in the throes of a pandemic. But when we talk about, backing up and looking at the benefits of schools, a lot of people raise that for some underprivileged students out there, this becomes the only place that they can get a meal during the school year, and very much dependent on those free lunches offered through the school. And obviously there is that to be considered here. But outside of it, we've also heard the benefits of in-classroom learning for younger students as well. But that's not necessarily always the case. So what would you stress in that discussion when trying to consider what might be best here?
Yeah, I think, we've offloaded a lot of our social burden on taking care of underprivileged and systemically discriminated kids within school systems. But of course, that's not the only way a society could choose to materially support underprivileged people. So inside the box of school, of course, losing school means losing some of those programs. But if schools had the material support to be able to continue those programs, hand out lunches, check in with kids who are underprivileged or don't have supervision, that would be okay too. But I always dial it back to we keep ourselves in this box that school is the only way to do this. And of course it isn't. There's many jurisdictions across the world that more materially support underprivileged people. and recognize that, for example, a child eating or a child having a safe place to live is a priority of that nation. And so putting that onto schools during a time when attendance at schools could lead to more distress or more illness is probably a bit of a mistake. Some children will benefit from going to schools, and other children may not. We know many kids with anxiety disorders, neurodiversity, they really struggle in school. What are you going to do when a child who's really resisting coming into school then comes into school and becomes aggressive? Many children have to be isolated. So it's a really challenging nuance to add.
And lastly, I mean, when we think about this discussion and what guidelines we've been seeing from the CDC and kind of the White House taking their own stance on a lot of these things as well, I mean, it's tricky to institute some of these recommendations that we've seen for schools when you think about socially distancing around high-risk individuals, trying to get everyone to wear masks for younger kids out there. A lot added to teachers' plates. I mean, how realistic is it that some of these recommendations might be able to be instituted in some of these more cramped schools rather than just having everyone be at home?
Well, I always want to relate that knowledge we had that prior to the pandemic, teachers were routinely complaining about not having enough resource, not having enough teachers, having too high a student to teacher ratio. And all of these things are just amplified in the pandemic. So, if our knowledge of what schools looked like online was based off of teachers really cramming online schools in very quickly, not taking advantage of interactive formats. I mean, here we are discussing this virtually over a platform, and it's allowing us to do things that we couldn't do if we were in a studio together. So when all of our knowledge is based off of how poorly things were implemented at the beginning of an emergency pandemic, there's many opportunities we have to deliver online education in a better way, to distribute food and lunches to kids who need it, to check in with kids who may need checking in with. We don't rely on in-person schools to do those things if we think outside of the school box.
Yeah, and very difficult to think about how you might minimize large indoor group gatherings if that's all you got at a school as well, especially as we approach the winter months. It's going to be very interesting to see how this all goes. But Dr. Tyler Black, appreciate you taking the time.
Absolutely. Thank you.
Coming up, looking at Lyft shares today, trading lower by about more than 3% after reporting the results of its latest quarter, what they're seeing in terms of recovery since April, but an absolute dramatic revenue drop of 61% as more and more people steer clear of ride sharing, plus the battle going on right now in California. We'll dig into all that on the other side of the break. Stay with us. Welcome back to live market coverage here on the ticker. Right now, I want to highlight Lyft shares in the afternoon trade after reporting its latest earnings yesterday, and we are seeing shares off more than 3% today. It kind of speaks to the overall trend that we've seen in terms of analysts lowering their expectations so much that sometimes bad news isn't necessarily that bad when you think about how it's trending versus expectations. But overall, Lyft reported a 61% decline in revenue to $339 million, beating analyst estimates. Again, very low there for $335 million in the quarter that ended in June. When you look at the other side, though, the loss that Lyft posted widened 37% to $280 million. That was also slightly better than analysts had been expecting. Again, lowered expectations. So how bad are things at Lyft? This is all coming, of course, in the wake of a battle in California. We already heard from Uber saying that they might need to shut down. Lyft coming out with almost a very parallel statement saying that that might also need to happen when you think about these ride giants now needing to extend benefits to contractors, treating them like employees. So what does it mean for these companies moving forward? More specifically, what does it mean for Lyft? Here to chat about that is CFRA analyst Angelo Zeno now. And Angelo, it's good to see you again. I would just start with, I guess, the quarter, just a dramatic drop off in revenue. They tried to say things were okay because rides increased 78% in the month of July versus what they saw in April. But I think anything, it's pretty easy to see a jump like that when you go from the absolute standstill we saw back in April in this pandemic. So what's your take on how things are playing out right now for Lyft?
Yeah, you're absolutely right. I mean, I think they tried to paint as good a picture as they could, looking at kind of, that jump off kind of the depressed March, April levels, kind of 78% above those low July. That being said, I mean, you can't really, you look at the company here down 60% year over year plus in terms of revenue levels. I think what's more important is what does the trajectory look like going into the second half and into 2021? Of course, the company didn't provide any guidance whatsoever in terms of the second half outlook, not surprisingly. The way we look at it here is really that the company remains in wait and see mode in terms of, Proposition 22 coming out this fall. And then, of course, everybody waiting on that vaccine, the kind of the big V. And those would be the two big catalysts if they work in the favor of Lyft here to really monster Lyft in the shares. Until that happens, expect the stock to really be range bound. And in our view, when we look at the estimates going into the second half in 2021, I think the street just continues to be way too optimistic.
Yeah, I mean, that's obviously not going to be any easier here. They got away with topping expectations here because we've seen those expectations come down. But when we think about California right now, that battle, just worth noting that the state makes up about 16% of the total rides that Lyft shows, according to what we heard from John Zimmer on the earnings call. I mean, how much of a weight would that be if they do wind up losing the legal battle there and have to shut down in California and deal with everything else that they've seen here in terms of people being afraid to ride in a ride share right now?
Yeah, so I mean, I'd say the one good thing is that revenue levels are off such a big cliff. There's really not much left really to kind of, take out of California. There, to your point, still about 16-17% of their business. We do like Uber a little bit more. It's less than 10% of their revenue. So not as much of a hit to their business. So you kind of look at Lyft over here, there could be a very good possibility they have to shut down for a couple of months. And even, if they have to, if they were to happen to lose this, Proposition 22, this live in an AB5 world, I don't even know if it makes sense for Lyft to even operate in California in that type of situation. So really kind of the risk hinging on this kind of fall vote is absolutely enormous for Lyft, a lot more so than it is for Uber. And it could be a great perk in their favor, but again, it's a wait and see type of environment for them. But all in all, I mean, if they are forced to shut down for a couple of months, expect to really kind of ratchet up. We're looking for about $1 billion plus in cash burn over the next 4 to 6 quarters. That number goes higher if we're talking about them having to kind of shut things down for a little while.
Yeah, and that cash burn becomes an increasing problem here too when we think about the fact that Uber at least has the food business there to kind of shore this up. They've also got other markets outside just the US and Canada. Not true on either one of those points for Lyft. So, I mean, the longer this drags on, at what point does that cash position start to become a very serious issue for a company like Lyft?
Well, I think the great thing here is, the company was able to raise some capital, back in May. So that really does help them a little bit here. They've got about 2.8 billion in cash. That gets them going here. They're pretty safe here for we think 8 to 12 quarters. Again, barring any type of massive second wave in terms of the virus and what have you. And in that type of scenario, they kind of go out and go back into the capital markets again. But at this point in time, again, Uber is much better positioned to kind of get through this environment. I'd also say this, when we talk about downturns like this pandemic we're seeing within the ride sharing space, oftentimes the market the market share leaders often, and the market share and the ones that have inferior share typically get weaker. So we do think that Uber is much better positioned and poised in the recovery phase once we start seeing that. And again, you couple that with the whole the view that this is a monster winner in the whole transportation atmosphere. You gotta like Uber over the next decade, and we would think on any type of weakness, that's the name you want to buy, and not necessarily Lyft here.
All right, there you go. Weighing both of those ride-sharing giants there, both dealing with a lot of the same problems right now, but one, according to you, a little bit more well-suited to handle all that. CFRA analyst Angelo Zeno, appreciate you taking the time to chat both of those stories with us. We're going to take a quick break here on the ticker. On the other side, Democratic nominee for president Joe Biden enjoying quite the fundraising boost, a shot in the arm after he named Kamala Harris his running mate. We'll dig into that fundraising boost right after the break. Well, welcome back to live market coverage here on the ticker. Of course, we've been covering the updates out of the political front here as Democratic nominee Joe Biden named his running mate and Senator Kamala Harris. And it's been a shot in the arm for his fundraising efforts here. The hour after naming Kamala Harris as running mate was supposedly Joe Biden's best 60 minutes of fundraising over the whole course of his campaign. And here to break down why that's important in his battle to keep pace with President Trump on the fundraising front is Yahoo Finance's Kristen Myers, who is always digging. Kristen, you're always digging the fundraising numbers constantly. Put the shovel away for a second and give us the update.
You know me. I love campaign finance, Zach. So as you mentioned, first hour after Joe Biden picked Kamala Harris was the best hour for his campaign to date. But they actually raised $26 million in just 24 hours after picking her as his VP pick. Now, if you're looking at the ActBlue tracker, ActBlue, as you and I have discussed many, many times, Zach, is actually the method through which Democrats are able to gain most of their donations. A lot of small dollar donors can go onto the ActBlue website and toss money over to whichever Democratic campaign that they want. Now, they have a lovely little ticker and tracker on their main site. And according to that tracker, about $11 million came in just the 4 hours after the announcement. And that first hour being the best for the campaign ever, that was actually confirmed by campaign aides. The camp also said that they actually had the biggest fundraising day ever. Now, you mentioned why this is incredibly important, Zach. So we've talked a lot about the kind of tit for tat going on between both Trump and Biden's camps, at least when it comes to fundraising numbers. Biden typically throughout this entire process, even when he was running for the Democratic nomination, lagged behind Bernie Sanders, lagged behind Elizabeth Warren in terms of the money that he was able to raise month after month, quarter after quarter. And at one point, I mean, he was only down to about $9 million cash on hand, which is not good news for anyone running for a presidential race, but particularly for anyone who wants to go up against President Trump, who has raised a ton of money. I mean, he said that he wants to raise and spend $1 billion in this race, and he is absolutely on pace to smash those figures, Zach, if he hasn't actually hit that 1 billion number already. So for the most part right now, Trump has actually been leading in that fundraising game, except for the last couple of months, where we've actually seen Joe Biden and the DNC be able to join forces together for fundraising. They've actually been able to top President Trump in those months of May and of June for those fundraising totals. That fundraising totals did, however, slip for the month of July. The Trump campaign and the RNC actually brought in $165 million in July, Zach. Biden and the DNC just behind, about 25 million less. They only brought in about 140 million. I say only, but this VP pick should give them a nice little boost going in. So we'll have to see what the August totals are going to be. I imagine that they actually might top the president's yet again, particularly as Kamala Harris is now out there stumping hard already, first day on the job, so to speak, as his VP. A lot of media frenzy around the pick, so we'll have to see how that boosts his campaign coffers going forward.
Yeah, if the first 60 minutes are any indication, look out. I think we could see perhaps a little bit more in the Biden-Harris combo ticket there in terms of fundraising. But Kristen Myers, appreciate that. And of course, a reminder that you can catch more from Kristen and all the coverage that we've been bringing to you in our special here in the afternoon. Catch 2020, A Time for Change tonight at 4:30 p.m. Eastern time, a little bit more time to dig into the issues behind why maybe we're seeing this fundraising battle go back and forth as the different sides take their positions on multiple different policies. We're going to take a quick break and then dig into one of those policies that we've seen change quite a bit here in the U.S. When you think about more states legalizing the sale of cannabis, we'll chat with one Chicago-based U.S. multi-state operator in Green Thumb Industries. The founder and CEO will join us after the break, after they reported yet another quarter above $100 million in total revenue. Why that has shares popping today. Stay with us. Welcome back to the ticker. Today, I want to spotlight shares of Green Thumb Industries, the Chicago-based cannabis company there. We're seeing shares in the company up more than 1.5% after they reported earnings after the bell yesterday. Second quarter results topping $100 million in total revenue for the second consecutive quarter. Total revenue came in just shy of $120 million, up 16.6%. quarter over quarter. The company also reported adjusted EBITDA of $35.4 million, well above analyst expectations, and yet another quarter of strength for another multi-state operator here in the cannabis sector. And for more on the quarter, as well as what the space is shaping up to do in the back half of 2020, we're joined by Green Thumb Industries founder and CEO, Ben Kovler. And Ben, good to be chatting with you again, my friend. Congrats on the momentum here. And it's not just you guys. I mean, we've seen this across the country, specifically in Illinois, though, ever since cannabis sales have become legalized back in January. Some pretty strong growth. So what do you attribute what you guys are doing there at Green Thumb versus the overall sector that made this such a successful quarter for you guys?
Sure. Thanks for having me, Zach. It's great to be here. I really think it's the same story. This is early innings for U.S. cannabis, and this brand new multi-billion-dollar industry is unfolding in front of our eyes. And Green Thumb is optimally positioned to take advantage of that as policies opening up regulated legal cannabis sort of sweep the nation. And Illinois is a perfect test case, an example of what other states can see in their future.
When you think about the opportunity out there, we've been having a lot of discussions about how it's shifting now. You know, there's obviously medicinal benefits here. That's a big piece of the business. And for you guys, you have 48 retail stores across 10 states here, notably based in Illinois. I assume that's a big battleground for you guys. But what are those opportunities you're most focused in on, whether it is right now branding or expanding to multiple states and growing out your retail footprint? What are you most focused on now?
Sure. I mean, our core mission is promoting well-being through the power of cannabis. And whether it's medical product that are helping people, and whether it's helping with the opioid epidemic, or it's adult use cannabis products that the American consumer really wants. So within our portfolio in Illinois that recently legalized on January 1st and has shown tremendous growth, we think there's tremendous growth ahead. Or whether it's Pennsylvania with a massive medical market on its way to adult use eventually, right, for a massive tax revenue windfall as they do that. Or New Jersey, where it's on the ballot in November, or Maryland, or Connecticut, New York, Massachusetts, Ohio. This is the Green Thumb portfolio, and we are set up to take advantage of that. We believe this is a branded consumer product that can develop an honest relationship with the consumer, right? The U.S. consumer is our target audience, and we think branded cannabis products are going to really be the wave of the future.
And we've seen that too. I mean, you guys announced the partnership a week ago with Cookies, the brand there, not just really a cannabis brand. They say they're a lifestyle brand. We've heard that even from Canopy Growth, former CEO and Bruce Linton, hyping up the Cookies brand on our show. But what does that say about branding at this stage of the marijuana sector maturing? More people getting familiar that it's not just doing marijuana, smoking marijuana, consuming marijuana in whatever capacity now, but really attaching themselves to those specific brands and the effects that come with them.
Sure. We think Cookies is one of the most exciting lifestyle brands in cannabis out of Northern California, that we can bring a Cookies on the Strip retail destination location and offer that experience to every tourist that is coming to Vegas in the must-visit cannabis location, right? High-quality product, authentic brand that appeals to consumers. All you have to do is look at a Cookies opening to see the kind of enthusiasm amongst the audience.
And when we talk about the overall country, right, we've heard timelines from a lot of your competitors out there. Curaleaf, we've chatted with Joe Lasardi multiple times on the show. We just had David Klein on earlier in the week talking about his timeline. He says about 2022 is when we should expect full federal legalization here. But we did see Joe Biden name Kamala Harris his running mate, and she introduced the MORE Act, which would not only make federal legalize marijuana at a federal level, but also expunge the records or seek to expunge the records of cannabis convicts. What does that do maybe to your timeline when you think that this will get passed here in the U.S. and how it could be a bit closer than people think?
No change for us. We believe this is Prohibition 2.0, and that brands distributed at scale is going to be how to win, and that it's inevitable over time where we are headed. However, in the near term, we're focused really on the states. We do not think that the federal government moves very fast on anything. And so we're very comfortable with the current situation. And particularly, we see state governments opening up to legalize regulated cannabis because they need two things, right? There's economic softness, they need jobs and tax revenue. And as these state markets solidify and they become really strong growth engines, those are going to be powerful, mini economies within the larger economy. We see federal policy moving towards banking regulations, easing of 280E, decriminalization, expungement, many kinds of things that happen on the federal government, banking, capital markets, et cetera. It just takes time, step by step.
On that front, I mean, when we talk about it, obviously there's a few different ways you can judge a lot of the multi-state operators in the space right now. You can look at how many states they're operating in. You could look at the revenue growth. You guys are posting impressive, as we noted, revenue growth already. And we saw the price targets on your stock get boosted from Cowen and Piper Sandler after you reported those earnings. But when you think about how a federal legalization might change the state-by-state battles going on right now, I mean, you guys have licenses for 96 retail locations across 12 states. I mean, when you think about that, does it maybe equal the playing field when we get to a place where it doesn't necessarily need to be so closely watched state by state, or how would that play out in your mind?
Well, we love our portfolio, which has a ton of optionality and unique assets in unique markets. So regardless of federal policy, which if it went full circle, all the way, like you alluded to, there's still municipalities and local regulations. We think we're optimally positioned with branded cannabis production and a distribution platform unlike anybody else. So in the pre-roll category, we think Dog Walkers, which is our brand of pre-rolls, will be in every one of U.S. consumers' hands soon. And that as the walls come down, it's not going to matter where that's necessarily made, so long as Dog Walkers are what consumers are using.
All right, we'll see how it all plays out. Obviously, this being an election year, new updates coming out on the cannabis front constantly here. So thanks for joining us to discuss all that. Ben Kovler, Green Thumb Industries founder and CEO.
Sure.
Appreciate it. All right, I'm going to take a quick break here on the ticker. On the other side, digging into the new push in the Senate to lower bank leverage requirements and why some banks aren't necessarily so stoked as you might think about that. Stay with us. Welcome back to the ticker. As we've been tracking the way that Washington continues to respond to this pandemic at hand, a shot in the arm here has been the idea of lowering leverage requirements at banks to maybe open up lending and support here for the economy. But banks aren't necessarily excited about that, or not at least as excited as you might think. And here to discuss that with us is Yahoo Finance's Brian Chung. who has the details. And Brian, I mean, it seems like they would be more excited about this.
Well, Zach, as we talk about that coronavirus relief bill that seems to be sputtering on Capitol Hill, we've heard about unemployment insurance, we've heard about help to state and local governments, but how about a little bit of looser bank regulation? That's the proposal from Mike Crapo, the lead Republican on the Senate Banking Committee. Here's how it works. So regulators broadly look at leverage in a bank by totaling all of their non-liabilities, what they call capital, and then dividing it by their total size. They call that the leverage ratio. But there's a growing call to ease the way that the Fed and regulators approach that ratio, because the concern is that maybe banks need to be more levered right now to lend into this economy that really needs the help right now. Large banks, for what's worth, have already gotten some form of help through a Fed change that they enacted back in April. So JP Morgan Chase, Citigroup, Wells Fargo, and Bank of America face what they call a supplementary leverage ratio. And all of those ratios have gone down in the second quarter as a result of that help. But as you mentioned, Zach, banks not necessarily saying they need this help. You had JP Morgan Chase's Jamie Dimon saying on an earnings call a few weeks ago that we're not going to rely on that temporary relief as we lend into the economy. So a lot of concern about what this proposal will actually do here. Critics have said, whoa, this might not be a good idea because it invites banks to get a little riskier here. We've had Sheila Bair, the former head of the FDIC, saying that she would advocate for banks to simply stop paying out dividends, which is not the case right now, as a way to preserve capital. The odds of this, for what it's worth, Zach, are not that very high for them to include this into that final package. Keep in mind, we don't even know when we'll expect to see that package, but this is something that we've heard opposition to from the likes of fellow Senate Republicans like Susan Collins, in addition to the House Democrats, which obviously we need to pass any sort of package if it were to ultimately end up reaching President Trump's desk.
Yeah, and I mean, ultimately, it seems like it would be a bit of a boost in terms of the banks and the way that they would see this, but it's surprising to see them not so amped about maybe seeing a lower leverage ratio here. I wonder how much of that, in your mind, you think might be tied to the idea of them just wanting less regulation and the idea of Congress jumping in here and changing things, and whether or not that could come back to bite them later on.
Yeah, well, in many cases, change is a little bit more expensive to effect for regulatory teams at these banks than it is for just the status quo. But we have to keep in mind that if there were to be a change, the legislative text as proposed would be a merely temporary change. That's something that proponents of this have really emphasized, that this would only be for about 12 months or so. But again, you've heard opposition from the other side saying temporary or not, this might just be a way for banks to skirt having to raise new capital, which they say is really the safest way to project or protect yourself from any sort of economic shocks. But interesting to watch this nonetheless. Again, the odds of passage of this, not really so sure.
All right, there you go. The latest there from Yahoo Finance's Brian Chung. Appreciate you bringing us that. We're going to head to break here, but much more on the ticker coming your way after that. As we go to break, we'll just give an update quickly on the stock action. We're seeing the indexes, at least the Dow remains in the red, now joined at break even by the S&P. The Nasdaq maintains its gains, though, as tech stocks still eke out a little bit of action here. The Nasdaq up by about 0.7%. Stay tuned. Much more coming your way after this.
Welcome to Yahoo Finance. I'm Kristen Myers, and you are watching The Ticker. Checking market action right now. The Dow, the only major index in the red right now. The Nasdaq, the leader of the day, as we are seeing a surge in tech companies. Financials right now are in the red. If you look over at our Yahoo Finance heat map, Bank of America right now down over 1.5%. JP Morgan down about 0.8%. We're also seeing telecom companies are in the red right now, including our parent company, Verizon. AT&T is down 0.75 percentage point right now, of course, and we're now seeing the S&P 500 actually flipping into the red. They actually are losing here. They're paring back some of the gains that they had been making a little bit earlier in the day. I want everyone to keep an eye on the S&P 500. We are keeping an eye out for that record closing high, 3386.15. We're just under 3380 right now. So we'll be keeping an eye on that during the show. Now, as I was mentioning, Apple right now giving a boost in tech and also to the Dow, up over 2% right now. Of course, this is coming as the company has said that they plan to launch a new subscription service where they're going to be packaging together Apple TV, Apple Music, Apple News Plus, which is not a very popular service right now, Apple Arcade and iCloud storage. And those bundles will come in a variety of different plans with different pricings. Also want to look over at Lyft right now, down almost 4% today. They had actually reported smaller than anticipated losses, and they also showed a beat on revenue as well. But the pandemic forced the company to cut demand, but they did say that in July, ridership was actually up almost 80% compared to April levels. Also want to look over at Penn National Gaming. They are up over 9% right now. Goldman Sachs actually initiated a buy rating for Penn National Gaming, so we'll be keeping an eye on them as well. Well, in stimulus news, the president said that no deal is getting done as those negotiations seem to stall. And this morning in an interview, the president said that Democrats, that desire to include money for the post office, over $3 billion just for mail-in voting, was essentially a non-starter. We did, however, get some good economic data out today. Jobless claims that totaled 963,000 last week. That is much smaller than the estimate of over 1 million. This is actually the first time that those jobless claims have fallen below 1 million since about mid-March. And on the coronavirus front, global case counts of the virus are now totaling nearly 21 million. Here at home in the United States, those case counts have actually risen to 5.2 million. And the death count currently sits at over 166,000. But according to a new report from the New York Times, that number could be well over 200,000. We'll be chatting that in just a few moments. Now, as I mentioned, those jobless claims much better than expected. First time, as I mentioned, that they've fallen below 1 million since mid-March, and that's breaking a 20-week streak. So for more on this, we're joined now by Eddie Gabor, Key Advisors Group and author of Common Sense Bull. Eddie, I was looking at your notes a little bit earlier, and you said that the labor market has been one of the biggest surprises. Obviously, coronavirus remains a risk to the improving labor market. But as you see it, do you think we're on the other side of this right now?
You know, I really do. And like I said, that has been the biggest surprise. Many economists predicted we would get to 20% unemployment during that shutdown and economic shock that we had. So I think the worst is behind us. Now, I don't think we're going to increase jobs at the same pace we have the last few months. But in my opinion, the good news is I think the worst is behind us, and we still have a lot of headwinds, but I think the trend line is going to be upwards here moving forward over the next 12 months.
Right. And so you say that the markets are going to continue to surprise to the upside. What other catalysts do you see pushing the markets higher? Any other surprises out there other than the labor market?
You know, one of the biggest things and the reason for my opinion in regards to that is a couple of things. Number one is the amount of cash and negativity out there right now. There's over $4 trillion of cash on the sidelines and a tremendous amount of negativity because I don't think people believe in this market. I think the biggest surprise going into next year is the earning per share number are going to surprise to the upside. Market is forward looking. And so that's why I think these dips, again, in my opinion, if you have the right risk tolerance, should be bought. So it's going to be choppy. But again, I strongly feel like the worst is behind us and we're going to be heading upwards.
So on that point of people on the sidelines, I want to ask you about this stock splitting that we saw out of Apple and then of course out of Tesla. Do you see more stock splits coming this year? And what were your thoughts on that Tesla move?
So it's amazing because, as we know, it doesn't really change anything in regards to what your value of your stock is. But we have a new investor, the millennials, that are doing a lot of trading right now. And I think why you're seeing the markets react positively to these stock splits is it gives more people an opportunity to get in because the share price is actually lower. So if that trend continues, then I think some of these companies will probably continue and follow along that trend line. Because what we've seen with Apple and Tesla in just a short period of time with the stock reaction to that stock split, it's been very positive.
Tesla right now, of course, is up 4.75 percentage points. So they're actually accelerating some of their gains. Eddie, if you were a new investor looking at Tesla, thinking that that $1,600 price tag was a little bit too rich for your taste, would you jump in on this stock split?
Look, obviously, everyone, it depends on their personal situation. I own Tesla myself. I think Tesla needs to be looked at as the technology company. People too many times compare them to the auto industry. I think long term, if you own Tesla after the split, it's got some really good upside potential. Again, it depends on their situation, on whether or not they buy it or not. All I can tell you is that I have it for myself personally and plan to hold it for a long time.
So I want to keep this going on investment strategy. You say that you're liking the barbell approach right now. What are you liking, and how do you think folks should be considering their allocations going forward?
So the funny thing in this dynamic that's changed with our economy because of coronavirus is now your growth stocks have now become your defensive plays. And in regards to a barbell strategy, we think that still needs to be a core holding. You know, you look at a day like today where the market's been down to flat most of the day, yet the Nasdaq and growth stocks are having a very good day. And we've seen the opposite happen on up days. So the barbell approach, keep the technology as your core holding for defensive plays. But I think you need to start buying these cyclical recovery stocks like the banks, like the travel and entertainment, like the industrials, and like housing. They have not had a great year like the technology stocks had. And so if you want to get some of that upside, you should buy it now before the news hits and the stock is already back to all-time highs.
So on that point about tech, it seems as if tech was everything to a lot of folks, although they did so unenthusiastically. Do you see tech, I don't want to say struggling, but I mean, as investors do this rotation more towards, value away from growth, do you think we're not going to see those big surges or as much as we have?
If we are truly coming out of this and we are recovering as an economy, then I think looking forward, value should outperform growth. Growth is still going to be solid, but I think it's unrealistic to expect the same types of returns that they've had the last 12 months looking forward. The only way that'll happen is if we have a major hiccup backwards and we do not recover the way that we anticipate.
So I want to ask you about the S&P 500 right now, just below 3380. What kind of target are you looking for the S&P 500? And how much more room do you think the S&P 500 has to run?
I think what you're going to find in regards to, obviously, it's impossible to predict short term what these indexes are going to do. But if we get a stimulus package passed and we get a vaccine that is approved this year, I think you could easily see at least a 5 to 7% move, in my opinion, before the end of the year from these levels on the S&P 500, because you're going to see a lot of cash rotate into the market if we get those positive news this year.
So I want to end on something that you just mentioned, stimulus. As I mentioned at the top of the show, it seems to be almost, I don't want to say dead in the water, but they have completely stalled right now. The president said that a deal was not going to happen. The market seemed to assume that we would be getting a stimulus deal. I think most folks are assuming that we are going to be getting some sort of stimulus deal. What do you think the market reaction is going to be? Either A, worst case scenario, if we don't, or B, what is looking like to be the more likely scenario, the stimulus talks continue to drag out over the next couple of weeks?
If we do not get a stimulus plan in place and package passed soon, that's going to be disastrous short term to the market, because we are in recovering, but we are nowhere near where we need to be. And without stimulus, you're going to have millions of households suffering as well as businesses. So they need to get off their tails and pass this thing and put all the political stuff aside, because there are businesses and families suffering. So without it, I would expect a quick double-digit drop. The other thing, too, is if this stretches out to the end of August, beginning of September, you'll see the same type of reaction, in my opinion, because the market has fully priced in a stimulus package to pass. And if it doesn't, it's not going to be a fun ride for investors.
All right. Well, hopefully Congress is listening to get up off their tail, as you said, and get a deal done. Key Advisors Group, Eddie Gabor, and author of Common Sense Bull. Thanks for joining us today.
Thank you.
Well, the U.S. has reported its highest number of coronavirus deaths in over a month. That's, of course, as the New York Times is reporting that more than 200,000 folks have died from coronavirus. So to chat more about this, we are joined now by Dr. Ali Mokdad. He's a former CDC executive that is currently senior faculty at the Institute for Health Metrics and Evaluation. The IHME, of course, is over at the University of Washington. So, Doctor, I want to ask you about this news from the New York Times first. I know that your expertise is in quantitative epidemiology. IHME is working on tracking, predictive modeling. So when you hear news that there is some sort of data discrepancy, that the death count is actually over 200,000 instead of this 166,000 that we're getting right now, does that surprise you, or is that kind of par for the course in tracking a pandemic like this?
No, that's very true. Actually, in every pandemic, we have excess mortality due to the disease itself. So in this case, COVID-19, and then we will revise our numbers later on by comparing mortality in this month, let's say in August 2020 and August 2019, we have nothing in difference here except COVID-19. And the surge in mortality will be attributable to COVID-19. That's why you see 200,000 rather than 160,000, 66,000.
What is causing that discrepancy? I mean, we have the CDC reporting those numbers were different from the numbers that we saw being provided by Johns Hopkins, which is different than the numbers that some papers are putting out through their own analysis and tracking. Why are we not able to get some sort of consistent figure, one, in terms of the death count, but also two, in the number of coronavirus cases that we're actually even seeing in the United States?
So there are two separate issues. So when you count mortality right now during a pandemic, you're counting people who died and have been tested positive for COVID-19. You're not counting people who have died but haven't been tested. So that's one. Two, you're not counting people who have died from another disease because of COVID-19 preventing them from seeking care or getting the care they needed. So that's what we call excess mortality to COVID-19. So immediate mortality right now is what we are measuring. Excess mortality is what we will be able later on to revise our estimates and say correctly how many people have died from COVID-19. As far for the number of cases, why aren't we able to get the right number of cases? We're not able to test enough in the United States, in my opinion, and we don't have enough testing right now. And at the same time, when we are testing so many people in the United States, we have lost our capacity to do tracing and isolation because we have a large number of cases on a daily basis that has overwhelmed the public health system.
So as you're looking at the data and at the figures, and you see that the case counts are rising, but rather that we're actually now getting the largest single number of COVID-19 deaths in well over a month, does that signal to you that this pandemic is getting worse and not better?
So when you look at mortality right now, it's coming up. When you look at infections in the United States, it's coming down, except for a few states where it's going up. California is alarming because it started going up. So what you see right now in mortality is depending on our behavior 2-3 weeks in the past. And what we have seen in the United States, when cases go up, Americans start paying attention, wearing their mask and staying away from each other, and the virus will start coming down. And I hope these good behaviors will continue in the United States to save lives and save our economy.
So on that point about wearing masks, I was doing some research a little bit earlier. I saw that you had made some comments about fall sports and how they could reopen. I feel as if I'm constantly seeing on social media the questions of, would you stay in your house and abide by a lockdown, or would you wear your mask for a solid month if it meant we could return things to normal? Questions like that. So I kind of want to put it to you, and piggybacking off of, you know, what you had said, that fall sports could return if people would wear their masks. I mean, could things return to normal if everyone just took this seriously, perhaps stayed inside, stopped traveling, wore their mask? And how many Americans would need to participate in that for us to return to some sense of normalcy?
If 95% of us wear a mask, we can control this pandemic. We have done it before. If you look what happened before in April, we peaked and we came down. We came down because we did the right things. Then when we started letting down our guard, cases started going up. So we have to pay attention. Wearing a mask, staying away from each other, 95% of us. Yes, we can open our businesses. Yes, we can have our footballs, but we have to be very careful. And we can't open businesses that are a spreader for the virus, such as bars right now. So we have to be very careful, but we have done it and we can do it again.
So 95% of Americans, if we can get 95% of folks on board, you're saying, I just want to reiterate here, that we could all be watching football again, going to restaurants, going to bars, going shopping, that we could return to normal, so to speak, if 95% of us can get on board.
If 95% of us wear a mask, right now we're estimating by December 1st, 295,000 deaths. We can save 66,000 lives between now and December 1st. This is more, almost half of the projected deaths between now and December 1st. So wearing a mask is very powerful. And then we have experiments. Other countries have done so, wearing a mask, staying away from each other. They were able to contain this virus. Here in America, we need to do our part, each one of us, because we have to assume, each one of us, that we are infected. And by wearing a mask, we can prevent the spread of this virus.
So, of course, as you're talking, I'm thinking about reopening schools. We got news that the president, he says that we need to reopen schools, otherwise it will be intellectually damaging to students. And he's unveiled new guidelines. He said that he's willing to deploy CDC teams to schools to make sure that schools can reopen. As you guys, IHME does a lot of the predictive modeling in terms of the deaths. Does that change your estimations and your calculations opening schools? Are you seeing large spikes coming? Perhaps in the fall, once we reopen those schools?
So right now in our projections, we're assuming 50% of schools will open and students will come back. And then, of course, we will update our numbers as new data come in. The debate about opening schools should be not, can we open our school? It's how long can we keep them open? Look what happened in Georgia. And for us to open our school, we have to contain the virus in our neighborhood. That's what we need to talk about in the United States, is containing the virus in the neighborhood. Then we can open the school, then we can open the restaurants. But to jump and open the schools without containing the virus in your own community, that's a recipe for a disaster, because there'll be spread of the infections among the school, they'll take it back to their houses, and we start all over again by cases rising in the US. So we have to be very careful. Let's look at what's happening around us, then make a decision for the schools, the football games, the restaurants, and so on.
All right, Dr. Ali Mokdad, Senior Faculty at the Institute for Health Metrics and Evaluation. Thanks so much for joining us.
Thank you.
And Yahoo Finance Editor-in-Chief Andy Serwer spoke with TIAA President and former Federal Reserve Vice.
The coronavirus has taken a disproportionate toll economically and in terms of health on people of color. And I'm wondering if you think that Congress should specifically address those populations.
You know, I've been on a few phone calls where I think that probably does, make some sense. We have to recognize the reality that the coronavirus has disproportionately affected minorities, as you say, for a variety of reasons. And thinking through the process of helping to rebuild those communities, I think is very, very important. I believe that at least some members of Congress are thinking about the possibility of doing something with community development organizations that focus in those spaces. Others I think have asked for a specific focus on HBCUs, historically Black colleges and universities. And so I think it is important for Congress to, take note of the reality around them, that this virus has disproportionately impacted people of color. I think the statistics show that, African Americans make up approximately 13% of the US population, but make up something like 20% of those that have been impacted by the virus. I may have my numbers off slightly. That I think calls for national attention. And in part, it is a result of the fact that, health inequities and disparities have been built into the system. It's related to wealth inequities and disparities, related to income inequities and disparities. So there is a pattern here that is playing out in these virus impacts, but that go back in the history of the country. And I do think it's important for Congress to acknowledge and take note of that. Absolutely.
And you'll be able to catch the full episode of that interview tonight on yahoofinance.com. And after the break, while the pandemic has closed some businesses, others are not just thriving, but expanding. We'll be talking to the CEO of Tropical Smoothie Cafe next. Welcome back to Yahoo Finance. Checking market action. Right now, the Nasdaq, the only major index in the green. We are actually seeing the S&P 500 retreating from some of the highs that they had achieved a little bit earlier. We had been watching the S&P 500 thinking that it was going to surpass and touch that record closing high of 3386.15. Right now, it is down below 3370. So we'll be keeping an eye on the S&P 500 to see if they can make a rally today. The Dow also in the red, down about 0.5 percentage point right now. While many businesses have been shutting their doors for good, Tropical Smoothie Cafe is only expanding in coronavirus time. So I want to welcome Charles Watson, CEO of Tropical Smoothie Cafe. Charles, what kind of growth are you seeing right now, and what are the expansion plans?
Sure. Well, thank you so much for having me, Kristen. I would tell you Tropical Smoothie Cafe is absolutely on a tear. So far this year, we've opened 55 new restaurants, and our goal for the year is to open about 85. And quite honestly, we're bullish on beating that number. So we've been able to accelerate the business during COVID. We've had some of the struggles that many of my fellow restaurant brands have in the March, April, May timeframe. But our comp sales have come storming back. If you look at our July, our comp sales were up 25%. So I think it's ultimately the consumer telling us that they are looking for brands that they trust, that can provide a consistent product that is very convenient to them, that they can get any place, anywhere, anytime. And I think Tropical Smoothie Cafe is filling that void.
So to that point, as you mentioned, comp sales up over 25%, almost up 6% on comp transaction growth. Do you think in some way consumer habits might have changed since the start of the pandemic that makes folks want smoothies more, want maybe healthier options? I know a lot of people have been talking about fighting the COVID-15. I'm not sure if that has contributed to the boost that you guys are seeing.
I think the consumer absolutely is looking for, again, healthier options, but they don't want to sacrifice taste and flavor. And I think that's where Tropical Smoothie Cafe plays. I think there's a lot going on in reaction to the new normal, right? I know I certainly have experienced with my family of four, getting sick of cooking our own food and really going to digital channels that allow for real convenience for our consumers. We've leaned heavily into that. We provide our consumers with web ordering, our own app. We utilize all the third-party delivery people as well as our own branded delivery. So when consumers begin to use those channels, they typically will order from more than just one, right? And so I think in our business, what we're seeing is ultimately you're getting larger bundled orders that are happening, which is ultimately driving our average check and leading to some pretty good success there. So that's been pretty consistent for us over the June, July, August timeframe.
So are most folks ordering from you guys through a delivery service, be it Grubhub, Uber Eats, Seamless here in New York, Postmates, or are folks still coming in stores?
It depends on the state. It depends on the state, Kristen. We operate our cafes based on what the state and municipal guidances are. But certainly we are seeing walk-in traffic. That is coming back. People want to be able to sit down. We have very strict dining room policies and social distancing procedures in place. But no, the big gainer has absolutely been the digital channels, ordering online, delivery, the Uber Eats, the Postmates, as you mentioned. That's where the growth is primarily coming. But the walk-in business is coming back. We are still a brand that provides a sit-down, convenient experience. So we're kind of getting it in all places right now, which we're very excited about.
Now, your company has franchisees. Have they been struggling? What kind of support have they been getting? I noted that you guys are helping them navigate this world, especially after the CARES Act of stimulus funding and PPP. I'm wondering if you can talk us through how some of those small business owners have been faring.
Well, I would say ultimately for any franchise business worth their salt, they understand that without franchisees, you don't have a business. So we are absolutely in partnership with our franchisees. Some of the things that we did, and many other brands did things similar, I think we were just more aggressive than some of our competitors. We did a 50% royalty reduction for 2 months for our franchisees during COVID to really help them manage cash flow and stay open and stay in business. We also did a charitable, we gave away 230,000 smoothies across the United States. Our franchisees did that, and both Tropical Smoothie and our partners funded those smoothie giveaways so we could get transactions ringing for our franchisees and also be altruistic at the same time, which obviously drives brand awareness and like of our brand as we're out supporting our communities where we live and work. We also did things like fund open signs and pay for them for our franchisees, buy our franchisees masks, open signs. Heck, we were flying planes above DMAs with freesmoothies.com. So we threw it all against the wall, put it all out there for our franchisees. And we've been extremely lucky that we have not had any permanent closures through COVID for the Tropical Smoothie Cafe brand. We also did a lot of work, as you mentioned, the CARES Act. Our franchise development team, well, for about 3 months, they were loan officers, helping our franchisees secure their PPP loans. And our real estate team focused intently on making sure that we were working with our landlords to get any rent abatement or deferral that was out there. When you sum all that together, we've got a system that is strong and has been able to rebound and produce the results that we have the past 90 days.
Do you think that system is going to stay as strong going forward? As we've been talking about, stimulus negotiations right now are dead in the water, and the president's executive actions did not include any assistance for small business owners. So are you concerned going forward for your franchisees if Congress doesn't pass some sort of deal?
I am not for our brand. I certainly understand the line of thinking. The reason I say that is because we diligently tracked the first stimulus and its effect on our business. And we have now come through that time frame and the new normal operating environment for our business, and we're still going gangbusters. So while I think it absolutely would continue to be tailwinds, I think for our brand and our space, we're okay without that stimulus. But I'll certainly take it.
All right. Well, it's definitely a good thing that for you, business is a boom and not a bust. Charles Watson, CEO of Tropical Smoothie Cafe. Thanks for joining us.
Thank you, Kristen.
And after the break, Trump's attack on the post office continues. We'll be chatting about that after this. Welcome back to Yahoo Finance, checking market action. The Nasdaq remains the only major index in the green right now. The S&P 500 actually has started to pare back some of those losses, up over 33.74 right now. Again, 3386.15 is the level that we are looking for, that closing record high. The Dow right now up under less than half a percentage point. I want to give a look over to Penn National Gaming. We were chatting them a little bit earlier today. They got initiated a buy rating, and Penn National Gaming up over 8% right now. Well, the president continued his attacks on the U.S. Postal Service today. In an interview this morning, he highlighted that the Democrats' desire for $3.5 billion for mail-in voting and $25 billion for the post office was essentially a non-starter. In that interview, he said that not only would the post office be unable to do mail-in voting without those funds, but that he had no interest in giving it to them. So for more on the war against the post office and its impact on working families, we're joined now by Monique Morrissey, Economic Policy Institute economist. So Monique, I want to start first on the elections and some of the notes that you had been making. The president saying that he doesn't want to give money to the post office for mail-in voting. I'm wondering if you can share with us your thoughts on how that's going to be impacting the integrity of the election in November.
I think it will have a huge impact. I mean, during the pandemic, obviously people are going to be relying a lot more on mail-in voting. We already have universal mail-in voting in many Western states, but when people are afraid of voting in person, obviously they're going to rely much more on mail-in. And the president has hinted that he was opposed to it, but then, as you know, what he told Fox Business News is he's openly trying to suppress mail-in vote, even though much of his administration, much of his cabinet himself have voted absentee themselves.
So a lot of criticism has been thrown at Louis DeJoy. He's the Postmaster General, and he's also a Trump ally. A lot of folks have been saying that he is purposely sabotaging the post office. I'm wondering, however, if you could respond to the pushback to that criticism, that the post office essentially has been hemorrhaging money for quite some time, and that something had to be done to stem the bleeding. So what Louis DeJoy is doing isn't necessarily a sabotage, but attempting to stem the bleeding, so to speak.
That's absolutely not true at all. So technically on paper, Postal Service has been losing money since the 2006 law was passed, and the Great Recession followed right afterwards. But the reason had nothing to do with the fundamentals of how it operates, but had to do with the fact that Congress required the Postal Service to fund 75 years worth of retiree health benefits in 10 years. And the reason it did that is kind of a convoluted story, but at the time they were trying to paper over their own deficits, Congress was. So they wanted a lot of money coming from the Postal Service, which is an off-budget entity, into the federal budget. And so they made this onerous requirement, which made the Postal Service look for many years like if it was hemorrhaging money. Also, the Postal Service is it's not supposed to make money, it's supposed to break even. It has a public service mandate. It has to deliver to every house, and it's been also restricted in how much it can raise postage. So in other words, it's really not that there's something. It's a very efficient operation. It would be making money if you just loosened a couple of those things. I'm not suggesting that we should raise postage rates right now, because during a recession that's a very bad idea. But I am suggesting that the Postal Service, like other companies that have been directly affected by the pandemic, should get a little bit of a relief.
So you say that the war on the post office, as I've been calling it, is harming working families. I'm wondering if you can talk us through how, especially given the makeup of the employees at the USPS.
Well, the Postal Service has for many years been a lifeline to the middle class, especially for military veterans and African American workers. And this was hard fought, by the way. There's an entire book written about how African Americans were locked out of the good jobs in the Postal Service and had to fight to get those jobs. These jobs are middle class jobs. They're solidly middle class jobs. They're not lavish. They're hard jobs. They're jobs of responsibility, but they pay a bit more than the typical job for somebody who's got a high school degree or maybe an associate's degree, but doesn't have a bachelor's degree or higher education. So like most government jobs for non-college workers are a little bit better. They have better benefits. If you have, often private sector jobs for non-college workers don't have a pension, don't have healthcare benefits, and Postal Service jobs do. So it's been especially important for African Americans who have, the wealth gap is enormous for, between blacks and whites in this country. And one way to fix that, if you're an African American family, you're trying to stay in the middle class, is to get a job with decent benefits that make sure that you're not going to get bankrupted because of medical costs, and that you have a secure retirement. And so that was what the Postal Service represented for many years, and still to this day. But there are increasingly pressures on those wages and benefits, so we've seen this. This has been sort of a long-standing thing. The Postal Service has been shrinking. The pay premium for working for the Postal Service has been shrinking. They're still decent jobs. They don't really by themselves pay even for supporting an average family. You still need to have a dual earner. I mean, it's not like these are lavish jobs, but they're secure. And so that's what makes this especially tragic.
I want to also contrast that as well to, while it's not, these moves aren't just harming folks, but they also are helping some corporations. How much of a boost is this to postal rivals?
Well, it's huge. And in fact, back to the earlier point about, about the jobs, what's been happening for a long time now is that the Postal Service has been sort of hollowed out from within by outsourcing. And very strangely, the Postal Service is required to rebate any cost savings that it has to companies that do things like pre-sort or deliver packages or mail closer to the destination. So the Postal Service doesn't even actually benefit from this kind of outsourcing, but low-wage employers who do that kind of work definitely benefit because they're paying sometimes, minimum wage or barely above it. They're using the same technology or worse technology than the Postal Service. In fact, the Postal Service often invented the technology and then it gets borrowed by the private sector companies. But the private sector companies compete on low wage, and the Postal Service is pretty much obliged to give them these big rebates. And so that has driven this sort of hollowing out of the Postal Service. And I should mention that the current postmaster, which is rather shocking, owns $30 million in stock in his former employer. He was CEO of a company that did third-party logistics, including for the Postal Service, was one of its main clients. It got sold to another company. He still owns a huge amount of stock in that company, and that his company was known specifically for that. It promised other employers, they would do outsourced work and without a union and at low wages. That was their that was their MO. So obviously the postal worker unions are alarmed by having him now head up the Postal Service. And he stands to directly benefit from things that are going on with the Postal Service or what they can implement.
Well, I think this is the first time that, the U.S. Postal Service has gotten so much attention as a piece of this political war. Monique Morrissey, economist at the Economic Policy Institute. Thanks for joining us.
Thank you very much.
And after this, we have a market outlook. That's next. Welcome back to Yahoo Finance. Looking at the markets right now, both the Dow and the S&P 500 are in the red as the S&P 500 retreats from some of its gains that it had made earlier today. But for more on the market outlook, I want to bring on Yahoo Finance's Jared Blippery. Hey, Jared.
Hey there. The averages are off their high, but we do have some individual winners here. Apple is the big leader in the Dow and one of the leaders in the Nasdaq. It's up at a record high, another one, 1.5% year to date, up 56%. Amazon, Alphabet, and Facebook also in the green, while Microsoft is a little bit in the red, just about break even. Another record high earlier before it turned red is NVIDIA, and you can see it is approaching 100% year to date at 93.63% right now. But let's take a look at the sectors first before we look at some charts. And here we see communication services and discretionary and tech. Those are the big three FANG sectors. Those are in the green, or tech is just barely break even right now. To the downside, energy is off the most, about 1.5%. Here's the S&P 500 today. You can see we are just coming off our session lows right here. And we've been talking about being so close to a record high. And we've been trying to punch through over the last few days, came very close, haven't been able to do it just yet. Have to see what happens in the final hour and 15 minutes of trading here. But I also want to take a look at the bond market, because the 10-year T-note yield, that is up 20 basis points over the last 5 or 6 days. That's causing a lot of consternation in the bond market. And on a longer term basis, it has now broken a trend line that has been in place since the COVID sell-off. So if this breakout takes form, should be supportive of risk assets, including value and cyclicals, that's energy and financials, which have been under pressure. Got to take a look at the US dollar as well, because that has been under a lot of pressure. And we can see it's just kind of consolidating now at the bottom end of its range. If it goes lower, that's generally supportive of risk assets. If it goes higher, that could cause some problems for equities here. And then finally, gold, which had a rough start to this week. We can see that big sell-off right here. It's bouncing back over the last couple days, just barely green right now. But take a look at silver. Silver up 4.5%, really shrugging off some of the concerns we had only 2 days ago after it dropped 15%. Kristen?
All right. Thanks so much, Jared. And after the break, we'll be looking at the president's executive actions on student loans. That's up next. Welcome back to live market coverage here on Yahoo Finance. Well, the president signed an executive action continuing the suspension of student loan payments until the end of the year. So for more on this, we're joined now by Ashley Harrington, Federal Advocacy Director and Senior Counsel at the Center for Responsible Lending. So Ashley, the president put a pause on student loan payments that was originally introduced under the CARES Act. This means that 35 million people with federal student loans are not going to have to resume their payments until January of 2021. Is this a win or not?
So it's definitely helpful, but we actually still have a lot of questions about it, Kristen. So we know that the executive order directs the secretary to extend the suspension through the end of the year. However, back in March, before CARES was enacted, when the president also issued an executive order to suspend payments, borrowers had to actually opt in. It wasn't an automatic suspension as it is under CARES. So it's unclear whether this is going to be opt-in, opt-out. There's also the issue of it doesn't speak to defaulted borrowers directly who have experienced a halt on involuntary collections under CARES. So we're in a situation where come October 1st, all the folks who were in default and struggling before the crisis, who are still struggling and struggling much more now, are going to be subject to wage garnishments and everything else starting October 1st. And it still leaves out the 9 million borrowers who have department guaranteed loans but not held loans, the FEL borrowers and the Perkins borrowers who are not actually owned by the department, who have loans not owned by the department. And there's the worry that under CARES, our payments the suspension of payments, even during those months, counted towards IBR and PSLF. However, the executive order doesn't mention the PSLF program. So we're looking at where teachers who will, if they have the department held loans, could have their loan payments still suspended, but it wouldn't count towards PSLF. The frontline workers who may have been counting it towards PSLF. So there's just a lot of open questions that we definitely need more direction from the department on.
So to that end, when you have open questions, who is the one that comes up with the answers? You didn't get any of those from the president. Is it just the Department of Education that says, okay, we have this executive order? let's just try to figure it out and perhaps use the CARES Act as a template or a guide? I mean, so right now it almost seems like we have no idea what's going to be happening come October, at least when it comes to our student loans and those payments.
Absolutely. We definitely need the Department of Education to say something. And that's not just borrowers. Servicers need that help as well. They are also confused by what's going on. And so we need directions for everyone involved. But really, Kristen, what we need is, our lawmakers to get back to the table and create a comprehensive relief package that does include student debt relief for all borrowers. The House passed HEROES back in May. It had the continuation of suspension of payments all the way through September 2021. It covered the left out borrowers, the failed borrowers and Perkins borrowers who weren't included. It even had debt relief for private student loan borrowers. And it had $10,000 of cancellation for some borrowers. So there was a lot more in there, and it just gave folks a lot more clarity. They knew what to expect, borrowers and servicers are like. So we need the department to give more guidance, but we also need congressional action on student debt and other issues that are facing families and consumers during this crisis.
So currently the student loan debt crisis is up over $1.5 trillion. I believe it was 1.6 trillion last time I checked.
1.7 now.
Okay, well that's even worse. 1.7 trillion right now. Without any form of specific legislation, how do you think this is going to impact that?
I think we've already been seeing student debt grow. It's only going to get worse because we are in such a precarious situation economically. So many borrowers were already struggling pre-crisis. Before we even got here, 2 in 5 borrowers were in default or seriously delinquent, and it was worse for Black and Brown borrowers. And the economy hasn't gotten better. We don't know when it might get better. Folks are still facing long-term unemployment. There are wages that will never be made up. We're also facing a massive rental housing crisis. And there's going to be so much overlap between these populations. So I don't think this is going to get better unless we take bold steps, including actual debt cancellation. Balances have to come down. If we leave this crisis and we're still at 1.7 trillion for 45 million borrowers, that is a serious drain, not just on their resources, but the entire economy.
So to that end, I also want to ask you, as you mentioned, rentals. There had obviously been a moratorium on evictions that, of course, expired when the CARES Act expired. Are you concerned about a rising number of folks that are going to be left homeless going forward?
Yeah, we're 30 to 40 million folks are looking at losing their housing. That's a concern for all of us. We're talking about right now $25 billion in back-owed rent that is set to approach $70 billion by the end of the year. And this is, again, when we still have high unemployment, wages are never going to be regained. This is a major problem. And so we're going to have a homelessness crisis in the midst of a public health and economic crisis. And all of these issues are going to compound on each other. So that's why we really need Congress to step up. And when you look at the president's executive order on the rental crisis, it actually really does nothing. It just directs HUD to, look for money. Basically, look under the couch cushion, see if you can find some extra money, and then think about how we could use it. Not even then, once you find it, use it. Just, think about it, figure out something. And so that's no help or relief for those 30 or 40 million people who are facing literal homelessness, literally losing their homes. In the face of in this crazy during this time of public health issues, economic issues, everything like that.
All right, well, we will have to leave that there. Ashley Harrington, Federal Advocacy Director and Senior Counsel at the Center for Responsible Lending. Thanks for joining us.
Thanks so much.
And up next, we'll be chatting Apple as they ready a subscription service that is going to be bundling digital services. That's next. Welcome back to Yahoo Finance. We're going to be chatting Apple right now. That stock up 1.25 percentage point. They are going to be readying a subscription bundle, essentially to boost digital services. So for more on that, we're joined now by Yahoo Finance's Sabeel Marcellus. Hey, Sabeel.
That's right. So Apple is ripping a page right out of Amazon Prime, trying to boost their business. And what they want to offer consumers starting reportedly in early October is subscription bundles. So like a bunch of different service piecemeal. So for example, they are going to have different tiers. It's going to be a monthly price for consumers, and you get to pick what you want in that bundle. So what they're considering is a basic package with Apple Music and Apple TV Plus. So that's one level. Another level, a little bit higher, another tier would be including Apple TV Plus, plus Apple Music, and Apple Arcade gaming service. Now you could also mix and match those services with Apple News Plus for a different price, and then also extra iCloud storage for photos and files. So Apple basically trying to give consumers what they want, and the goal of all this is for the bundles of the different services to be cheaper per month than if you were to pay for the different individual services by themselves. So what we're seeing here is Peloton, they could possibly be threatened because Apple is considering having a physical class virtual fitness subscription service. That's going to be new for Apple, and that would be one of the pricier ones. So we'll keep an eye on all this, but different innovation here from Apple.
All right. Thanks so much, Sabeel. And stick with Yahoo Finance. Up next in the final round, you can, of course, catch 2020 A Time for Change at 4:30 p.m. We'll be chatting with former Oklahoma Rep J.C. Watts, as well as Claflin University President Dr. Dewan Warmack. You won't want to miss it. Stick with Yahoo Finance next.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's take a look at the market here an hour to go during today's trading session. We've got stocks moving lower here. The Dow and the S&P now both moving to session lows. The Nasdaq as well, though the Nasdaq remains the lone one of the three major indexes that is in the green right now. The Nasdaq is up about 15 basis points. The Dow's off about 0.6%. The S&P 500 is down about 0.4%. Now, earlier in today's session, the S&P did trade above that 3386 record closing high. That's the second session in a row that we've seen The index on an intraday basis trade above the closing record high, kind of a mind teaser there, but it does look like for the second straight session, we're not going to see the S&P hit a record high, though, as we've been discussing on this program, really for the last couple of months, it does seem that the S&P is headed to a record level. I mean, we're basically there, right? We're within 15 points of the record. You could call this record territory, certainly, for the index. And we've been kind of tracking, our move towards this level for some time here on the program. But just taking a look inside today's specific trading action, and really the last week has been a huge amount of rotation on a day in and day out basis in terms of leadership, in terms of the sectors that find themselves in favor, out of favor. Energy had been a real standout earlier this week, off 2% today. Financials sector we have talked about a lot, and really one that just cannot get off the mat here during this pandemic rally. XLF down about 1% today, and among 11 S&P sectors, if we look at the distance from 52-week highs, energy obviously off 40%. We all remember what happened with crude back in the spring. Financials, XLF, the only other sector among the 11 majors that is 20% or more below its 52-week high. Healthcare, discretionary, tech, communication services, all these sectors, even staples, they've got to record levels just within the last, several trading sessions. But really, financials just cannot find themselves any kind of sustained momentum here, and still, again, well off the best levels that they've seen just within the last year. Turning our attention quickly to what's going on in the FANGs. Facebook shares, they're basically unchanged. Apple, Amazon, Netflix, Alphabet, all higher during today's session. Microsoft shares off about 0.3%. I want to bring in my co-host, Shauna Smith, now joining us for the next 90 minutes of today's program. Shauna, just what stands out to you in today's market action?
It's interesting, Miles, because when you take a look at the broader market action today, yes, the Dow is in the red, off over 100 points. One of the big reasons for that is this 11% drop that we're seeing in Cisco. And we kind of saw there's so much excitement about the S&P maybe finally closing above that record high that it hit back in February. We're pretty far away from that at this point, I guess, down just around 15 points. So we're going to hit it soon. Like you were saying, we're probably not going to hit it today. But I think I agree with you that one of the most interesting things to point out is just this rotation that we have been seeing the last couple of days. And we're seeing some broadening out in the market. Investors aren't just favoring some of those tech names that we've been talking about. They're finding reason to buy some of those beaten down sectors. But from the market guests that we've had on, you and I have talked about this, and a couple of notes that I was reading this morning just talk about the fact that we need to see even broader market participation here in order for this momentum in the market to carry through, and especially for the S&P here, I think, to make at least some significant move above its record high. So I think that is important here as we look ahead to the rest of the trading day today, tomorrow, and then into next week. And then, of course, that econ data that we got out this morning on jobs, the jobless claims number better than expected, falling below 1 million for the first time since March. It's not having a huge impact on the market because historically speaking, it's still obviously a very weak number, but with claims below 1 million for the first time since March, like I said, I think there was some thought that maybe we would see a bigger move here in the broader markets or some of those names tied directly to the reopening of the economy, just because we can't read too much into it because it is a little bit backward looking, but maybe companies aren't closing down, or some of those jobs obviously aren't being lost, at least at the rate that they were earlier. But airlines are down today. American, United, Delta, Southwest, all in the red. Retailers, of course, falling as well. Kohl's and Macy's amongst the biggest decliners there. So I think, Miles, the reason for this is just the fact that I guess the jobless claims numbers are still very high, historically speaking, like I was saying, and therefore just the underlying factors that we've been talking about in the market, they haven't changed significantly. And I think the pressure now and what a lot of investors are watching for is more of this broader action, more of this rotation into some of these beaten down sectors. You mentioned the fact that financial is one of the only sectors here, in addition to energy, still off more than 20%. Below its 52-week high. So I think we still need to see some activity in those beaten down sectors in order for investors to be convinced that this market momentum to the upside can continue.
Yeah, and certainly, again, that seems to be the theme in this market. Just interesting to highlight the initial jobless claims data, which we talked about very briefly at the end of yesterday's program. And okay, under 1 million claims. Again, the worst week that we ever saw during the financial crisis was 650,000, give or take, initial jobless claims. Last week we had 993,000. So we're still 50% above the worst we'd ever seen before this period. And I think a lot of things veed off the bottom, but now we are definitely entering a period, kind of a show me period for the economy, just in terms of, and as you mentioned, Shauna, which businesses close permanently, which businesses decide over the coming quarters to downsize. We've talked a lot about the white collar layoff wave that could be coming up here, but all that, I think, again, augurs for a labor market, no doubt, has been seen the most disruption in modern history, probably in all of American history, but I think the initial rebound is going to come up well short of getting us anywhere near repairing the damage that was done in the spring. I want to turn to Jared Blickery now quickly for a look, just what stood out to you in today's market, Jared, because earlier today things looked fairly constructive, fairly placid. We had the VIX kind of flirting with 20 at one point. It was well under 22. And we've just seen a little bit of softness here as we get into the last hour of the trading day.
Yeah, this is probably going to get dragged out as long as possible. When are we going to get those highs? Just looking at the Wi-Fi interactive. Here's yesterday's attempt right here. Here's today's attempt right here. Just missed by a few points. Not a big deal in the long term. But you asked me about the other markets. It's really the bond market. And we'll go to a 2-month view here of the 10-year T-note. It's up about 21 basis points from this low here, which is right around 50 basis points. And that's significant because if we take a look at the year to date and we draw this trend line down from this high here, we have now definitively broken out. And it's interesting. We got Barron's, I think it was 2 weeks ago. And I only noticed this because JC Peretz was tweeting this. There is a magazine cover contrary indicator among traders, and this is what we're looking at. So they had free money. I don't know if you can see it there, but it's basically a spigot, and it's pumping out free money. And this occurred exactly at those 50 basis point lows. So possibly we have an all-time bottom in rates right now, but it's going to take a while to figure out if that's actually the case. But just throwing that out there. Finally, the VIX is at 22, 23 points right now. So not quite below 20, but still within acceptable ranges. Lars?
Jared, we've all seen the charts. I think Bank of America has the 5,000-year interest rate trend. Rates haven't been this low since 2000 BC, whatever part of the Roman Empire that was. Jesus never enjoyed interest rates this low. So, if this is the all-time low, then so be it. All right, let's turn our attention now to what's going on in the world of Apple and their services business, which we've heard them emphasize so much over the last couple of quarters. It appears the company is going to roll out a new Apple One subscription bundle, Dan Roberts, that I guess brings the whole family together. And I guess from your point of view, what would be the impetus to change the way they currently formulate their bundling? I mean, is it about Apple TV becoming a fuller offering? Is it about the music? Where do you kind of see this headed?
Well, I think this sounds smart. And by the way, Bloomberg reporting that it might be called Apple One, or that could just be an internal term. And this is an option you'll have with the new iPhones when they're unveiled in October. I think what's smart here, let's use me as an example. On the face of it, none of the Apple services interest me or appeal to me currently. I mean, you would be able to get music, arcade, Apple TV Plus, maybe cloud, and then fitness. And we know that they're planning some kind of new fitness service. At the moment, I would at first glance say, well, I don't want any of those. And especially take music. I already do Spotify. So it's definitely an either or right now. You're not going to subscribe to both Apple Music and Spotify. Now, that said, though, if we take someone who wants just one of those services, maybe someone who does already use Apple Music, or someone like a Dan Howley who's a gamer and wants the Apple Arcade, the idea of paying a cheaper fee and getting all of them bundled is pretty smart. And I think if you're a competitor that has any service that competes with any of these Apple services, you should be concerned. I mean, if someone wants, say, arcade and is interested in Apple's fitness product, but they currently subscribe to Spotify, but they see that they have an option to get the Apple bundle, maybe that makes that person switch over to Apple Music since it comes with the bundle anyway. So I think that it's a shot across the bow at existing services that could get people to switch over to one of the Apple services. Cloud storage, especially if you throw that in. You mentioned families, there's going to be some kind of family option, but I imagine there will be multiple tiers. I mean, if they're smart, There will be something for you as an individual, something that's a little more expensive as a family deal, more premium options that have 5 services, whereas a basic option has 3 services. And as you mentioned, I would also think it's a way to get Apple TV Plus in more homes, because as of now, they've only had really the morning show as the hit show, I guess, of the platform. And if that show doesn't appeal to you and the other shows weren't well reviewed, then you haven't had a reason yet to cough up the money and pay for yet another service for Apple TV Plus. But if you're going to get it as part of a bundle, then you say, well, sure, okay, I'll watch Apple TV Plus. So if this is coming along, I think it's a way to maybe boost subscriptions for everything. I think Peloton should be watching and concerned. Spotify should be watching and concerned, so on.
Yeah, Peloton, a stock under a little bit of pressure today, or had been earlier in the session. Right now, it's up about 1%. But this comes at a very interesting time for the App Store. And just some news crossing within the last hour or so is that Apple has kicked Fortnite off the App Store. Epic Games, their parent company, had been trying to essentially get their users to sign up and pay them outside of the App Store, so they didn't have to pay the fee. You'll remember on this program, we talked to DHH with the Hey email app a couple of, I think it was almost a month ago now, and they had their whole tiff melody hum with Apple taking the rake, that 30% rake on purchases made in the App Store. And I think this really highlights, we go back 2 weeks to all those tech CEOs on Capitol Hill. It really highlights that I think Apple is kind of the worst actor here in terms of how they use their market position to take a cut of other companies' business that's built on top of their service. I think we could all agree that Facebook is a bad company for all of society, but Apple might be clearly using their market position here in a way that's more questionable than the other peers they were up there with.
Yeah, which is an interesting turn of narrative, right? Because for so long, we kind of couched Apple as, oh, but they do care about our privacy. There are so many more kind of levers in place. But I think with an incident like this, and as the conversation gets more and more entrenched, I think it's not just rogue actors, right? These are big players like Epic Games, the owner of Fortnite, that are blatantly going rogue and saying, hey, this is an unjust system. And even on the day of the antitrust hearings and leading up to it, we spoke with lots of different analysts and people who are making comments about the structure of tech giants today and how monopolistic they really are. And I think Apple is always likened to a toll booth, right? Where you kind of have to go through the toll booth. It doesn't matter if you have an easy pass. It doesn't matter if you're paying cash. You have to pay 30% of your that 30% commission in order to exist, in order to survive, which is a common thread across a lot of the companies. I do want to read the company's statement in full from Apple, basically admonishing Epic Games, saying that they had to, quote, take the unfortunate step of violating the App Store guidelines that are applied equally to every developer and designed to keep the store safe for our users. As a result, their app has been removed. They enabled a feature in its app which was not reviewed or approved by Apple, and they did so with the express intent of violating the App Store guidelines regarding in-app payments. And Miles, I think this is just kind of, I would say, the second chapter of an ongoing novel that I think is being written right now. And I imagine that Epic Games, yes, they're being chastised, but this is not going to be the end of this sort of tit-for-tat battle.
And guys, one thing on Apple and the App Store, after those hearings 2 weeks ago or 3 weeks ago, whatever it was, there was a little bit of a general consensus that Apple, of the big four, kind of got off lightly. A lot of the questions toward Apple really weren't about its size and breaking it up. And so people kind of said, well, look, of those four companies, I remember I wrote up one analyst comment along these lines, Apple has the least obvious assets to break up. That is, you look at Facebook and you look at Google and you can point directly at big things those companies have acquired that if lawmakers really do this, which do we really think they will ever, they could say, you now have to sell off those assets. Apple, not so much, but then the App Store is really a big exception. It's sort of a different form of antitrust concern. But I think as more of these examples proliferate, Hey, which we talked to, and now Fortnite, it ain't good for sort of the optics of how the App Store works, that 30% fee.
Yeah, and I think it all fits into whether we're talking about the App Store, we're talking about like an Amazon marketplace type business. The maturation of all these industries have created a lot of large companies built on top of these services. And now they're saying, wait, I could be 10%, 20% larger if I just challenged Apple. And now I'm a big guy. I mean, Epic Games is now a big enough, strong enough company. They feel like they have the leverage to take on Apple, and they're of course not the only company who kind of works in that ecosystem. So very interesting times ahead, whether it's push and pull with lawmakers and also just good old-fashioned competition. Some companies think they're overpaying for some service that they can only get from one company. Well, that sounds like a monopoly to me. All right, coming up on the other side of this break, we're going to talk about our call of the day. Goldman Sachs initiating coverage of Penn National Gaming. We'll get into that coming up here in just 2 minutes. All right, it's time now for our call of the day. And today we are talking about Goldman Sachs's initiation of research coverage on shares of Penn National Gaming. They got a buy rating and a $60 price target on the Barstool parent company. Big day for the Davy Day Trader Global, right? That's what it is, DDGG. I think, Shauna, I have that right. And the whole Barstool gang. Now, I think it's interesting in this note that Goldman sees Barstool as essentially a customer acquisition channel for Penn, and a cheap one at that relative. And I know Dan Roberts has written about the ad spend that we've seen ramp back up from DraftKings, from FanDuel. Well, if you're Penn National, you just let the Barstool crew, I guess, do whatever they do, write posts, have podcasts, and it all feeds into this funnel of more people using Penn National's online sportsbook, which as we kind of get sports going again, we've seen heavy betting across kind of all the sports that have started up.
Yeah, Miles. I mean, Penn National Gaming CEO has said in the past a couple of times how Dave Portnoy is just this marketing genius. So it obviously makes sense that because of their massive following that they have, the company probably won't have to spend as much on advertising as some of its competitors does, as FanDuel or DraftKings has to here in the future. And then also just talking about their massive following. This is something that Goldman Sachs actually pointed out in their note, and they had a graph on this. They were talking about the number of Instagram and Twitter followers and also Facebook likes. They even threw that in there, that Barstool has compared to FanDuel, compared to DraftKings, and really by how much it really dwarfs some of their competitors out there. So just the importance here and the power of Barstool, that's really at the crux of this note from Goldman and what separates Penn National Gaming from its other competitors out there. And there was also a couple other strong numbers in this report as well. Goldman saying that it expects regional casinos to benefit from people not being able to travel or spend their money elsewhere on leisure activities because of COVID. And they think that that's going to amount to $230 billion. So some decent here projections, at least in the short term, from a Goldman that they think Penn National Gaming is going to be able to capitalize on. And remember real quick that this is a stock that has already doubled from the beginning of the year. If you take a look at where it was trading in January 1st, right around $25, $26 a share, now above 50, and Goldman thinks it can rally another 20%. So talk about just the power of the partnership, especially when it comes to Barstool's fan following that we all have talked about so much here at Yahoo Finance. But definitely it looks like a smart move here from Penn National Gaming, at least.
It's interesting, guys. You know, if the thinking was that Penn Gaming has upside amid the return of sports, which is also in here a little bit, and that's the case for all betting stocks, that's one thing. And also, if the thinking was that as Barstool grows, that's good for Penn Gaming as the majority owner, then that's another thing, and that's true too. I mean, it's the majority owner, so you know anything that's good for Barstool, hypothetically good for Penn Gaming. But I did find it interesting that the crux of the argument being, as Miles and as you, Shauna, both alluded to, the idea that Barstool readers and Barstool kind of fanatics and, you know, stoolies as they're called, fans of the site, readers of the site, viewers of the content, will automatically become Penn Gaming customers. And there's a really interesting line in here, the idea that it's going to be one of the lowest customer acquisition costs in the sports betting industry, allowing Penn to quickly take share from Barstool Sports' embedded customer base. That is the assumption that a Barstool fan would automatically become a gaming betting customer of Penn. That's where I took a little bit of issue, because I wouldn't necessarily assume that. Now, as you guys mentioned, Portnoy, the founder and president of Barstool, has really pivoted to being a stock guy during this time and has grown his own personal brand. I know Miles is interested in that sort of transition and taking advantage of the moment. And a lot of those personalities of Barstool talk about betting, and they love to talk about the over/under, and they love to talk about their bad losses. But I just wouldn't necessarily assume that most or that a high number of stoolies will automatically become sports bettors.
Oh, that's interesting, Dan. I think that's actually very likely, because we're talking about a prototype, right? There are so many Portnoy wannabes. They stand Portnoy no matter what he does. It's almost like this Muskian thing where he has developed this cult of personality. And to Shauna's earlier point of, the CEO of Penn Gaming calling him the mastermind marketer, and he has done some egregious stuff over the last several years. And especially during these race conversations, I'm just so fascinated that even though there's like bits of cancellation, it's not actually tearing him down, right? We just saw that they hired Deion Sanders, leading the NFL Network. I think Portnoy said in an interview earlier today with TMZ that he wants Charles Barkley to be another correspondent with Barstool. I feel like their profile is rising enough where there's so many people. To be perfectly honest, I'm not a stoolie, right? But I'm obsessed with the pizza reviews. I can't stop watching them sometimes. So when you think about the entry point and to that point of the lower CAC, I feel like I can't think of an alternative, right? To get somebody who normally would not be interested in sports betting, not be interested in that world at all. Portnoy has really spread himself out in many different directions to get people where they are, even if you're not interested in sports content whatsoever.
And of course, Dan Roberts will love that today. It appeared that Dave Portnoy was hanging out with the Winklevi, both of them, hanging out together, spending some time discussing the Bitcoin world. But to that point, Melody, I think what we also should think about too is who the profile of like the target daily fantasy sports bettor is. And I think, as someone who's dabbled in it, I think that the experience on FanDuel and DraftKings is mostly like, I'm just being had. I know it's all sharks. It's professionalized. And you wonder if Barstool can stay true to a more, let's call it a retail customer, someone who just wants to bet $1 here, $1 there. And it doesn't take a lot for that person who has 50, 75, even $100 in an account at DraftKings to just move it over to Barstool. It's not a huge commitment. The sharks are going to stay entering thousands of pools on DraftKings. We all know who was the guy? James Holzhauer, right? The guy from Jeopardy. Like, there are those people out there who actually make the money. And I do wonder if this sort of retail bent, and you see it with stocks, we see it now with the pizza, with Bitcoin, this everyman thing, I feel like that also has to be part of the brand. And it seems like it'll be easy for them to port over a lot of that enthusiasm into the app when it does, in fact, get itself fired up. Of course, regulatory risks, as always, Goldman flagging some of these. But again, buy rating, $60 price target, Penn shares. So they were up as much as 8% earlier today. Right now, up 8.5%, $53.90 per share with 35 minutes to go in today's session. All right, coming up on the other side of this break, we're going to talk about a theme, maybe we'll call it a 2018, 2019 theme. Are private markets the new public markets? We'll get into all that with Jack Castle of the Nasdaq coming up here on the other side of this break. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Well, as the market has recovered here since the pandemic, since the lows back in March, we've seen a very hot market for IPOs. SPACs have been a big trend, direct listings. Joining us now to discuss everything going on in capital markets is Jack Castle. He's Vice President for New Listings and Capital Markets at the Nasdaq. Jack, thanks for joining the program. So let's start with kind of the idea I tossed out in the tease, which is I think Matt Levine coined it, right? Private markets are the new public markets. Thinking about how you guys have the demand and how the private side, the secondary private side has gone for you guys. What's that been like in the last few months? And do you think there's a renaissance in companies wanting to go public again, or is there still a preference for remaining private if the capital is there?
Yeah, so the trend started a few years ago with companies staying private longer. We saw a lot of venture capital as well as institutional capital coming into the private companies so that they could capture this value creation as the companies continued to mature. And so at Nasdaq, we built out the Nasdaq private market platform to work with companies to structure and execute these secondary liquidity, from tender offers to buybacks to auctions and block transactions. And so it's been pretty directly correlated to the public markets. And a lot of that, again, is driven by buyer demand. But as we think of the companies, not only are they staying private longer, but there is demand from their employees to have liquidity in their private stock. So on the private market side for Nasdaq, we actually are coming off the best first half we've ever had for total transaction volume totaling $1.7 billion and a record number of actual programs that we had run for 29. So that was on the heels, a lot of momentum coming out of Q4 last year. We saw obviously kind of the world slowed down in March and April, but through May, we saw an uptick in the volume of deals, the conversations picking back up as the market started to stabilize. And we're very optimistic about the rest of the year for it.
And I just wanted to follow up quickly on that point about employee liquidity, because we talk about this a lot on the program when it comes to, say, a big private company X wants to go public. And I always make the point that a lot of this is going to be, hankering from employees saying, I'm sitting on all this illiquid stock. I need a liquidity event. Are companies being more proactive now and coming to you guys to say, hey, we'd love to get X number of employees, X amount of cash, so that we can sort of, I don't know, keep our executive path, the strategy we want to go, but also make sure that these, engineers we've incentivized heavily with a liquid stock can have an event and sort of stay happy and contented here at our business.
Yeah. Yeah, look, you're well versed in this. I mean, you nailed it. What we're seeing more and more, and about half of those 29 programs were Series A and Series B companies. And a lot of it is, again, that fight for talent, especially here in the Valley, in the Bay Area. When you think of the comp packages that your Googles, Facebooks, Salesforce, even Uber are able to put out for this engineering talent, for liquidity and immediate vesting schedules, et cetera, the private companies have to compete with that. And so they are in turn going not only to the employees, but they're looking at this as a benefit with their HR department. Hey, we're going to pick up and schedule a regular cadence of running these programs on an annual or even twice a year basis so that we can provide this for our employees.
Jack, Dan Roberts here. Let's talk specifically about Airbnb. And I know that due to your position, maybe you have to talk in more broad terms, but we see the reports of the company wanting to go public now. What's interesting is, demand was 67% down reportedly in the last quarter. I mean, this company, obviously, due to the nature of its business, has just been brutalized by the pandemic. And yet here we are. They're about to go public anyway. And first of all, we had previously thought Airbnb would definitely be a candidate for a direct listing due to sort of the way that avoids the hype, avoids the roadshow. Now it doesn't sound like that's the case. I mean, I guess remains to be seen. But some people see a kind of disconnect in the fact that companies like this are, expecting the public markets to greet them warmly when, especially for Airbnb, its business is not looking very healthy right now.
Yeah, it's a good question. So I cannot comment on any particular private companies, especially. But what we've seen through this transition with an incredible market in June and July is the market bounced back. I think it was 36 IPOs in June, 49 total in July. That was the most since 2014. Actually, I think we eclipsed the 2014. So there's still a lot of investor demand for these stories. And when you think of some of the unicorns that have remained private for so long, they're very smart about telling the story early in their life cycle. They're meeting with analysts, they're meeting with buy-side investors, large institutional firms, starting to test their narrative, starting to test their KPIs to see what's resonating well with the story. So as we look at the second half of this year, we see a lot of these companies that might have gotten hit with kind of the COVID downturn, or that might have, again, put a strain on the business. But if they have that narrative around how they're going to come out of this, how they have fixed the problems with the business and what that looks like going forward, because they have those relationships going into this, I think that the public markets, or at least those initial investors, are being more forgiving around what they've just gone through, because they're buying into the story, they're buying into the management team, and really the vision of the company for the long term.
I mean, Jack, to kind of push back on that a little bit, I think early on during March and April, as you mentioned, when we were speaking to venture capitalists, they said that there was a paradigm shift, that they insisted it would not be a growth at all costs sort of mentality anymore. But from what I'm hearing from you, it sounds like, nope, back to business as usual. We'll continue to incentivize and congratulate companies that are saying and promising large, ridiculous amounts of TAM versus just steadily growing a business. How do you sort of reconcile how startups will grow during this period? Do you really think it's back to business as normal, or do you anticipate there will be sort of a shift in the way people scrutinize financials?
Yeah, it's a great counterpoint and thought. I think, again, it's case by case. It's going to be company by company. It's going to be who's the end user. It's software versus internet versus healthcare, right? We've seen an incredible proliferation in healthcare, let alone the SPACs, as you had mentioned at the top. So it's going to be case by case. It's going to be based on TAM, of course. That's always one of the key metrics. I think now we're seeing more of a shift towards profitability. You don't necessarily need to be profitable at time of IPO, but you need to have a story there. You need to look people in the eye. You need to look at the investors through the roadshow and say, here's how we get here. Here's how we'll continue to grow. No, it's not going to be at the 80% clip, but if it's at 45% year over year growth, and now we're able to move this down to the bottom line and get to a position or a profitable position faster, then that will be rewarded, certainly.
All right, Jack Castle, Vice President, New Listings, Capital Markets at the Nasdaq. Jack, thanks so much for joining the program today.
Thanks for having me.
All right, coming up on the other side of this break, we'll turn our attention to the market. We'll also talk about the world of sports and helping pro athletes manage their finances. We're back with more on that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Let's go to Jared Blickery for a quick look at this market as we head towards the closing bell. Jared.
Yeah, we're seeing the FANG stocks, communication services, tech, consumer discretionary, all of those are outperforming. So reversion to the norm after what we saw Monday through Wednesday. And here's the Nasdaq 100 heat map right here. Apple coming within $3.60 of becoming a $2 trillion company earlier today. Pretty wild stuff here. Looks like, oh, I just got my access back. So let's take a look at the Dow, and on a 2-month basis, really have come a long way. This is a 12-day operating period right here. And we're going to track the sectors that have led the most over that 12 days. So even though it's been mostly the FANGs that have contributed to market cap, let's just take a look here. So we see at the top, yeah, it is tech, but then followed by industrials and consumer discretionary, communication services. So we do have at least one value play in there, which would be, or a cyclical play in there, which would be the industrials. To the downside, real estate and utilities, those defensive sectors, along with healthcare, have fared the worst. And just looking at our canaries, we can see the transports have been on an incredible run. And I think this is going to be snapping an 11 or 10-day winning streak right here if they do indeed close in the red. But we've seen strength throughout that sector, not only from the transport and logistic operators like FedEx and UPS, but also the travel names. So following that, we have retail up 10%, home builders up 7.6%. Then we got the regional banks. So even though the focus has been on the FANGs kind of driving the rally, there has been a lot of other participation. And just looking at market internals in general, we have seen the advanced decline lines on both the New York Stock Exchange and S&P 500 stocks reach record highs as of only yesterday. And they've been doing that on a continuing basis. So that should lead the indicator, or excuse me, lead the averages higher here. Usually we don't see that breadth just kind of turn on a dime.
All right, Jared Blickery, we'll check in with you after the closing bell. All right, let's turn our attention now to the world of sports. And we've talked a lot about the challenges for the leagues in resuming play and the money that they've lost. We haven't talked a lot about the challenges facing players over the last couple of months. And for more on that, we're joined now by Anthony Paul, regional partner and financial advisor at Raymond James Financial Services. And AP, thanks for joining the show. Let's start with, I guess, the challenges that your clients have seen in the last 6 months with, I guess, their world, everyone's world turned upside down, but all of a sudden guys are sent home from road trips, off-season programs are halted. I guess I should ask the most practical question, were checks that were supposed to come in not coming in? How did that work for some of your clients who are either paid during the season or paid 12 months, I guess, however they have it in their contract?
That's a great question. Thanks for having me today. I really appreciate it. So you diving into basically budget cash flow. So it also turns into an opt-in or opt-out for the NFL season. So if you opted in, then you're going to be paid accordingly based on your contract. If you opted out, then you're going to have two scenarios. Either you're a high-risk opt-out, which in turn results in a $350,000 stipend. If you're not a risk opt-out, then that's a $150,000 stipend. So what we've been talking to clients about is really that budget and cash flow, is that this stipend or whatever cash reserves that we have to last us to the next playable season that you're going to have, which is 21-22. So that said, is that we're really looking at, okay, on the budget, what do we have to cut? What can we not spend on? What can we reduce? Essential versus non-essential in terms of financial. Then also we're telling clients, if you have, if you get calls from a family member or a friend that needs financial assistance, let us be the bad guy. Let's tell them that, hey, no, this is not going to work. Take a page out of Kevin Hart's playbook, the way his checking and savings account is set up, right? I don't know if you know that joke, but long story short is that if you're opting in, you're still going to get paid, but there's also some things to look at if you decide, if the season is cut short. So there's still a focus on your budget and cash flow. And the byproduct that we've seen is because of what's going on in the environment, a lot of guys just aren't moving the way they used to. So they're not spending as much as they used to anyway. So you got a lot of different factors going in, but no, in terms of the season, they have come to agreement that you do get a stipend, whether you opt in or opt out. And if you play, you, of course, will get your contract.
AP, Dan Roberts here. Let's talk specifically about college football, because what is happening there is obviously a mess in some ways. The different conferences and the different decisions. Who knows if the remaining three really will be able to play in the fall. But the two that have canceled fall are claiming they'll play in the spring. A lot of people think they're just saying that and that college football in the spring really isn't realistic. I mean, if there is an attempt to play college in the spring, how does that change the sort of financial decisions for these guys? A lot of people just assume big stars are going to opt out because they've got to focus on NFL. And if you play in the spring, you're butting right up against the NFL draft. So some of those guys, the advice they're getting, I'm sure, is that you can't really do both if you're trying to go to the NFL, I guess, next spring.
It's a great question. And so there's each player has a different set of scenarios, and there's so many unknowns as we can look around just our own lives. But imagine now being a young man and his family have to make a financial decision that is going to be critical to his financial future. So you're now talking risk reward. So as you highlighted, is that the conversations now are either canceling or postponing. So if you postpone and go into the spring, now you're saying to a young man, okay, will you play? But if the NFL and the NCAA don't come to some type of agreement where that's an unknown, if they're going to move some dates around, will they push the draft? Will they change the date of the combine? No one knows. So if you're a college student right now, and if you're in the top 1% to 2%, meaning the creme de la creme, your first round or second round, your decision is a little different, right? Because you're going to say now, especially if you have that spring, or even if you do have the season, because some of the Power Three is still talking about having the season, is you have to make that decision as to, your financial future versus your health of yourself, your family, and your loved ones. So it's a lot on the table for a lot of these young guys now. So what I would say to them is that, you want to definitely make sure get really familiar with your scholarship, your choices in terms of your amateur status, like whether or not you sign an agent or do sign an agent. And also, if you decide to opt out and train for the upcoming NFL draft, you're going to have expenses. You're going to have training expenses, your personal expenses. Be careful with lines of credit and things that you get before you become a pro, because there are so many unknown factors. So it's a great point. We all want college football back. Heck, Saturdays, that's what you live for. But I cannot sit here and say to you that everyone knows all the facts in terms of the future holds in terms of the medical part of it, and the science is a science. So it's a risk reward conversation. It's a risk reward discussion. And if you're a student athlete and you have that amateur status, you really have to take some time with your family to make that decision and look at all these surrounding variables and figure out, even if there is spring ball, do you opt out? Even if there is a college season in the Power Three, what do you really want to do in terms of looking at your financial future, and what are the risk reward measurements around that?
Yeah. And then shift to some of these guys that have made their money and are doing well. I know you work with some more established veterans like Calais Campbell to talk about the kind of investments that they choose. You know, when we cover sports business, we often have athletes on here talking about whatever their newest tech investment is. A lot of these guys are pumping, you know, CBD products, but we've also had a lot of athletes who are getting involved in cryptocurrency investing. You know, Richard Sherman did it. Just a week ago, we talked to Spencer Dinwiddie in the NBA. He's very big on Bitcoin. And I'm just curious what you say to your clients on that specific area, or if there are areas that you say, you know what, stay away from this. You know, we had Rudy Klein-Thomas here on the show about a year ago, and he works with Andre Iguodala and some other NBA guys. And he was saying that in his view, you know, he says, I stay away from Bitcoin. I'm just curious your view on that.
It's a great question. You know what's interesting? Another thing that's come up in this time period, it all depends, like you said, if you have some seasoned vets. We've been having conversations with clients around just basically capital markets. When you go back to March and the lows, I had inbound calls from clients saying, hey, this thing is looking really cheap. Let's talk about some of the big names, as everyone has talked about, the Apples, the Amazons, the Netflix, et cetera. And so it's been really an interesting discourse, because a lot of our clients have now been looking at it as an opportunity to get in your more traditional capital markets in that space and looking at individual names. So that's been an interesting conversation. To your comments about what you've been seeing in the sports industry, you know, in terms of the VC piece, and looking at these opportunities. Today's athlete is far different from your dad, your granddad, my granddad's athlete. They now have access and opportunities to some of the most incredible investments in the world. But, you know, it's not for everybody. As you said earlier, it depends on where you are in your career. Because remember, you got to be excellent on the field, because that's what got you here to these opportunities. So to vet it and make sure it's appropriate for your risk profile, your appetite, that's why you have to have a team in place. And that's why you work with somebody like me to say, okay, does this fit what you're trying to do? But, you know, if you look at like the Andre Iguodalas of the world and all the, you know, the Kevin Durant's, et cetera, you're seeing that these guys are now at tables that they've never been at before and getting opportunities that they never have seen, especially from the communities they're coming from. One other thing I'd be remiss to say, I want to say, if I'd be remiss if I didn't, is that some of these guys are also really giving from the kindness of their hearts and their wallets to support some of the coronavirus victims out here in the family. So that's something that we should also look at, is that in looking at, you know, the philanthropic side of these athletes and the clients that we work with, some of them have been giving back with their money as well. And that's part of their budget as well.
All right, AP, great to get your thoughts on this. Love to hear that athletes, they're just like us. They just want to be in the FANG names in this kind of a market. Thanks so much for taking the time. We'll talk to you soon.
Sounds great. Thank you for having me.
All right, coming up on the other side of this break, we'll talk a bit more about what's going on in the U.S. economy. Stephen Blitz with TS Lombard will join us for that conversation coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's turn our attention now to what's going on in the U.S. economy. For that, we're joined by Stephen Blitz, U.S. economist over at TS Lombard. So, Stephen, let's just start with what we've seen the last couple of weeks. Today, we finally got a jobless claims print under 1 million, but it certainly seems that the economy stalled out kind of at best late July into early August. Is that how you're seeing it as well?
Yeah, the economy, I mean, based on all the high frequency data it has, and one of the confusing parts of trying to follow the economy in this environment is that you've got these big numbers that look so good because you're going from a COVID mandated shutdown to reopening. And what you have to look for underneath that is, okay, how far does this reopening go in terms of economic activity, and where are you left? And so, look, it's better than going from 7 million to 900 odd thousand on initial claims. Feels great. It is great. It is to be celebrated. But understand that at the worst point in the 2008-9 recession, weekly claims was 665,000. So the system, the economy is still laying off people at a high recession. So our view is that once everything's reopened to the extent it will be, we will be looking at a recession with about 8% unemployment and all that unfortunately goes with that.
And, you know, Stephen, the last couple of weeks, we spent so much time saying you can't let the CARES Act expire. It's going to be devastating. Well, it has expired. Obviously, the data have not come in yet on just how much harm that does to consumers. But are you concerned about this? I think some have called it a fiscal cliff of sorts, a benefits cliff that consumers have been walked off. Are you concerned about how that plays as we get into the fall here and we don't see an expected pickup? The market certainly thinks we're going to see a pickup, but we might just see a flat line.
Yeah, and that's part of the problem with the big positive numbers, right? So you're sitting in Congress and you're not inclined to spend the money anyway, and then you see this big, gain in employment, and then you say, that $600 was preventing people from going back to work, and all of a sudden you don't have it, and all of a sudden you see this big drop in initial claims. So you say, you see people are going back to work. It was keeping people away. So the reality is these high frequency numbers have a lot of volatility to them. It is going to hurt. It is going to hurt a lot of people. That's, without question. But let's also think a little bit about when we think about the macro numbers, and here's the lie and the difficulty in discerning this. And that is that when we look at who's unemployed, right, it's basically the very low end in terms of wages of the population, right? Leisure and hospitality is still sitting at a 25% unemployment rate. You have a 4% unemployment rate in financial services. And we know that basically, as a rule of thumb, 80% of discretionary consumption is spent by the top 20% of wage earners. So when you think about it in those terms, you realize that the loss here is going to be of this top up is going to be devastating for these people, and it's going to be devastating for the people who are supported by them. But when you bring it up to the broader macro numbers, understand that retail spending is basically back to where it was in nominal levels earlier this year.
Yeah.
We'll get the update on Friday, yet you still have all these initial claims, and in total about 30 million people getting, almost 30 million people continuing to get some sort of unemployment insurance.
Yeah, and as you mentioned, a very challenging time when you look at the aggregates of the economy versus the individual micro stories. Stephen Blitz, we'll have to leave it there. U.S. economist with TS Lombard, thanks so much for taking the time. It was great to get your thoughts.
Thank you. See you soon.
All right, coming up, other side of this break, watching the market here mixed as we head towards the closing bell. We're back with that in just 2 minutes.
Welcome back to the final round here on Yahoo Finance. I'm Shauna Smith. You just watched the closing bell here, and stocks closing the day mixed. We have the Dow well off its lows of the day, but off just around 0.3%. The S&P also closing in the red, off just around 0.2%, and the Nasdaq, the only major average here, eking out gains, pushing further above 11,000. It's interesting. Nasdaq coming off its best day in about 3.5 weeks, so still holding on to gains there. I mentioned some of the losses that we saw in the Dow today. Cisco, a huge underperformer. We brought you those breaking earnings results after the bell yesterday. That stock off just around 11% today on their disappointing earnings guidance. That's something that investors took issue with today. Exxon and Walgreens also off just about 2%. Taking a look at some of the sector action today, energy was the big decliner, off more than 1.5%. We also saw some weakness from real estate and financials. On the flip side, communication services, technology, and consumer discretionary bucking that downward trend. On the data front, we have to talk about the jobless claims number that we got out this morning, falling to less than 1 million for the first time since March, not having a huge impact on the market, though, because historically speaking, it's still a very high number. I want to bring in my co-host for the next 30 minutes, joined by Miles Udland, along with Yahoo Finance Editor-in-Chief Andy Serwer, Akiko Fujita, and Rick Newman. And Miles, taking a look at today's action, we didn't drift too far from the flat line, but Dow and S&P both moving to the downside. So what stands out to you in today's action?
Yeah, kind of a choppy day, and I do want to make Jared Blickery happy. Got to mention the bond market. That was really where we've seen the action in the last couple of sessions. I think we got into the all-time low earlier in the program. Jesus came up at some point there. But basically, look, we have a backup here in yields from south of 50 basis points, now north of 70 basis points. And a move of that magnitude in just a couple of sessions is going to upset some parts of the market. Of course, financials. We've talked so often about how bank stocks can't really get their act together. And just thinking about, and we were talking about this on yesterday's program, 2 days ago, I think we had Jim Bianco on. He's talking about, look, the impact a 1% 10-year yield could have on the market is probably not appreciated. And obviously, on a percentage basis, that's almost a 50% move higher from here, but it's only 30 basis points of actual effective yield on the 10-year. The record low heading into the pandemic was 138 on the 10-year. It's not crazy. We could get back to a one handle on the 10-year, especially for betting on better economic growth ahead. And that would certainly change the character of the market. And I think we've seen some of the outlines of that in the last couple of days.
Yeah, and that's interesting there because, Andy, we've been talking about some of this rotation that we've been seeing in the market, and outside of some of the leadership there, the rotation out of tech names and back into some of these other cyclically sensitive sectors, that's seeming to cool a little bit today. So it's interesting here when we try to identify where investors are really finding the most opportunity at this point.
Yeah, the other thing we've been talking about besides rotation, though, Shauna, is the safety trade and the fact that tech is the safety trade, paradoxical to people like myself who've been watching the market for decades. But in fact, that has become the case during COVID, as we know. So maybe not surprising to see those stocks doing well. And the news today, the headline, well, the jobs number broke the 20-week streak of over 1 million. I don't think our long national nightmare is over with that number. Plus, the stimulus gridlock is a real problem. And I think that really potentially does not bode well for equities. And then my final thinking here, top line, is Cisco that you mentioned, Shauna. And, geez, you would think that this company, with all the trouble that Huawei has, would be making hay right now, but they're not. They've had a number of quarters that have disappointed investors, and it's really been a tough time since last summer for Cisco shareholders. And I know Chuck Robbins over there, the big guy, must be feeling some heat and probably not happy right now, because with the rest of techs going up, he doesn't like to be falling behind and not with that pack.
Yeah, and that certainly is interesting here when you take a look at the fact that we saw Cisco off just around 11% today. So a massive drop. And I think a lot of the focus was on its weaker guidance that it issued there during their results. But Kiko, sticking with tech a little bit, because Apple was one of these names that I want to talk about, but I want to get your thoughts just on this potential backlash. I know you and I have talked about this in the past, and the story in the Journal today from President Trump talking about the fact that President Trump is targeting TikTok and WeChat. And they were talking about names like Apple, like I mentioned, but Ford, Walmart, Disney, among those names, on a call with the White House this week, saying that this order could undermine their competitiveness in China. And we talk about the backlash here and what this could mean for potential growth or lack thereof from these names in China, and how big of a issue that could be for these companies here, at least in the short term.
Yeah, I mean, bottom line, if you're a business that's operating in China, you need to be able to have access to WeChat. It's really as simple as that. And we had talked about that when that executive order was initially signed, about just how significant this app is to doing business, to communication, to really operating in any way out of China. And the Wall Street Journal report there saying that there are those companies like an Apple, like a Walmart, like a Disney that did reach out to the White House, had a call with White House officials on Tuesday to address their concerns. And the reason we're seeing this kind of lobbying right now is because while that ban is not set to go into effect until September 15th, if you read the executive order, there's no real clarity on the scope of the ban. Now, as far as we know, this would only apply to US jurisdiction, which essentially means for companies like Apple, they would still be able to offer and have the WeChat app in their app store in China. But that's going to ultimately be decided by Wilbur Ross, the Secretary of Commerce. So right now what we're seeing are businesses reaching out to the White House saying, look, if you move forward with this on the most stringent way, in a very restrictive way, it's going to be really difficult for us to do business. Again, we keep talking about this, but keep an eye on this weekend, August 15th. We've got that meeting between Vice Premier Liu He and Trade Advisor Robert Lighthizer. That is expected to be a conversation about where things stand on phase one of the trade deal, but you can bet the Chinese side will be raising the concerns on not just the ban on WeChat, but as well as TikTok, with that clock ticking down to September 15th.
Yeah, certainly will. And I've been a little bit, I guess, surprised, I guess you can say, about how China has seemed so measured here in their response so far to these attacks from the Trump administration. So certainly we will be watching for headlines out of that meeting. Well, I want to get to more on today's market action, really what we've seen over the last couple of weeks. And for that, we have Troy Gajewski. He's with Skybridge Capital, the co-chief investment officer there. And Troy, it's great to have you back on the program. Let's just start with that jobless claims number that we briefly mentioned at the top of the hour, falling to below 1 million, certainly is trending in the right direction. So I'm just curious, just your take on how investors are looking at this number, because on the one hand, it's much better than what we've seen, but historically speaking, it's still a very high number.
Yeah, it's really tragic when under 1 million claims is viewed as good news. And, I think investors have come to the conclusion, like we talked about before, that the economy never contracted as much as people feared. It's expanded faster from a higher low than what people initially expected. But right now, a lot of the focus is on the upcoming stimulus bill, because without a muscular stimulus, it's going to be very hard to continue this trend in labor market improvement, in consumption improvement, in industrial production improvement. I mean, the real success we had from the federal government in Q2 and early Q3 was all taking place in March and April when they got legislation passed fast. And now it's almost political malpractice to drag this out, because as you know, without the expanded unemployment claims payments as well as the direct stimulus, it's going to be much harder for consumers to consume and also service their debt, which could put us in for a mild contraction, going into the election.
Yes, true. I mean, it's interesting there, because we've been talking about the fact as to whether or not, since we've been getting a little bit better econ data out recently, maybe there's a way that we could spin this, that we don't need additional stimulus. But it sounds like you're saying that we need this number for it to continue, because if we don't get it, then the labor market is just going to reverse and weaken again.
Yeah, so it's not that the world's going to end if we don't get the stimulus, but it's going to be very hard to maintain the pace of improvement that we've seen since the lows in the labor market or the economy in April. I mean, the V that we got off the bottom was directly tied to that, and that personal incomes were up. They're still up 6% through June from January this year, yet consumption's down 5%, which has led to these massive savings rates. So there is pent-up demand. But if you want to drive unemployment down to the mid to call it 5 to 7% range by the end of 2021, and you also want to get back to peak GDP, which does not necessarily mean consumer incomes will be as healthy as they are now. You need another round of stimulus. And even if it's 1 trillion, that's still 5% of GDP. That's an incredible muscular number, but clearly a number closer to 2 would be far better for the real economy, which is now almost completely divorced from the equity market, which has become more and more dominated by the large cap tech names, as you guys know.
Hey, Troy, Rick Newman.
Hey, Rick.
Hey, what are your clients and other people you talk to in the investing community saying about a Joe Biden presidency? It seems possible that maybe investors will be fine with a Biden presidency, and there may not be any real disruption in stocks as we get closer to the election. And if it does appear that Biden has a good shot at winning, what do you think about that?
Yeah, that's a great question. So obviously, typically that would be the main event, but it's almost a sideshow compared to the pace of recovery, the upcoming stimulus, and Fed policy. But the expectation prior to the pandemic was if Biden was elected and the Senate would flip, and both of those more than likely have to happen together. You're not going to see a Senate flip without Biden winning and vice versa. Then there could be some fallout in equity markets in the nearer term from multiple compression due to higher corporate tax rates. Now, the consensus has evolved more to, well, if you get a Biden in the White House and a flip of the Senate, you're going to see more muscular stimulus that, again, benefits the real economy. So that in the near term will outweigh any fears of future higher corporate tax rates and higher rates in the upper decile or 2 of the population. So, paradoxically, you will more than likely get more economic stimulus and output with a Biden win. And the issues around corporate taxes will probably be pushed towards Q3 or Q4 of 2021, meaning, it's highly likely that the first act he takes as president is going to be to raise corporate tax rates, right? When we're in such an economic hole. That will come. And of course, at some point in late 2021, there'll be more regulation of tech, we think. But that's more of a 2021 issue. So I think there was a lot of concern early on, but as people have weighed the pros and cons of the Trump administration staying on versus a Biden and Democratic sweep of the Senate, markets have become more sanguine and investors have become a little more relaxed about the policy shift in DC.
Troy, I want to get back to what you said about the need for stimulus. I think you said muscular stimulus, and I'm curious.
I said it twice, actually. So
I think
apologies.
I'm curious, how significant that stimulus package needs to be in order to push the market higher. Is it enough to get some kind of agreement? I mean, right now we're talking a significant divide between Republicans and Democrats. What's the number, or what are the specifics in the stimulus you think need to be included in order to keep this momentum going?
Yeah, so enhanced unemployment at $300 a week, or maybe $400 if some of the states kicking in, is certainly better than nothing, right? However, that's no replacement for $600 a week plus the $1,200 in stimulus, which both sides had agreed upon, right? And so if you're doing $1 trillion and you're spending it over, say, 3 months through stimulus checks, enhanced unemployment, another round of funding for PPP, that would be sufficient to carry us on over the next month or 2. But it would be much better to do a larger stimulus that's going to be spent over a 6-month period to give markets more confidence. Now, again, we can't highlight enough the divorce between the real economy and the market. So the Fed has stopped expanding their balance sheet. If they start to fret over a lack of stimulus and they start to ramp up their balance sheet, you could see economic activity flatline and markets continue to go up. We just think that's getting less likely given the fact that PE multiples for 2021 are, roughly 21 to 22 times forward earnings, which is a very rich multiple, even with interest rates so low. And, one of your commentators said before how important interest rates have been to this rally. And that's a fact, right? I mean, one of the drivers of it continues to be that investors expect interest rates to stay low as far as I can see. And, a 10-year that does hit 1% could cause a little multiple compression as well, even with economic improvement.
All right, Troy Gayeski of Skybridge Capital. Great to have you back on the program. Thanks so much.
Yeah, great to see you guys.
All right, we're going to take a quick break here on the final round, but when we come back, Vroom, it's out with its first earnings report since its blockbuster IPO back in June. We're going to talk to CEO Paul Hennessy about the company's results. That's right after this quick 2-minute break. Welcome back to the final round. Vroom shares off just around 18% today after the company's first earnings report as a public company. The stock declining today after it posted a wider than expected loss, and also its third quarter guidance coming in a bit lighter than what the street was expecting. So for more on this, we have Paul Hennessy. He is the CEO of Vroom. And Paul, it's great to have you back on the show. Let's just talk about the second quarter. Obviously, it was challenging for you, for the company. Talk to us just about the headwinds that you faced due to COVID and how you're addressing those challenges in the second half of the year.
Sure, and good to see everyone. Thanks for having me back on the show. Second quarter was really an interesting quarter for us. As you all know, when COVID came on, we ultimately had a required reaction to the event. And so what Vroom did, seeing the pullback in demand, is that we priced our vehicles to sell. And sell we did. There was great demand. There was great encouragement from our customers, and we sold those vehicles down. And then as soon as the inventory kind of got down, as the market started to stabilize, we then saw that demand came back. And Vroom went on kind of the buying tear to secure inventory for our customers. And really, since the May timeframe, we've been at that. And now we've actually got the highbrow problem of demand being greater than our inventory. And so we're working really hard to add inventory to the Vroom business so that customers can take advantage of that. So we're very pleased with our results from second quarter. We had 74% growth in our e-commerce business, which is outstanding. And then since the sell-off of the inventory and now the rebuilding of the inventory, we've had sequential growth in June and in July. So we gave really strong guidance. I think what has troubled the street is that the average revenue per car has actually come down, and they were not expecting that. And that's because consumers now are looking to buy more affordable cars. And so Vroom actually secured those cars to meet that demand. And I think that's where you see the miss in revenue.
Hey, Paul, Rick Newman here. So, I mean, it's pretty standard in recessions, excuse me, that people who need a car, who might otherwise have bought a new car, if they are worried about money or have less money, they're going to buy a used car. How much of a shift are you seeing from new car buying to used car buying? And can you tell how long it's going to last?
Well, the used car market, as you know, Rick, is very large. It's almost 3 times the size of new. But given that there's been lack of production in new, we've seen real pressure in used cars, meaning customers coming into the market and buying used cars. And we see that in our own business. Customers are coming in droves. And again, we're sprinting to fill that demand. And I think that's going to last some time, particularly in our business. Because the beauty of the Vroom model is that we're transacting in a contact-free way and delivering in a contact-free way. And so customers are leaning in now more than ever.
Hey, Paul, so you talked about this bounce back in terms of demand from customers. And, we've been reading, of course, and listening to people talking about consumers wanting to drive, not trusting mass transit, maybe also wanting to take vacations and not flying. So if those are some reasons why you're seeing an increase in demand, I'd like you to comment on that. And if that is the case or not, will you see a continuation of this demand?
Yeah, Andy, we're definitely seeing that. As a matter of fact, our data is telling us that in addition to people driving more, using their cars more, reduction in mass transit because of social distancing, we're seeing all of that materialize in demand. We've also seen a very interesting thing as well. Even in cities, major cities, we've seen a 20% lift in sales where either potential customers are saying, I want to get away for the weekend or get away for a week, or they're actually migrating out of cities and now need vehicles to navigate, a suburban market. So yeah, we think, to answer your last question, we think all of this is sustainable. These are, material shifts that we're seeing in our business.
Paul Hennessy, CEO of Vroom. We'd love to check in with you next quarter just to see how things progress. Thanks so much for joining the show today.
Thank you very much.
All right, we're going to take a quick break, but when we come back, we'll have the latest on the stimulus talks. President Trump today saying that he's holding up the coronavirus aid package to block the Postal Service funds for voting by mail. We're going to have more on that and the implications of this right after this quick break. Welcome back. Well, President Trump reiterating this morning that the main reason stimulus talks have stalled at this point is over the additional funding for the post office. And of course, that surrounds the mail-in voting. So Jess Smith is standing by for us with the latest from DC. Jess.
Yeah, Shauna, things are not looking good for a stimulus deal. I know I've said that several times, but really they're not looking good today. The Senate just adjourned until September 8th. So Majority Leader Mitch McConnell says that he'll call senators back, give them 24 hours notice if there is a deal. But at this point, that does not look likely. And the House had already left under those same conditions. So now people have left DC, negotiators aren't meeting. And then today, what President Trump said in a Fox interview really probably hurt negotiations and made the odds of a deal even slimmer. He said in this Fox interview that one of the sticking points in these negotiations is funding for the United States Postal Service. He says he does not want that funding to go through because it would be used to facilitate mail-in voting. He went on to say, if you don't get the funding, that means you can't have universal mail-in voting. So he has consistently railed against mail-in voting with unproven claims of voter fraud. Speaker Pelosi responded to that today, saying that he is afraid of the American people, so he's putting up obstacles to keep them from participating in the election. But even aside from that massive issue that has come up now, there are many, many differences between the two sides in these negotiations. Speaker Pelosi outlined them again today, saying they're just vast differences. She spoke to Treasury Secretary Mnuchin yesterday and turned down a meeting because she said he wasn't budging. She wants him to come to $2 trillion. So far, the administration has said no. So we will watch for any movement. But at this point, it is still not looking good.
It certainly is not looking good. Jess, thanks for that update. Rick, I'd love to get your thoughts because yesterday we talked about this. You said yesterday, don't expect anything until the fall, into September. But I just want to get your thoughts just on this mail-in voting and the funding for the Postal Service, because I think that this issue just takes this whole thing to another level. Because when you take a look at the numbers, and Jess just said this, the fraud for mail-in voting is very rare. So it's a baseless argument that he's making.
Yeah, so think about what this does to the dynamics of these negotiations. So Trump has now basically shown his hand, and he has basically said, here's the reason I'm not agreeing to what the Democrats want, because I will not agree. And it's two sets of funding for the Postal Service. One is $25 billion for operations for the Postal Service. And then the second set of money is about $3.6 billion for states to help them pay for and set up mail-in voting. So call it $29 billion altogether. So Trump has basically put Nancy Pelosi in a position that if she gives in on any of those demands, it's going to look like Trump wins. So guess what's going to happen? Pelosi is going to demand all of that money end up in a final bill. And now we have a complete impasse. This amount of money is small potatoes compared to a bill that is where the starting price tag is $1 trillion. It's less than 3% of the total. And we could get a $2 or $1.5 trillion bill. But because Trump has now made this such a crucial issue, the Democrats can't back down. And how in the world is Trump going to back down at this point? So I think this actually raises the possibility that it scuttles the whole thing. And you could even have Democrats saying this is another reason to vote for Joe Biden, because once Joe Biden gets in, we will pass a clean stimulus bill and we'll get this all done.
You know, Rick, it's interesting because I know you've talked earlier about this being a game of chicken. And when poll numbers start to turn against one party or the other, when it comes to this deadlock, someone will capitulate. I agree, this complicates matters, but it's interesting to politicize the post office. And you wonder if, this is something that, I don't know if it's a third rail or something like that, where Americans are just going to say, let the post office be, leave it alone, or meaning fund it. Don't turn this into a political football. But it's so hard to see where this thing goes, I guess, right?
I mean, I'll give you some context on that, Andy. So recent polling by the Pew Research Center shows 70% of Americans favor mail-in voting for everybody, and that includes 49% of Republicans. So the numbers are higher for independents, and they're in the 80s for Democrats. And also think about who relies most on the Postal Service. Probably older Americans, and we're starting to see anecdotal reports now of seniors who get prescription medicine through the mail, and they are not getting that on time, and they're sitting there saying, what is going on in Washington that now I'm not getting my medicine on time? So I think this is a loser for President Trump. It's kind of easy to bash the USPS, but in reality, it's a pretty good deal, and a lot of people rely on it. And I'm not sure Trump is going to get the traction he thinks he might get on this.
Yeah, I agree with you, Rick. I don't think he's going to, and certainly is not going to be the last that we hear of it. So we, of course, will bring you any update here on Yahoo Finance. But we're going to take a quick break. Keep it right here. Coming up next, we have 2020, A Time for Change. It's our special coverage here on Yahoo Finance, and it starts right after this quick break.
Welcome to Yahoo Finance. I'm Kristen Myers, and this is 2020, A Time for Change. Well, as the coronavirus pandemic has dragged on, colleges and universities have been hard hit, but HBCUs have been particularly affected. We're going to be starting today's conversation there. Seville Marcellus, as always, is here with us for today's conversation. Jen Rogers is on vacation.
President Trump has been emphatic about his desire for schools to reopen this fall. But colleges and universities are already reeling from the financial devastation of the coronavirus pandemic, and they've been left to fend for themselves. It's up to them to decide whether they want to take on risk and open their doors in the fall or continue with remote online learning. Now, what we've seen is that the lack of a deal between the White House and Democrats for another round of fiscal stimulus could mean that some colleges and universities will have to close their doors permanently this fall. Joining us now is Dewan Warmack, president of Claflin University, a historically Black university. Now, Dewan, you caught my attention when you said that when other institutions catch a cold, historically Black colleges and universities catch the flu. Now, I know that this fall you're going to be doing online remote learning. What has been the impact of the coronavirus pandemic on Claflin University's finances?
Yeah, first off, thank you for having me on. And I say, and I mean that, HBCUs have been able to persevere and be successful for a long time, and so when you think about historical context, but for Claflin University, it's a very interesting time, right? When you think about where if we can't bring students back, we lose revenue for room and board. But what makes HBCUs special is that campus environment. That's what separates us from other institutions, the nurturing environment, the family atmosphere. So losing that makes it extremely challenging for an institution like Claflin. So we could face anywhere from a $6 million to a $10 million deficit just for the fall semester.
Wow, that's pretty significant. And in December, I know that President Trump signed legislation to provide more than $250 million a year to historically Black colleges and university. Have you received those funds? Is that going to have an impact?
I think you have to extrapolate that. There's 100 HBCUs, over 100 HBCUs, and then the formula that's in Pell Grant, that's in Title III sponsor program. So that's not really like a lump sum of cash coming to HBCUs, and so when you're losing students, that's restricted, that's unrestricted revenue. And so those dollars from that 250 can't be used to make up a budget shortfall. Does that make sense? Like so those are operational costs that's there. So if it's earmarked for Title III programming or Title IV for federal financial aid, then that's different. That comes with the students. That money goes directly with the students. But if it's, for us, yeah, so I can't say that money directly impacts my bottom line. Does that make sense?
Yes, no, it definitely does.
So, Dr. Warmack, I kind of want to run through some stats with you right now. When we look at the average endowment size for HBCUs in 2019, it was less than $150 million. Now, if you're looking over at predominantly white institutions, that number is over 800 million. The HBCU endowment total was just over $2 billion. As you mentioned, $2 billion spread across over 100 universities, HBCUs, is not a lot of money. So when I think about the future of HBCUs, I think that it's fairly bleak, at least without any sort of meaningful intervention. I mean, are you seeing the landscape for HBCUs similarly?
Well, not really. Only because our HBCUs have been able to persevere for years without support, right? And so we understand this, the historical context. When we were founded, we wasn't founded because everybody loved us and thought that was the best thing. We had no other choices, right? To provide access and opportunity for folks who didn't have access and opportunity. And so that has, been perpetuated over the years in the limited funding and the funding equity challenges. So I don't, yes, it's bleak in a sense of we have to find a way now, as we've always had to be creative and innovative to ensure our students have an opportunity, not just to survive this, but thrive through this time as well. So I would use Claflin University. I just see this as a minor setback for a major comeback. And so we are doing everything in our power to ensure we have continually been ranked in the top 10 amongst HBCUs in the nation. We have continued to graduate students at extremely high rate. This freshman class we just brought in again for the 10th consecutive year, mean GPA is at 3.65. So we have top quality students that are choosing our institutions because they want to be there. And so we will get through this financial piece. And I love how corporations are looking at now helping support the endowments and funding some of our HBCUs. And I just, shameless plug, want to get one of the top 10 HBCUs, Claflin University, that has been the top 10 for consecutive years in that mix.
So following on that, a lot of corporations giving a lot of money to, well, I want to say HBCUs, but really it's Howard University, it seems, in particular. Their endowment, almost $700 million. The next big name on that list is about 300 million. So I'm wondering why you think Howard gets the lion's share of money from corporations and from donors. And as you're seeing companies, in this movement after George Floyd's death and his murder, if you're saying, hey, look, Howard has a lot of money, perhaps consider giving to Claflin, perhaps consider giving to Grambling, perhaps consider giving to one of these other HBCUs that does not have the level of funding that a media darling like Howard University has.
Right. And so I will not take away from my colleagues at Howard at all, right? I am excited that they're able to build that. But if you still compare Howard to a lot of the large mainstream institutions, theirs is low, respectively speaking, right? And so I think it's, I think what Howard is doing has been able to leverage itself in DC. They're one of the few institutions that it's a private institution that gets state and federal money from the government, and it goes towards the endowment. So I am happy for what happens at Howard. But for me as well, there's other institutions out here that are doing just as good or better on a lot of the matrix scales that could use some of those funding. So I wouldn't say give Howard less, right? I would say, give Howard plus others. There's a ton of funds that are out there and philanthropists that are doing it. And so for me, if it was based on a certain matrix and success rate. If you look at U.S. News Report that most companies and organizations look at, we're there in the top consecutively. And people, if they look at a participation, we've had the largest alumni given amongst HBCUs for maybe 7 to 8 consecutive years. Over 40% of our alumni give. But with that wealth, it's not a large wealth piece that's there. That given number is low. But they believe in the institution and have been significantly committed to give funds. So I just think, some of the other corporations and companies and major organizations just have to hear other names outside of the big ones, And so Howard has been successful in leveraging the Howard brand, and Morehouse, Spelman, and my other colleagues, and I'm excited for them. But I just know there's an HBCU in the state of South Carolina. You put us up against anyone else in the country, we're just as good or better. And so if there's some philanthropists that would like to give to an outstanding institution that's been doing transformational work, look at Claflin University. We will be good shepherds over that, and you will be investing into fertile ground.
Well, hopefully some folks out there are watching and decide to open their pocketbooks to you. I'm wondering, in the aftermath of the murder of George Floyd and all of the protests that we've seen since then, if Claflin has been impacted in a positive way, at least financially.
Well, I wouldn't say because of George Floyd. I mean, I just think the impact, I will say this, in light of COVID, our applications jumped up significantly. We had over 10,000 applications for this year. So, where students probably historically have been thinking about going to other institutions, other types of institutions, Claflin's long history of being committed for over 151 years of access and being a thought leader around inclusion and diversity forever. We have an outstanding Center for Social Justice that we're unapologetic about that commitment to equity. And so, so we haven't fell short as it relates to the enrollment factor. And I think our enrollment has increased partially because some of the things that are happening around the country. And we want to remain a thought leader in that space to help folks understand that what does it mean to be in a space, not just that you can go and be educated academically, but you can go socially, spiritually as well, and develop that whole student. And that's what Claflin University does.
And let's talk about the elections coming up. As we know, Biden has picked Kamala Harris, and she is the graduate of a historically Black university, Howard University. Now, during the primaries, Biden promised more than $70 billion in investments for historically Black colleges and universities. Do you think that's enough? What would you like both Biden and Harris to promise come the elections in November?
Well, I think it's one thing for a presidential promise, but I think as we all know, it has to get through Congress, right? And so understanding that context and knowing the nuances that come behind that is challenging. And so we're asking for a commitment to our HBCUs. We're not asking for a handout. We're asking just for a hand up. We have historically done an outstanding job. If you look at HBCUs, graduate the most African Americans in the medical field, in the law field, in the criminal justice field, but we only educate 3% of the college population, but we're the thought leaders in every one of those categories. And so when you say punching above your weight, HBCUs consecutively does that. So just imagine what a little investment would do. And so as a CEO of an institution and of an organization, I believe in what's my ROI. So if I see these organizations are that successful, I would want that same return on my investment if I know that I can invest this amount of dollars and get this. So you've invested this small amount and look at the success rate. So imagine if you double that or triple that, imagine the success rate. So you're talking about gainful employment. You're talking about getting folks in the workforce. HBCUs have been doing it forever. Just invest a little more and we'll continue to be successful.
Well, Dewan Warmack, president of Claflin University, thanks so much. Coming up,
for having me.
Of course, absolutely. We're happy to have you on. Coming up, a former vice president at the Federal Reserve makes the case for why Congress should take note of the disproportional impact of the coronavirus pandemic on the Black community in crafting new legislation. That's up next.
Welcome back to Yahoo Finance. This is 2020, a time for change. Well, we finally got a vice presidential pick from Joe Biden earlier this week, California Senator Kamala Harris. Now, Harris is both the first Black woman and first Asian American woman to appear on the ticket for a major party. So for more on this VP pick, I want to bring on former Congressman from Oklahoma, JC Watts. JC, thanks so much for joining us today. I had to start off first on this news about Kamala Harris being picked for VP. I'm wondering what your thoughts are on this pick and if you think that she'll be broadly appealing, not just to Democratic voters, but perhaps even Republicans who are maybe feeling a little bit dissatisfied with the Trump presidency.
Well, I think, Kristen, when you consider the question you just asked, I think first and foremost, you pick someone, I think a candidate, a nominee picks someone that he can first take care of home base. And I think he did that with Kamala Harris, with Senator Harris. I think there are some disgruntled Republicans. It remains to be seen where they'll go or where they might land between now and November 3rd. But I think, the former vice president took care of business to say, I've got to take care of home first, and then we'll grow our circle over the next 2.5 months.
So I'm wondering, you are a Republican. For those who do not know, you are the Republican congressman for Oklahoma. I'm wondering if you can speak to the issues that are most concerning Black conservative voters right now. If you're hearing that they're feeling left out over the last 3 years in this Trump presidency, and if they're searching for perhaps another candidate that they can go with instead. And is Joe Biden, is the Biden-Harris ticket appealing enough for them?
Well, Kristen, I first of all, I don't need a political party to love me, and I don't need a political party to love. I think what I look for is a candidate, I think, that will take seriously the African-American vote. I think both parties, by and large, have taken the African-American vote for granted. The Democrats, I can make a strong argument that they have, but Republicans, conservatives, I think the issue on the right is that they do not allow an African-American to be Republican, conservative, and Black. They say you've got to be one or the other. And I think it's very difficult for African Americans to say, you expect me to denounce the experiences that I've had over the last 55 or 60. I'm 62. I remember when I couldn't swim in the public swimming pool. I remember when I had to sit in the balcony of the movie theater. I've had 6 police officers pull me over at 3 p.m. in the afternoon, not 3 a.m. in the morning, but 3 p.m. in the afternoon as a member of Congress in the city that I represented. And so you can't denounce, or you can't separate yourself from those experiences. And I think Republicans often lose out with the Black vote, not necessarily with, lower taxes or balancing the budget or those type of things. I think they missed the Black vote because of the race issue. I think it's been somewhat challenging over the last 3.5 years in this administration to attract Black voters, but that remains to be seen. And so I think both parties have their challenges, but I think Senator Harris is probably going to have more sway concerning the Black vote than what the Republicans currently have in their lineup.
President Trump's stance with the protests is law and order. Basically, if mayors or governors need help, he's willing to bring in federal law enforcement. Now, do you think more empathy might serve him better in terms of attracting whatever Black votes he can get in November?
Well, I think, and Kristen, I don't necessarily think in law and order in the true sense of what that means, that's necessarily a bad thing. But when you consider law and order and you look at Ahmaud Arbery down in Georgia, you look at what happened to George Floyd, you look at the protests that we've seen with Black Lives Matter, you look at the protests that you've seen in the National Football League with Colin Kaepernick. That's law and order doesn't necessarily fit those protests. They're pro. Reverend King said back in his day, the letter from Birmingham jail. He said he was talking to some white clergy, responding to some white clergy who were being critical of him, of his nonviolent protests. And he said, "You will be critical of my protest, but you will not recognize why I'm protesting." And so I think, when you protest, if you protest peacefully and in a nonviolent fashion, law and order is, that doesn't reconcile with peaceful protest. And so when you talk law and order in terms of politics or using that to push people's buttons, I would say that's wrong. But when we're talking about law and order to make sure that peaceful protests can be carried out, that is the American way. And I think we cannot ignore why Colin Kaepernick was protesting. We cannot ignore, why people are protesting in terms of what happened to George Floyd. So when you go back to your question about the black vote, I think Ahmaud Arbery was the tipping point. I think George Floyd was the turning point. And I think you've seen Black Republicans, Black Democrats, you've seen people from the white community, from the Hispanic community. It's more than Black people who have stood in the gap for George Floyd and what happened to him here about 3 or 4 months ago.
All right. Well, we'll have to leave that conversation there. J.C. Watts, former congressman from Oklahoma. Thanks for joining us today.
Kristen, thanks for having me on.
And coming up next, we will be hearing from Roger Ferguson, TIAA CEO. That's next. Welcome back to 2020, A Time for Change. Well, in this week's installment of Influencers, TIAA President and CEO Roger Ferguson joined Andy Serwer. And one of the topics that they discussed, the disproportionate impact minorities have faced from the coronavirus. Take a listen.
The coronavirus has taken a disproportionate toll economically and in terms of health on people of color. And I'm wondering if you think that Congress should specifically address those populations.
I've been on a few phone calls where I think that probably does, make some sense. we have to recognize the reality that the coronavirus has disproportionately affected minorities, as you say, for a variety of reasons. And thinking through the process of helping to rebuild those communities, I think is very, very important. I believe that at least some members of Congress are thinking about the possibility of doing something with community development organizations that focus in those spaces. You know, others I think have asked for specific focus on HBCUs, historically Black colleges and universities. And so I think it is important for Congress to, you know, take note of the reality around them, that this virus has disproportionately impacted people of color. I think the statistics show that, you know, African Americans make up approximately 13% of the US population, but make up something like 20% of those that have been impacted by the virus. You know, I may have my numbers off slightly. You know, that I think calls for national attention. And in part, it is a result of the fact that, you know, health inequities and disparities have been built into the system. You know, it's related to wealth inequities and disparities, related to income inequities and disparities. So there is a pattern here that is playing out in these virus impacts, but that go back in the history of the country. And I do think it's important for Congress to acknowledge and take note of that. Absolutely.
Wants to hear the rest of that interview. The full interview is going to be up next at 5 p.m. Eastern right here on Yahoo Finance. Now, Sabeel, as I was listening to Roger speak, I was especially struck by his call essentially for Congress to do something specifically about it, particularly as we have these negotiations, these stimulus negotiations stalled. Because I actually was looking at a new study that crossed my inbox literally, honestly, an hour or two ago that said that Black female-owned businesses received less than 0.5% of PPP loans. So it'll be interesting to see if Congress decides to make specific moves going forward to help minority communities that have been disproportionately impacted.
That's right. And every time there's a new negotiation when it comes to another round of fiscal stimulus, it's an opportunity for the White House and for Congress to actually address some of the racial inequalities that we're seeing, the racial pay gap in legislation. As we know, the coronavirus pandemic has disproportionately impacted the Black community. So it's an opportunity to address that. But if they're not talking, very difficult to do.
Yeah, unfortunately, I don't think Democrats and Republicans are going to be meeting at the table anytime soon on these issues. Well, that is our show for now. Thank you all so much for watching. Make sure to tune in next week at this time, 4:30 p.m. Eastern, for our next episode of 2020, A Time for Change.